We'll be dealing with chapter number 14, Rectification of Errors. So what exactly is this rectification of errors is? When any sort of mistake is committed intentionally or unintentionally in the books of accounts, we group them as errors. Intentional mistakes are mistakes which are committed to take unfair advantage or some undue advantage. Unintentional mistakes are those mistakes which are committed due to lack of knowledge of accounts or accounting principles and all that. Now, these errors are basically divided into four categories: error of principle, error of omission, error of commission, and one more group called as compensating errors will be there, and they'll be resolved at different stages. So look at this error of principle. What is this error of principle? Is when wrong application of accounting principles, that is wrong application of your debit and credit rules are done, the resultant error will be called as error of principle. Clerical errors, all the other errors are grouped as clerical errors. Error of omission, what is omission? Is you forgot to record either debit or credit, or you forgot to write both. Okay, debit and credit is like we call them as complete omission and partial omission. Error of commission, what is this error of commission? Is when the account is wrong or account is correct, the side is wrong, or account and side are correct but the amount recorded is wrong. These are grouped as error of commission. Okay, and you will have one more category of error which is called as compensating error. What is this compensating error? Is one error in an account which is there on the debit side will be compensated by another error which is there on the credit side. Okay, so they are it can be 1:1 or it can be 1:multiple multiple. So compensating is your trial balance tallies. And while discussing trial balance chapter, if your trial balance tallies, it means that it is only a conclusive proof that your accounts are correct, that is your debits and credits are correct. But still, in spite of having trial balance which is tallied, we can't say that your accounts are correct. Okay, and what is the next thing? These errors are resolved in three different stages. Okay, that is before preparation of what we call as trial balance, that is at the stage of journal or ledger or subsidiary books or ledger. After preparation of trial balance, that is after extraction of trial balance, and the last stage is after preparation of final accounts. And how is it done? We'll see that with the help of a what we call as problem here. Let's go to our CRD1. Okay, look at that. Correct the following without opening suspense and with suspense account. That is first stage and second stage. They are asking you to rectify this is first stage, this is second stage. They identify, if you identify these errors in the first stage, how will you resolve them? See that. Okay. So sales book has been totaled 100 rupees short. Sales account shows a credit balance. There is a 100 rupees less in the sales account on the credit side. We enter it on the credit side of sales account. But can I write an entry? No, because only one account is wrong. You will not have a chance of writing an entry. Only when both the effects, debit and credit effect of a transaction are wrong, then we can write an entry. Okay. So what is it I'll do? I'll go to sales account. I'll write that in sales account as by undercasting. Look at the thing. What is it recorded? By wrong totaling of sales book. Undercasting or wrong totaling or wrong casting of sales account. Next, goods worth 150 returned by Green & Co. have not been recorded anywhere. These things are not recorded anywhere. So it's a complete omission. Both the accounts are wrong. I can write an entry. Okay. What is the entry that we are writing? Returns inward. That is sales returns account debit to Green & Co. I'm in a position to write an entry. Why? Because both the accounts, debit account is wrong and credit account is wrong, because it is a case of complete omission. Goods purchased 250 have been posted to the debit of supplier. When you purchase goods, you will post that onto the credit side of the supplier account. But what is the mistake that this guy has done? He has debited it. So when the side is wrong, account is correct, side is wrong, the impact will become double. In order to resolve this, in order to rectify this, we have to write it on the correct side, double amount. Okay, see the thing. Gupta & Co. is a supplier. In that account, by errors in posting 500, what is the original value of the transaction? 250. I'll be writing it on the correct side, credit side of Gupta & Co. an amount of 500 in order to resolve this particular error. Look at the next one. Furniture purchased from Gulab Rose 100 has been entered in purchase day book. Furniture is an asset, and of course purchases are also asset, but this is a tangible asset. It was supposed to be debited to furniture. They wrongly debited to purchases. Can I pass an entry? Yes. Two accounts are wrong. Furniture account is correct. Purchase account is wrong. Furniture account debit. Purchase account credit. That is what we have done here. See the thing. Furniture account debit to purchases account. Next, discount received from red and black 15 has been entered in the discount column of the cash book, has not been entered in the thing. So if it is not entered in the cash book, there is no way that you will find this entry even in the account of red and black, because posting into red and black account must be made from cash book only, correct? So it is missed out. What is that we will write? Red and black account debit to discount received account is the entry for rectifying this. Now, discount allowed to G. Mohan and Co. 18 has been entered in the discount column of the cash book. It is recorded in cash book. The account has not been entered in the discount column of the cash book, but it is correctly recorded in G. Mohan and Co.'s account. So, what is wrong? Only discount allowed account is wrong. So, I have to update this only in discount allowed account on the debit side. I'll be writing it in the discount allowed account debit side as to omission of entry in cash book 18. So, because of omission in cash book, it was not transferred to discount allowed account. Okay, so this is like first stage before preparing trial balance. If the same errors are resolved after preparing trial balance or after extracting trial balance, how are they done? All the one-sided errors, that is, in a transaction, if only one account is wrong, debit is wrong, credit is correct, or credit is wrong and debit is correct, we will be routing it through a temporary account called the suspense account. Let's see the thing. Same problem, second stage. The sales book has been total 100 rupees short. I'm crediting sales account, corresponding debit should be given to suspense because it is a one-sided error. Only one account sales is wrong. Look at the entry that is passed here. Suspense account debit to sales account. Let's increase this. Okay, suspense account debit to sales account. Look at the next one. Goods worth 150 returned by Green & Co. have not been recorded anywhere. Even in the previous stage, we wrote an entry. Right, even in this entry we'll write the same entry, returns inward account debit to Green & Co. Next, goods purchased 250 have been posted to the debit of supplier account. Just now we have discussed Gupta & Co. account has to be credited with 500 and corresponding debit will be given to suspense account. Suspense account debit to Gupta & Co. Okay, because it is only Gupta & Co. which is wrong. Next, furniture purchased from Gulab Rose 1000 has been entered in purchase day book. So what is the entry that we have written in the previous stage? Furniture account debit to purchase. The same entry will be repeated even here. The difference will come only when you are rectifying the one-sided errors. They will be routed through suspense account in your second stage. Next, and discount received. Just now we wrote the entry black and red and black account debit to discount received. The same entry is recorded here. And the last one will be discount allowed account was debited and corresponding credit will be given to suspense account now. Discount allowed account, this is discount allowed account debit to suspense account. Okay, and they have prepared the suspense account here. Suspense account, it has got a difference of how much? 582. Okay, they didn't give the difference here and we found the difference to be 582 rupees. Trial balance, if it was prepared, you would have got a difference of 582. Okay, let's see the next problem. Right, CRD problem number 2, correct the following errors found in the books of Mr. Da. The trial balance was out by 493, excess credit. There was an excess credit, obviously suspense account will show a debit balance, to balance brought down, or the difference in trial balance will be 493 on the debit of suspense account. The difference thus has been posted to a suspense account, they don't have a choice. An amount of 100 was received from D. Das on 31st December 2020 but had not been omitted to be entered in cash book. So if something is omitted in cash book, it will not be there in the other account also. Who is the other party? D. Das. So it is not there in cash, and obviously you will do the posting in D. Das account based on cash book only. If it is not there in cash book, obviously it will not be there in D. Das account. So we'll write an entry, cash account debit to D. Das account. Look at the journal entry here for CRD problem number 2. Okay, cash account debit to D. Das account. The total of returns inward book for December has been cast 100 rupees short. Returns inward, okay, sales returns, debit balance, sales returns account debit to suspense account, or returns inward account debit to suspense account. The purchase of an office table costing 300 has been posted through purchases account. So office table should be a part of furniture. Furniture account debit to purchases account will be the entry, rectifying entry to resolve this. Okay, next, 375 paid for wages to workmen for making showcase have been charged to wages account. It should be debited to what? Showcase account or furniture account. They have debited to wages account, right? So what is the entry that we will write? Furniture account debit to wages account. This will be the rectifying entry. Furniture account debit to wages account. Okay, next. Purchase of 67 has been posted to the trade payable account as 60. You purchase something on credit worth 67 rupees. Trade payable account was to be credited 67, but you credited only 60. So what is the under credit there? 7 rupees. Now we will credit it. Suspense account debit to trade payable account. Or creditor is given. Better write as trade payable here. Next. A check for 200 received from PC Joshi has been dishonored and was posted to the debit of allowances account. Doesn't make any sense, right? When a check is received and subsequently it gets dishonored, the concerned person who gave you the check should be debited. PC Joshi was supposed to be debited, but it was wrongly debited to allowances account. Both accounts are wrong. I'll write an entry. PC Joshi account debit to allowances account. PC Joshi account debit to allowances account. Next. 1000 paid for purchase of motorcycle for Mr. Dutt. So this is purchase for the purpose of Mr. Dutt. Has been charged to miscellaneous expenses. It should be debited to drawings account, but it was wrongly debited to miscellaneous expense account. What is the entry? Drawings account debit to miscellaneous expenses account. Next one. Goods amounting to 100 have been returned by the customer. Sales returns, a debit account was taken into inventory. You added that to the inventory, but no entry in respect of thereof was made. Nothing was recorded. So what is the entry? Returns inward account debit to customer account or trade receivable account. Okay. Returns inward account debit to debtor, that is personal account of the customer. Next, a sale of 200 to Singh & Co was wrongly credited to their account. So when you are selling it to Singh & Co, you are supposed to debit Singh & Co and credit sales account. What is that you have done? Wrongly credited to their account. Okay. Account is correct. Side is wrong. When the side is wrong, the impact will be double. You have to correct it on the correct side by writing a double amount here. So Singh & Co account debit to suspense account, an amount of 400. Okay. And they have what we call as prepared the suspense account. Initial balance, debit side balance was 293. Excess credit was there. It will be debit. It got tallied here. It means that there are no further errors as such in this particular party's books of accounts. Okay. That is Mr. Dutt's books of accounts. Next, let's see the next problem here. CRT problem number 3. On going through the trial balance of Ball Bearings Co. Limited, you find that debit was in excess by 150. Debit is excess now, which shows suspense account has a credit balance. By balance brought down. This was credited to suspense account. On close scrutiny of the following books, they noticed it. The total of debit side of the expense account has been cast in excess by 50. So, expense account has got an excess debit. So I have to credit it now, give a corresponding debit to suspense account. Suspense account debit to expenses account or expenses account, 50 rupees. Next, the sales account has been total in short. Sales will show a credit balance. I have to give a further credit of 100, giving a corresponding debit to suspense account. Suspense account debit to sales account. Next, supplier account has been overcasted by 225. Supplier account will show credit balance. There is an excess credit. Debit supplier. Corresponding credit will be given to suspense account. Supplier account debit to suspense account. Next, the sale of rupees 100 from a party has been posted to that account, though the party account was not posted to sales returns account. Okay, sales returns are made. Party account is correct. The mistake is there or the error is there in sales returns account. We have to debit sales return account and give a corresponding credit to what? Suspense account. Only one account is wrong. Next one. A check of 500 issued to the supplier account shown under trade payables towards his due had been wrongly debited to purchases. When you are making payment to a supplier by giving a check, supplier account was supposed to be debited, but wrongly you are debited purchase account. Now rectify it by debiting supplier and give a corresponding credit to purchases account. Okay. Trade payable account debit to purchases account. Next one. A credit sale of 50 has been credited to the sales account and also to the trade receivables account. Trade receivables account was supposed to be debited for credit sales. You credited it wrongly. So in order to rectify it, debit it with a double amount, that is 100. Trade receivables account debit to suspense account, 100 rupees. Okay. So what is the suspense account story here? suspense account, unlike in the previous problem, Mr. That's problem here, the suspense account is not closed. Still you are having a balance, two balance carried down 425 rupees, which means that still some more errors are there in your books of accounts which are supposed to be traced. Okay. Now, what is that they have asked in the question? Pass the necessary entries. We are done with it. Show the effect of these particular errors on profit. And what errors will affect your profit? If a nominal account is involved in the rectification entries, it will affect your profit. Let's see what are the nominal accounts that we have. Expenses account 1, this will affect the profit. Sales account is an income account, nominal account, this will affect your profit. Supplier, personal account will not affect your profit. Sales returns is to be treated as an expense, it will affect your profit. Trade payables to purchases, nominal account, this will affect your profit. Trade receivables to suspense. So how many entries are affecting your profit? 4 entries are affecting your profit. Let us understand the impact. Expense account is created, expense account is decreased, profit will increase. Okay. Sales account is created, sales account shows a credit balance, sales is an income, it is again created, profit will increase. Sales returns, we are treating it as an expense account is debited, okay, profit will decrease. And what is the other one? Purchase account is credited, okay, purchase is expense, okay, it is credited, what will happen? Profit will increase. So what is the net impact? Let's see that in a statement form, net impact of this particular rectification exercise what we have done just now. So look at the statement there. Yeah, they have prepared a statement here. Mistake in totaling and expenses account. Just now we have discussed when purchase expenses, expense account is credited, what will happen? Expenses decrease, which means that the profit will increase. 50 rupees increase. Sales is credited further, profit increases. Okay. Purchases is credited, profit increases, and sales returns is debited further, 100. So 650 is the increase, 100 rupees is the decrease, net of 550 rupees is the net increase after rectification of these errors. Okay. So let's see the next problem. Problem number 4. The trial balance of Mr. W and H failed to agree and the difference of 20,570 was put in the suspense account pending investigation. Okay. So a difference of 20,570 was there in the trial balance and they have put that to suspense account and they have given you the reasons, obvious reasons. Purchase returns daybook has been correctly entered and totaled at 6,160 but had not been posted to the ledger. Purchase returns account will show credit balance. You were supposed to post this on the credit side of purchase returns account. You didn't post it. Now you have to rectify it. Suspense account debit to purchase returns account will be the entry. Let's go and see the entries here. Okay, suspense account debit to purchase returns or returns outward account. Either way, 6,160. Simple case, you didn't post the amount. Next, discount received 1,320 had been debited to discount allowed account. Income of discount received of 1,320 has been shown as a loss by writing it as what discount allowed account. How many accounts are wrong? Discount received is not posted. Unnecessary debit is given to discount allowed. So we have to cancel it. Discount allowed should be created. Discount received should also be created. Corresponding debit twice the amount. 2,640 rupees are to be debited to suspense account. Look at the entry here. Suspense account 2,640, discount allowed for cancellation, discount received correctly entered now. Okay. Next, the sales account has been under added by 10,000. So now we will add it by creating sales account, giving a corresponding debit to suspense account, 10,000 rupees. Okay, this is the entry. Next, a credit sale of 1,470 has been debited to the customer account as 1,740. So account is correct, side is correct, but the amount went wrong. Okay, and what is the amount? Difference of amount is 270, 260, 270. 270 rupees is the difference. So what is that we are doing? Customer account should be credited now. Why? Because there is an excess debit of 260 rupees, 270 rupees. Suspense account debit to trade receivables account. Do not use the general version as customer here. Okay. Next. A vehicle bought originally for 7,000 4 years ago and depreciated to 1,200 has been sold for 1,500 in the beginning of the year, but no entries other than in the bank account have been passed to the books. So what is the problem here? There was a vehicle which was purchased 4 years ago, originally purchased at 7,000. This information of 7,000 is not relevant to us. The WDV of the asset was 1,200 and it's sold at 1,500, which means that it is giving you a hint that you made a profit of 300. And what is that they are telling you? Except for bank entry, they made the entry in bank, but the other accounts are not recorded anywhere. That is, vehicle account is still not having any entry for this, and profit is not accounted for. What is that we are doing? In the place of bank, actually, the original entry will be bank account debit 1,500 to vehicle account 1,200 to profit on sale of vehicle 1,200. What is this? 300. Balance is 300. Yes. Did we record this? Bank entry is made. So we cannot invoke bank. In the place of bank, I'll be replacing it with suspense now. Suspense account debit 1,500 to vehicles account 1,200 to profit on disposal 300. Okay, done. Next up, an accrual of 560 for telephone charges has been completely omitted. What is accrual? Outstanding telephone charges is not recorded anywhere. What is the entry for outstanding telephone charges is, we'll debit it to telephone charges account and give a corresponding credit to outstanding telephone charges account. Yeah, telephone charges account debit to outstanding expenses or outstanding telephone expenses. Next up, yeah, very important point. A bad debt of 1,560 had not been written off. First and foremost thing, your trade receivables should be reduced by this amount of 1,560. Provision for doubtful debt should be maintained at 10% of trade receivables, which were shown in trial balance. So what is that we will do? First, out of this 23,390, which is shown as trade receivables in your trial balance, we have to remove 1,560 with a credit provision of 2,000. Already they have a provision account in trial balance standing with a credit balance of 2,320. So, and one more thing, this particular seventh transaction, seventh error, whatever is given to us, has got a connection with the fourth one. Okay, now why? Customer account was debited in excess by 270 rupees. Remember, we adjusted it. What is that we have credited? Customer account, which means that we have to remove this 270 and then bad debts, then find out the provision, then apply the 10% on provision on trade receivables and compare it with the old provision. Let's see the thing. Okay, so first and foremost thing, 23,390 minus 260, is it 270? Reduce that 270. After that, we have to reduce this 1,560. Balance comes to how much? 21,560. Are we getting it as 21,560? Now, on that amount, when I applied as 10%, if your provision is 21,000, is it coming 21,560? Right. Old provision is 2,320. New provision is 2,156 rupees required. Okay, let me check that once. Yeah, 21,560. 21,560. Right. 21,560. 10% of that comes to 2,156. New provision that you have to maintain is 2,156 rupees, but already we have an existing provision of 2,320, which is in excess by how much? 164 rupees. So what is that I have to do? When old provision is sufficient, no problem. But when the old provision is in excess than the required provision for the current year based on the trade receivables at 10%, I have to reverse it. So what are the entries? First, I will pass an entry for 1,560 towards bad debts. Bad debts account debit to trade receivables, reduce the trade receivables. Then I'll compare the provision. What is the difference that you've got? 164 rupees. Here, it's given here. 164 rupees is the difference. And what is that we are doing? We will revert the provision. Provision will be debited below because there is an excess credit in provision account to the extent of 164. So what is the entry here? Look at the entries. Bad debts account debit to trade receivables for reduction. Provision for doubtful debts account debit to profit and loss account, because whatever old provision is there, that was sufficient and it is in excess by 164. We are reverting it. Careful with this kind of things, and always problems like this, they will have an excess. Okay, if you forget this 270 or 260, okay, entire calculation will go wrong. Next, let's see the next point. Tools bought for 1,200 has been inadvertently debited to purchase account. Tools are what? Loose tools. We have seen that in your final account chapter. Loose tools are, yeah. So they are assets. We should debit it to loose tools account. But what is the account that is, yes. So loose tools account debit to purchases account. Done. The proprietor has withdrawn for personal use goods worth 1,960. No entries have been made in the books of accounts. Drawings account debit to purchases, complete omission, drawings to purchases here. Okay, and better have an eye on this particular adjustment. Careful with this particular thing. Okay, this 270 should be adjusted first, then you adjust the gadgets. And what is the status quo of suspense account? Did they give us the opening balance? Yeah. Suspense of 20,570 amount is given, but which side was excess and which side suspense account balance was there was not given. So by balance carried down, the suspense was there on the credit side, which means that the debit was in excess by 20,570 in the trial balance. Okay, now let's see the next problem. Yeah, so we are done with the second stage after trial balance before final accounts. Now we are looking at the last stage. What is this stage? Final accounts are prepared, you have closed your financial year, final accounts are done, and you have prepared your accounts with suspense because you could not trace the errors in the accounts. And what is the uniqueness of this stage is, all the nominal accounts are already closed in your trading account and profit and loss account last year. If you come across any of the errors in these nominal accounts which are debited and credited to your trading and P&L account, those are to be routed through a common account called as P&L adjustment account. Why? Nominal accounts, they affect your profit, and profit directly affects your capital. Okay, so look at this. After rectifying the errors, P&L adjustment account should be closed by transferring it to capital account, because these nominal accounts technically they affect your profit. Let's see problem number 5. The following mistakes were in the books of a concern after its books were closed and suspense account was opened in order to get the trial balance agreed, and they prepared the final accounts, closed it. See the thing, sales day book was overcasted. This you found out after completing final accounts. Sales day book was overcasted by 1,000. Okay, what is the entry? If it was second stage, previous stage, I would have written the entry as sales account debit to suspense account. Can I write sales account now? No. P&L adjustment account debit to suspense account. Sales account has been replaced with P&L adjustment account because sales account happens to be a nominal account. A sale of 5,000 to X was wrongly debited to the account of Y. When you sell it to X, you should debit X, but this guy is wrongly debited Y. So X is correct and Y is wrong. X account debit to Y account. Okay, no nominal accounts are involved here. Both the accounts are personal accounts. Next, general expenses, nominal account. General expense of 180 was posted in the general ledger as 810. Excess debit was given to the expense. Now we have to reduce it. If it was the previous stage, I would have written as suspense account debit to general expenses. Can I write general expenses now? No, it is already closed in your P&L account. So it will be suspense account debit to P&L adjustment account to the tune of 630. Next, a bills receivable of 1550 was passed through bills payable book. Bills receivable which was accepted by the customer and gave it, he has given it to you. You have passed it to which book? Bills payable book. Complete book has changed. So, and who has given it? P has given it. So, customer, you have changed his role from customer to supplier now. Okay. So, how to resolve it? What is correct? Bills receivable is correct. Bills receivable account debit. Bills payable for cancellation, and P account should be credited with the double amount. Look at the thing. Bills receivable account debit. Bills payable account debit to P account 3,100. Next, legal expenses of 1,190 paid to Mrs. Neetu was debited to personal account. When you pay legal expenses, you have to debit it to legal expenses, but this was wrongly debited to Mrs. Neetu account. And what is that we are doing? Legal expenses account is the correct account. Can I write legal expenses? No. So I'll be writing it as what? P&L adjustment account debit to Mrs. Neetu account. Okay, next. Cash received from Ram was debited to Sham. When you receive cash, you debit cash and give a corresponding credit to the party. But what is that you have done? You have debited the party account. So Ram should be credited, Sham should be credited, right? Because wrong person, wrongly debited. Suspense account with the double amount. Suspense account debit 3,000 to Sham account and to Ram account. Next, while carrying forward the total of one page of the purchase book to the next page, the amount of 1,235 was written as 1,325. Oversight, and the amount has been recorded in excess. And which account is it? Purchase book. So what does it have to do? I have to reduce it by crediting purchase. Can I credit purchases? No. So suspense account debit to P&L adjustment account is the entry. And what is the excess amount? 90 rupees. Okay. And then we'll prepare P&L adjustment account and suspense account. See the thing? So they didn't give us what do we call as the balance, suspense balance. Did they give you suspense balance in this? No. So they prepared their final accounts with a suspense balance of 2,720. When you the difference in suspense account debit side minus credit side, you got it as 2,720. It was there in their trial balance the previous year. With the same suspense balance, they prepared the accounts. And what is that we have to do with the P&L adjustment account? P&L adjustment account is basically meant for adjusting the profit. But where is the profit? Profit is already included in your capital. That's why we close it against capital. Okay. Balancing figure of 1,470 rupees. Okay. What is that we have done? What is the entry? Capital account is debited. Capital account debit to P&L adjustment account because there was an excess profit transfer to capital. Now we have reduced it to the tune of 1,470. Okay. Now, let's see the next problem. Who is the party here? Roy, Mr. Roy. Mr. Roy was unable to agree the trial balance last year and wrote off the difference to profit and loss account of that year. Next year, he appointed a chartered accountant who examined the books and found the following mistakes. So now a chartered accountant is doing the rectification exercise for Mr. Roy. Let's see did they give us suspense balance? No, nothing is given. So we have to understand, we have to find out suspense balance and where was it, debit or credit. Purchase of scooter was debited to conveyance account. Asset has been treated as an expense. Okay, so motor vehicle or scooter account debit to P&L adjustment account, because conveyance account, if it is already closed in our P&L account, right? What is the entry here? See, motor vehicles, they didn't write a scooter, they wrote as motor vehicles account debit to P&L adjustment account. Next, purchase account was overcasted by 10,000. If it was a previous case, I would have credited purchase, but now I'll credit P&L adjustment account. Corresponding debit will be given to suspense. Suspense account debit to P&L adjustment account, 10,000 rupees is the value. Next, a credit purchase of goods from Mr. P for 2,000 entered as sales. Purchases are treated as sales. Okay, so purchase should be debited, sales should also be debited, and corresponding credit should be given to party account. Who is the party? P account. Look at the thing. P&L adjustment account 4,000. What is the breakup of this 4,000? Purchases 2,000, sales cancellation 2,000 to P account 4,000. Customer, supplier has been treated as a customer here. Next, receipt of cash from Mr. A was posted to the account of Mr. B. Cash is received. A account was supposed to be credited, but you posted it to B account. B should be debited, A should be credited. Okay. B account debit to A account. Simple error. Next, receipt of cash from Mr. C was posted to the debit of his account. When you receive cash from Mr. C, he was supposed to be credited, but you debited his account. Since the account is correct, side is wrong. Amount is also correct, side is wrong. I have to write it on the correct side with double of the amount here. 500 will become now 1,000. And his account is supposed to be credited. Suspense account debit to C account. Okay, suspense account debit to C account, 1,000 and 1,000. Next, 5,000 due by Mr. Q was omitted to be taken to the trial balance. Who is Mr. Q? He is a trade receivables. He was supposed to be included in the group of trade receivables. You didn't include it. Now we'll include it. Trade receivables account debit to suspense account. Next, sale of goods to Mr. R for 2,000 was omitted to be recorded. Altogether complete omission. Mr. R account debit to P&L adjustment account, or R account debit to P&L adjustment account. Payment of 2,395 for purchase was wrongly posted as 2,593. This is again an oversight mistake. Okay, amounts. And what is the difference? Can you tell me the difference? The 198 rupees. Right. So what is that we are doing? Look at the entry here. Suspense account debit to P&L adjustment, or originally we would have written it as suspense account debit to purchases account, tune of 198. And we'll be writing two more entries after preparing P&L adjustment account and suspense account. Okay, the same logic what we have applied in the previous problem, right? Suspense account, what is the balance that they had after adjusting it? Roy's capital. Suspense account has been transferred to Roy's capital here, and P&L adjustment account, obviously it will be transferred to Roy's capital account. Okay, why is it transferred to capital account here? The difference was it transferred to P&L account? Yes, the difference was posted to profit and loss account. That is the reason why we are closing suspense account against Roy's capital. Okay, so this is it. This is your rectification of errors chapter called as inventories, chapter number 15 in our list of chapters. So what exactly is this inventory? Inventory, all this time we know inventory as closing stock, and you have adjusted this in your final accounts chapter. Okay, but now we'll be seeing this inventory word elaborately. So inventory can be defined as an asset. It is an asset held by the business in the ordinary course of business, that is for sale. Whatever finished goods are there which are meant for sale, they will be called as inventory. In the process of production, whatever is there which is in work in progress state, that is semi-finished goods, are also considered as inventory. And whatever are meant for consumption in the production of goods and services, that is so-called raw material, will also form part of your closing inventory. Okay, now different types of inventories depend upon the nature of business. Every business may not have the same kind of inventory. So inventories of a trading concern may consist of products which are like meant for sale, that is they will not have something called as raw material, and they will not have something called as work in progress. Trader will buy what we call as completely finished goods and he will be selling them. But when it comes to a manufacturer will have elaborated classification of inventory, that is you will have raw material, work in progress, you will have finished goods, and all the what we call as things which assist them in this what we call as production process, like packing material, etc., and all that will also form part of this. Okay, so every year at the end of the year, what is that they will do? The business has to do the valuation of inventory, and this is one of the important or most valuable current asset a business holds. And inventory includes what? It is not just the stock that is there in the possession or which is there in the godown. It also includes goods held by branch. Head office has sent the goods to branch. Stock that is there in branch is also an inventory which will be added, though physically it is not there with the head office. Goods held by consignee. Okay, in consignment you have seen, okay, consignee, whatever stock is there with the consignee, it is also a part of your stock. Goods sent on sale or approval or for which the time limit has not expired, this thing will be taken as inventory. Goods sent on delivery basis and yet to lying with the transporter, that is goods which are in transit. We already wrote this as closing inventory. Out of that, goods in possession and goods in transit will also be counted as inventory. Goods purchased but not yet received, these are purchased but they are in the possession of the supplier. So these things, maybe they are in transit or they are still lying in the possession of the supplier. So in case of inventories, if you see the classification, in case of manufacturer will have the elaborated classification of what we call as inventory. Look at the thing: raw material, work in progress, finished goods, stores and spares, packing material. But when it comes to traders what do we call this? They hold only finished goods. They will not have this raw material, work in progress, and all that, stores and spares, packing material. Maybe they will have packing material, but not all. So the classification of inventory when it comes to manufacturer is quite elaborated than what we call as the traders. So inventory valuation, basic principle. What is the basic principle that you are following? Inventory should be valued at cost or net realizable value. We will arrive at two values. Two values will be taken. Whichever is less will be taken as value of inventory. Why? Because this is driven by the concept of conservatism. The principle of conservatism says that show the lower of two, that is cost or net realizable value. And we'll be what do we call as, we'll elaborately see what cost is, what is cost, and all that is given here. Net realizable value, how exactly it is done. Inventory record system, how this inventory is recorded. There are two principal systems. Periodic inventory, that is they will not maintain any record. Whenever they purchase, they will just open the godown, put the stock in the godown and close the godown. They will not be having a track, they will not be having a record, no godown record will be there, anything like that. That is periodic inventory. And under this system you have to arrive at closing stock, like what do we call this? By using the formula, opening inventory is already known, purchase or known, closing inventory physically counted. So you have to get the inventory counted physically that is there in the godown to arrive at your COGS, that is cost of goods sold. This is one system. and the system suffers with a lot of what we call as limitations and all that. And what is the thing? And moreover, periodic system is used by small businesses which hold a low value of inventory, very less value of inventory. But when it comes to perpetual inventory system, this is a, what is perpetual is continuous inventory system. A godown will be there, a godown manager, what we call the stock register will be there, or stock register will be updated. We'll have a stock register, okay, or they will maintain a software on a computer. Whenever something enters, even if one item enters into the godown, it will be updated first. So they will have a real-time tracking of inflow and outflow of stock under perpetual inventory system. And under this system, opening inventory is no. This is common in both the formulas. Purchase made during the period, obviously we'll understand it from purchase account. Less cost of goods sold. Whatever stock went out of godown, that is cost of goods sold. When you reduce that, the balance amount will be taken as closing inventory. There you are arriving at closing inventory by physically counting it and arriving at closing, what we call as cost of goods sold. But here we are deducting cost of goods sold based on the outflow out of the godown. The resultant value will be your closing inventory. And in what we call, just now we have discussed, inventory ledger or stock ledger or store ledger will be maintained. They'll maintain a register in this format. Date, receipts, issues and balance will be the main columns, and after that they'll have quantity, rate, amount, and outlet. They'll be maintaining the what we call as register like this. Register like this. And let's try to understand what we call this particular methods, the issue procedures and all that with a example. Okay, what exactly is this perpetual inventory system is? This is how your perpetual inventory system's ledger looks like, store ledger looks like. They will have columns, particulars column, purchase and issues are recorded, receipts, issues and balance. And in this they follow methods FIFO, first in first out. Whatever comes in first will go out first. So at any given point of time in your godown, you will have the latest stock under FIFO method. Okay, now under LIFO, this is one of the last in first out. You will have the oldest stock in godown and the latest stock will be issued. It is very rare. Only for those things which get more value as the time passes, those goods or inventory will be issued under LIFO method. But majority of them, okay, will be done using what we call as FIFO method only. And we have mathematical methods like simple average method and what we call as weighted average method. Now that is under what we call as the store ledger is maintained under perpetual. If they are not maintaining it, the same methods FIFO, LIFO, simple average, weighted average will be calculated, but the valuation of inventory done under perpetual inventory will be more accurate than what we call as periodic inventory. Okay, the system suffers with what we call as a lot of drawbacks where the valuation will not be correct. So perpetual inventory is always more accurate than what we call as periodic inventory. Now we are looking at what we call as non-historical cost methods. So whatever we have discussed just now, FIFO, LIFO, simple average and weighted average, they rely on historical cost. That is, whatever amount is paid by the business to acquire the inventory, that is the base for calculation of inventory valuation. Non-historical cost methods are, we will not see how much money is paid for acquiring the inventory. What is the cost that is incurred to acquire the inventory, or we may not have a chance of what we call this getting a clarity of how much is spent. For example, look at the thing. Under non-historical cost methods, in your syllabus, they have given only adjusted selling price method and standard cost method. And as far as problems are concerned, only adjusted selling price method is given. Now, what exactly is this adjusted selling price? It is also called as retail inventory method. This method is extensively used in retail businesses where it is technically or logically it is not possible to find out the cost of inventory. Why? Because they will have huge amount of inventory. Large amount of inventory will be maintained. Let's go with something like Reliance Fresh, okay, a hypermarket called as Reliance Fresh, or go with DMart. The kind of items, the number of items that they deal in, it will be literally impossible for them to what we call as have a track of cost, because all the lots that are being sold will not be purchased at same price. So what is that? How do they handle it? How do they arrive at cost? Is instead of going with cost, they have a system called as fixed margins. Every article or every group of articles or every article which forms a part of particular group will have a margin. For example, stationery will be sold at this particular profit. Okay, what we call the soft drinks are sold at a particular profit. Okay, rice is sold at a particular profit. So every item will have a prefixed profit. So why am I talking about profit when you are dealing with what we call as cost is from selling price? When I reduce the profit margin that is there, the balance part will be cost. That is the ground, or that is the base for this particular method. Valuation of inventory will be, look at the formula here, selling price, look at the formula, selling price of the inventory. Usually we go with cost of the inventory or net RV with NRV of the inventory, but here we are going with selling price of the inventory, and we are deducting gross profit from that to arrive at something called as cost. Okay, we are applying the formula reverse. Usually we'll write as cost plus profit is equal to selling price. We are going the other way. Okay, now let's try to understand this particular method using a problem. We'll see that in a problem. So CRT problem number 2. Messrs XYZ are in retail business. Following information is obtained from their records for the year ended 31st March 2020. Goods received from suppliers subject to trade discount and taxes. Trade discount 3%, sales tax is 11%, 15,75,550. This is not the final value. We have to arrive at the purchase value, goods received value. And how do we arrive at that? Look at the thing. Determination of cost of purchases, 15,75,500. And what is the first thing? We are reducing trade discount. First you remove trade discount, then we calculate tax on that, right? So 15,75,500 less trade discount of 3%. We came to something like 15,28,235. From on that I'm adding sales tax. It's nothing but GST. 1,68,106 rupees total comes to this, and they are paying something like packing and transportation charges 87,500. So purchase value comes to 17,83,841 rupees. Now this is the cost part. Look at the other one. Sales during the period, they made a sale of 22,45,500. and sale price of inventory. Till now you have always seen inventory at cost, but this is the first time you are seeing inventory at selling price. So what does that have to do? First I have to find out the gross profit percentage and remove that gross profit percentage from selling price. A very simple method. Okay, next target is, see the thing, determination of estimated gross profit margin. Sales made during the year, confirmed sales are how much? 22,45,500. okay, to that what is that I'm adding? Closing inventory and selling price. That is, we are going with an assumption that if the entire stock is sold, how much will this retailer get? He will get 24,80,500. And from that, if this is the total revenue minus cost, what is the 17,83,000? Just now we found out the purchase plus packing and transportation cost. We got the gross profit amount as 6,96,659 rupees. And when you calculate the profit margin percentage, you're getting a percentage of 28.09% on sales. Now, how do I find out the value of closing inventory? Selling price of the closing inventory 2,35,000 provided in the problem here. Okay, so what is that I'm doing with it? Minus gross profit margin 28.09% comes to 66,012 rupees. Are you getting the same? Yeah. So what is the cost of inventory? 1,68,998 rupees is your closing inventory as per, yes, as per adjusted selling price thing. Okay, now let's see the next problem. Okay, again the same what do we call as adjusted selling price concept, because this is, yeah, from the following particulars ascertain the value of inventory as on 31st March 2020 and also the profit. Inventory as on 1st April 2019 1,42,500. Purchase made during the year are 7,62,500. Manufacturing expenses, selling expenses, administrative expenses, financial charges. Now these are the expenses which will go into your profit and loss account except for manufacturing expenses, and sales are given as 12,45,000. Now one small twist is given in the problem here. Focus. At the time of valuing inventory as on 31st March 2019, they are talking about the opening inventory here. Okay, 31st March 2019, a sum of 17,500 was written off on a particular item which was originally purchased for 50,000 and was sold during the year at 45,000. Bearing the transaction, that is leaving this transaction, gross profit earned during the year is 20% on sales. Now they are trying to tell you that out of the sales of what we call this 12,45,000, we have normal sales and abnormal sales. What is this abnormal sales is, one of the item it got damaged, which was originally purchased at 50,000. So in the previous year, what you did is you reduced the 17,500 and you carried it forward at a value of 32,500. And this particular item which was carried forward at 32,500 was sold in the subsequent year at 45,000. Okay, so your gross profit will also have two parts, that is gross profit on normal sales and gross profit on abnormal sales, right? Let's see the valuation thing here. See the thing, CRD problem number 3, statement showing the value of inventory in trade. Okay, value of stock as on 1st April 2019, 1,42,000. They removed, look at the thing, for valuation purpose, in order to apply this normal, whatever we call as 20% on sales, it should be applied only on normal inventory or normal sales. For that purpose, I removed 32,500 out of my inventory. How did we get this 32,500? Purchased at 50,000 minus reduction of 17,000 made last year. So out of this 1,42,500, 32,500 is an abnormal item which got damaged and which was carried forward from previous year to the next year. Current year, last year closing inventory or current year opening inventory. Okay. Now, 1,10,000. What is this 1,10,000? Normal inventory, which is in a good condition. To that, what is that they have added? See the thing. Purchases are added. Opening inventory is taken as 1,10,000. Purchase 7,62,500. Manufacturing expenses. These things will go into your purchase cost. Total comes to 10,22,500. From that, we are reducing what we call as cost of goods sold. How do I arrive at cost of goods sold? Sales as per books is 12,45,000. But this thing comprises of a sale of an abnormal item, 45,000. So normal sales are 12 lakh rupees and gross profit applied on that will be 2,40,000. So what is the cost of goods sold? 9,60,000. So what is the difference? 10,22,500 minus 9,60,000. 62,500 is your closing stock, closing inventory at cost. And what is this profit part? They have asked you to calculate the profit also. Look at the problem here. So find out the profit also. Is it given here to calculate the profit? Yeah, they have asked us to calculate both profit for the year also and also profit for the year. So for this purpose, what is that we are taking? Gross profit on normal sales. See, the statement is very clearly given. Gross profit on normal sales is 2,40,000. Profit on sale of abnormal item. 45,000 is the sale value. This item has been brought forward at 32,500 from the previous year. 12,500 is the profit. This is profit again, but it is not a regular profit which is earned on normal stock. So out and out, profit is profit. Total comes to 2,52,500 minus all the indirect expenses. Okay, selling expenses, administrative expenses, financial charges, they are reduced out of it. Okay, overhead expenses or indirect expenses. We get a total of 1,12,000. Net profit comes to 1,40,500. So this is the second problem in what we call as adjusted selling price method. Let's see the next one. What is this inventory taking? Inventory taking is, just now we have what we call as learned about periodic inventory and perpetual inventory. Under both the systems, at the end of the year, they will count the inventory. But under periodic inventory, they don't have a choice. They have to count the inventory inside out. Every single item has to be counted. Under perpetual inventory, they may go for random sampling. They pick up a few items and they will check whether the inventory is matching with the record or not, because they have a record. The store ledger is there. Okay. So inventory taking is usually, this inventory taking will be done on 26th or 25th or 26th of the month of March. That is 1 week before the closure of books of accounts. Okay. And if because of obvious reasons they could not do that, because of obvious reasons, if they are unable to take the inventory on 25th or 26th and it gets delayed, they'll be doing the inventory valuation maybe on 9th of April or 15th of April, whenever it is possible. Okay. So how do we tackle, how do we handle that particular thing, inventory taking? Look at this problem. A trader prepares his accounts on 31st March every year. Due to some unavoidable reasons, no inventory taking could be possible till 15th April. So they got delayed by 15 days. Okay, because of lack of workers or lack of, obvious reasons, we are not bothered, but there was a delay, and delay was by 15 days. And when they counted it on 15th April, they got the inventory value as how much? 50,000. So I have to work back now, go back and understand what is the value, what was the value of inventory that was there on 31st March. Okay. So for that purpose, what is that I am doing? I have to adjust this 15 days inflow and outflow. Okay, what is it we are adjusting? Inflow of the stock has to be adjusted for this. Now what is this inflow? Purchases received from the supplier, sales returns made by the customers. Outflow, what is outflow? Sales part. Sales is like, whatever cost of sales, whatever you sold during the year, and whatever purchase returns are there, purchase returns made to the supplier. These are the common points, 4 points which are related to inflow and outflow of the business. Okay, now let us understand this with a problem. Okay, so 50,000 is the value of the inventory. What is it I'm writing here as? Value of the stock on 15th April 2020, 50,000. Okay, we'll be preparing a statement format and understanding it. Next one is sales 41,000 including cash sales of 10,000. Sales are sales, it doesn't matter cash sales or what you call as credit sales. Stock movement is common in both of them. 41,000 worth of sales are made, which is an outflow, but these are gross sales. Actually, look at the thing, go down further in the next points, you'll be finding out sales returns are there. So what is it I'll do? I'll net off 41,000 gross sales minus sales returns. 40,000 rupees of sales are made. Okay, will I reduce the sales amount? No, I'll find out the cost of sales. How do I find out the cost of sales here? Look at the thing, goods are sold by the trader at a profit of 20% on sales. I'll be reducing 20% profit on that, derive at the cost of sales. And what is that I'm doing with that? Look at the thing, add cost of goods sold during the period, because this is outflow. Add outflow less inflow. Whatever goods were there on 31st, they went out from 1st April to 15th April, we are adding them back. Okay, so net sales are 40,000, 41,000 minus 1,000, 40,000. Gross profit taken at 20% margin of 48. So cost is 32. We are adding it back to the inventory. Now derive at the inventory as on that particular date. Okay, that is on 31st March. Next, purchases. Okay, these are inflows which were not there on 31st, but they came after 31st. These are to be deducted. What is that they have done with the inflows? Look at the thing, less purchase during the period, 5,034 rupees is deducted. Okay, let's go back to the question. These two statements are over, sales is over. Now focus on this. Point D. On 15 March, goods of the sale value 10,000, sale value 10,000 were sent on sale or return basis to a customer. The period of approval being 4 weeks. So you gave customer 4 weeks time. Obviously this guy has got time at least up to 14th or 15th of April. He returned 40% of the goods on 10th April. Approving the rest, the customer was billed on 16th April. Now the twist is there in the date. What is the problem here? Your inventory taking date, if you go back to your question, your inventory taking date is what? 15th of April. Okay, 15th April. As on 15th of April, it was not a sale. It was stock and it became sale. Confirmation of sale has occurred on 16th of April. So on 15th, I have to treat that balance 60% as stock only. See the thing? Cost of goods sold on approval return basis. Okay. What is the value? Out of this 8,000, 10,000, 40% is returned. 60% balance is there. Okay. 60% balance will be taken as what? Unsold stock of goods sent on approval or return. Is it approval or return basis? Yeah, sent on approval or return basis. Yes. So this is 80% of 6,000 rupees. 80% of 6,000. Why are we taking it as 80%? Original value is 10,000. Out of 10,000, this guy has already returned 4,000, 40%. Balance 6,000 is there. And what is the profit margin that you guys are taking? 25% of cost on 20%. So if you minus 20% out of this, the balance will be 80%, which comes to 4,800. Okay. Next, what is the next thing? One more point is left out. Now look at the thing. The trader has also received goods costing 8,000 in March for sale on consignment basis. So this guy is a consignee now. Okay, he is receiving stock from consignor. 20% of the goods have been sold by 31st March and another 50% by 15th of April. So 70% of the goods has already gone by the time you started counting it. So how much balance is there? Only 30% balance inventory is there with the consignee. You are a consignee. This guy is a consignee. So 30% of this comes to how much? 2,000 400. That is what will be deducted. Why? Because this stock is not our stock. You are a consignee, you are not a consignor. Deducted. Okay. So what is the value that we are getting here? Total comes to 50,000 plus 32 plus 4,800, 86,800 minus purchases and consignment stock lying in our godown. We'll be getting the value of inventories as 79,366 rupees. Okay, so this is when there is a delay in taking inventory. Now let's see a problem where the inventory is taken beforehand, that is before 31st. Now look at this problem number 6 here. Physical verification of stock is taken on 23rd June. So they are closing books of accounts on 30th June and it is taken 1 week before, and they found the stock as 48 lakh rupees. Okay. Now we have to do what? Add inflow less outflow. Right. So let's go to problem number 6 and understand it. Statement of valuation of stock. Value of physical stock as on 23rd June is taken as 48 lakh rupees here. The first one. Okay. Next, out of goods sent on consignment. Now this guy is a consignor. He is sending goods. Goods are there with the consignee. It belongs to you. You have to add this. Now, out of goods sent on consignment, goods cost were 2,40,000 were unsold, which means that this stock is lying with consignee. I have to include that in my stock. So I'll be adding it to my 48 lakh stock here. See the thing? Unsold stock out of goods sent lying with the consignee or on consignment, 2,40,000. Next, purchase of 4 lakhs were made out of which goods worth 1,60,000 were delivered on 5th July. So you are doing the inventory counting on 23rd, books are closed on 30th, but out of 4 lakhs purchases made, you are receiving only 1,60,000. But when are you calling it as purchases? Because the purchase account is already debited. 2,40,000 is received, but balance 1,60,000 is goods in transit, because already you have raised, the supplier has raised the invoice, you have already recorded that in your books of accounts. Okay, so only thing is we'll add this, but we'll be dividing it into 2 parts. See this, purchase during the period from June 23rd to June 30th, 4 lakhs minus 1,60,000, 2,40,000, and goods in transit. Only thing is 4 lakhs is added, but we are showing them as 2 separate items, goods received and goods in transit. Next, sales were 13,60,000, which include goods worth 3,20,000 sent on approval. Okay, half of these goods were returned by before 30th June 2020. So the half of the goods out of this 3,20,000 are already returned. They are already added to the inventory. Okay, now the problem is there with the balance half, that is 1,60,000 out of this 3,20,000. Okay, and what is the sale? This is a sale which is made on approval or return. The stock is there with the retailer which is pending for approval. And what is the accounting treatment that we have learned? We should cancel it from sales and we should add it to inventory. As of this chapter is concerned, we will add it to our inventory. Okay, so 13,60,000 minus this particular thing, and this is at selling value. Okay, approval and the balance part, goods returned. Let's see the profit margin here. Goods were sold at cost plus 25%. However, goods costing 2,40,000 have been sold for 12 lakhs. You are required to determine the value of the stock as on that date. Now, look at this thing. First thing, we have to add goods which are sent on sale or return basis to the customer, which are pending for approval. Value is 1,28,000. Why? 1,60,000, half of 3,20,000. And what is the profit margin? You are selling the things at 25% on cost, which will be 20% on your selling price. This is added. Now let's get to the sales part. Cost of sales during the period. How do I find out the cost of sales? Is out of this 13,60,000 sales, okay, sale on approval or return basis are 1,60,000. We removed it. So the balance sales are 12 lakhs. From that we have to remove what? Gross profit margin. How did we arrive at this gross profit margin? See the calculation here. Actual sales are 13,60,000 minus abnormal sales 1,20,000. What is this abnormal sale? Originally purchased at 2,40,000, sold at 1,20,000. There is a clear loss of 1,20,000. Okay, so abnormal sales are removed, and after that return of goods on approval return basis we removed it. So we got the cost of sales as 10,80,000 is the balance sale on which we have to calculate the percentage. And what is the profit percentage here? Gross profit on this will be 10 lakhs 80,000 into 20 by 100, which comes to 2 lakhs 16,000. This is normal stocks profit minus loss on sale of abnormal item 1,20,000. Net off, we have a gross profit of only 96,000. This figure will be taken here. 12 lakhs sales minus 96,000 gross profit. Okay, 11 lakhs 4,000. Total 55 lakhs 68,000 minus 11 lakhs 4,000. You got the closing stock value as on 30th June, which comes to 44 lakhs 64,000. Confirm the amount. 44 lakhs 64,000. This is the sale value. Yeah, cost of the inventory that was lying, that will be there on 30th June. Okay. So this is all about what we call this inventory valuation. Today we are dealing with chapter number 16, Advanced Concepts in Final Accounts of Sole Proprietor. Already I've done this particular chapter's basic problems in your chapter number 7, Final Accounts of Non-Manufacturing Entities, right? Now look at the advanced problems in that. Only thing is number of adjustments will be more and the intensity, yes, the intensity of what we call this adjustments will be a little complicated. Nothing complicated. They are like, preparation of final accounts. CRT problem number 1. The following are the balances as at 31st March 2020 extracted from the books of Mr. XYZ. Now, he has given you a list here. This is not a trial balance. Okay. Make sure that, yes, find out if there is any suspense in that. Do the totals of debit accounts and credit accounts and make sure that there is no suspense in it. Okay. Right. After that, what is the next thing that you are supposed to do? You are supposed to mark the adjustments. Okay. Whenever the problem is lengthy, something like this, always make sure that the adjustments are marked properly. Okay. Now let's see the first adjustment. What is the first adjustment? Purchases include sales returns of 2,575. Purchase includes sales returns of 2,575 and sales includes purchase returns of 1,725. So we have to reverse it. We have to pass a rectification entry. That is, sales returns are included in purchases and purchase returns are included in sales. We have to reverse this first. In order to do that, you have to pass rectification entries. Now, where do I mark this adjustment? What are the accounts that are affected because of this particular? Today we are dealing with chapter number 16, Advanced Concepts in Final Accounts of Sole Proprietor. Adjustment. Where is purchases? Purchases, I'll be writing it as A1. Okay, because there are two parts of the same adjustment. Let's write that in capital A1. And where is your sales account? Sales account is here A2. Adjustment A has got two effects here. Next, let's go back to our adjustments. Goods withdrawn by Mr. XYZ for own consumption 3,500 included in purchases. They should be taken out. They should not be included in purchases. They should be debited to drawings. So what are the accounts that are affected? Drawings account is affected. Purchases account is again affected. This is B. Okay. So again, we'll go back to our DC drawings here. Where is drawings? Yes, drawings account here. So I'll be writing it as B1. Drawings B1 and purchases B2. Two adjustments are to be made to the same amount of purchases. Now, next one, let's go to the next adjustment. Okay, drawings done. This is done. Wages paid in the month of April for installation of plant and machinery amounting to 450 were included in the wages account. So what is the mistake here? Amount which was supposed to be capitalized, that is the amount which was supposed to be added to the machinery capitalized, is treated as a wages thing. Okay, so which is wrong. What are the accounts that are affected? One is wages account, the other one is plant and machinery account. Let's go to wages account. Where is wages account? Wages is C1. Okay, adjustment C, part 1 of it. And one more account that has to be adjusted is your plant and machinery here in the first account, C2. Why am I writing it as C1 and C2? There are two accounts which are affected because of the same adjustment. Okay. Next, adjustment D. Free samples distributed for publicity costing 825. So what is that he is trying to tell you? You distributed 825 rupees worth of cost of worth goods for publicity purpose. Okay, sales promotion or business promotion. And where is that you have to include them? Obviously, you have to include them in advertisement. Do we have advertisement? Yes. Usually it is given as advertisement in ICA books. That's why we are writing it as advertisement, or technically it is business promotion expense, or what do we call the sales promotion expense. Okay. So here it will be D1. And again, what is the account that is affected? Next time, one more time is D2. Okay. So purchase will be adjusted thrice now. Okay, three times. Three amounts are to be adjusted in purchase account. Next one, look at the next one here. Adjustment D is over. Create a provision for doubtful debts at the rate of 5% and provision for discount on debtors at 2.5%. Okay, make sure in the previous adjustments you have not adjusted any of the debtors here, right? No. So this will affect what accounts? First and foremost thing, look at your trial balance. See, already you have existing bad debts here. Okay, existing bad debts E1. And do we have a provision? Let's go back and see. These are bad debts recovered. They will not be having any impact on this particular adjustment. Provision, check the thing. Do we have an existing provision in the? Yes, we have provision for doubtful. It's already existing. This will be marked as A2. We'll be adjusting them accordingly. Marking them is very important because these problems are lengthy problems. Okay. Next, what else? Where is your trade receivables? What is the next thing? Debtors. Where are your debtors here? Okay, that will be E3. We have to adjust this. We'll be seeing the solution now. Let's mark the adjustments first. And after that, what is the next thing that we are doing? So bad debts are already given. Do we have anything? So just asking you to prepare what we call as provision to be created at this. No adjustment is made to trade receivables in adjustment A to D. Careful with that. Next one, provision for discount on debtors. After doing it, we'll be doing it along with this. Yeah, already existing provision is there to the extent of E3. This will be E4. And do we have discount? Check if you have discount. You have to close discount allowed in this particular account. Do we have discount allowed anywhere? No. Good. Right. So we'll be creating a provision. No discount allowed is there. Sure. No discount allowed being given. We'll be creating a provision after creating provision for this. Next. Depreciation is provided on plant and machinery at 15% per annum and on furniture and fittings 10% per annum. Okay. So depreciation already, plant and machinery has got what we call as C2. Provide depreciation at the end, that is after making all the necessary adjustments to the concerned asset, only then provide depreciation. Why are we discussing this? This because already we are adjusting C2. There is something called as wages paid for installation of plant and machinery. We are not included that. Include that wages and then calculate depreciation. Okay. And what is this adjustment? Adjustment is F. So adjustment marking F1 here. And immediately on furniture F2. Okay, done. What is the next thing? Bank overdraft is secured against hypothecation of stock. Bank overdraft outstanding as on 31st March has been considered as 80% of real value of stock, deducting 20% as margin, and after adjusting the margin value 80%, the same has been allowed to draw as overdraft. Now, what is a twist in this? That is the reason why we have grouped this particular problem in advanced concepts. Okay. Now, they gave you a link between bank overdraft and the closing stock. Do you see anything called as closing stock in your additional information anywhere? No. Okay. So what is that they have done? Let's go back and see and discuss, right? First thing that you need is bank overdraft. What is the amount of bank overdraft that is given in your problem? See this bank overdraft. What is adjustment? Adjustment G, the last adjustment. So adjustment G. Okay. First, we will take care of this adjustment G here. So what is that they are trying to tell you? Bank overdraft is how much? 80% or 80,000 rupees, right? In terms of amount, it is 80,000. And what is the statement that is given? Bank overdraft is secured against hypothecation of stock. This particular individual, he went to bank and he said that give me an overdraft. And banker obviously immediately will say that what is the security that you will provide? He said that I will give stock. inventory, the stock, finished goods, whatever are there in my godown, I will give that as security to you. That is hypothecation. Immediately, obviously, what is stock? Stock is a current asset, it keeps on changing. So he promises them that at any given point of time, this will be the stock that I'll be maintaining in the godown. So please give me what do we call this bank OD. So as against this agreement, what is it banker has done? How did they evaluate the stock is bank overdraft outstanding as on 31st March 2020 has been considered as 80% of real value stock. So whatever stock is there in the godown, out of that bank said that 80% will take it as real value. Whatever inventory value is there in the godown, 80% real value. And did they give you 80% of inventory? No. Look at the thing. Deducting 20% as margin. Okay. And after adjusting the marginal value, 80% of the same has been allowed. Of that 80, 80 is given. So technically, let us understand this calculation here. Okay. You have just seen that. What is the OD part? Bank overdraft is how much? Bank overdraft is 80,000. Okay. Now, if 80,000 rupees is allowed to me as overdraft given to me is 80,000 rupees. Okay. Which is standing at what? 80,000 rupees into 100 by 80 percentage. This thing comes to 1 lakh. This is what the banker is calling it as real value. Real value of inventory. And what is the real value? Real value is after deducting what do we call this? The margin of 20 percentage. Again, I'll multiply it with 100 by 80. This thing comes to how much? 1 lakh 25,000 or 20,000. What is it you're getting? 25,000, right? Or let's see this. Now, how to understand how to do this is this can be done in a different way. If 80,000, that is technically if you are taking it in terms of percentages. Let's try to understand this in terms of percentiles. If 100 is your stock value into 80 by 100 into 80 by 100, this is what you will be getting. That is effectively 64 rupees. Am I being correct? So if you are giving 100 rupees stock to the bank for hypothecation, you'll be getting 64 rupees. And your 64 rupees, whatever you're talking about, is equal to 80,000 here. Am I being understood? Am I being clear? Right. So let's continue with what we call as the regular part of the thing. So closing stock value comes to how much? 1,25,000. See this, they have passed rectification entries here. Rectification, they didn't ask you that in the solution, but you're supposed to show that in the solution. If they ask you, prepare trading account and balance sheet, also show the rectification entries. You have to write rectification entries first and then go ahead with your regular presentation. So first adjustment A, returns inward, sales returns account debit to purchase because sales returns were included in purchases, and sales account debit to returns outward, that is sales included what? Purchase returns. So sales returns included in purchase are reverted and this thing, first entry. And then purchases, that is amounts taken by the proprietor for his personal purpose, adjustment B. It was included in purchase. So we removed it out of purchase and we written to as drawings. Drawings account will be affected. Wages paid for installation of plant. Wages paid for installation of plant, they were not included in the plant. So we have included that. We passed a rectification entry, plant and machinery account debit to wages account. Next one, advertisement expenses account debit to purchase. So out and out, if you observe, almost 4 adjustments are done in the same account, that is purchases account. Okay. Now, let's understand the problem one by one. Purchases, look at the problem here. First, we'll go with what we call as plant and machinery. Okay, I'll go in the order in which it is printed because it is not a trial balance. Plant and machinery is given as 19,550 here. 2 adjustments are to be made, C2 and F1, and which one has to be done? C first. C will be adjusted first, and then we will adjust what we call as F. Okay. See the solution here. Let's go to balance sheet. Plant and machinery, installation charges are added here. 19,550. Out of that, installation charges added. First, you add installation charges 450. Value is raised to 20,000. Less depreciation, 15% comes to a value of 17,000. This is the final value. And what is that we have to adjust here? This wages of 450 are to be taken out of this wages, installation charges are to be taken out of wages account, and we have to charge depreciation to P&L account. Okay, let's go back to that and see. Look at wages account here. Okay, in wages account, 12,165 minus installation charges removed 450. We have a amount of 11,715 balance in wages account. And what is the next thing? Profit and loss account, I'll be writing it as depreciation on plant and machinery, 3,000 rupees. Okay. Next, furniture and fittings, value of what we call as 10,250. No other adjustment is there apart from depreciation. Go back to depreciation adjustment and see 10% has to be adjusted. Solution, balance sheet. Go to your balance sheet here. Furniture is the next asset. Okay. Furniture, what is the story? Furniture 10,250 less depreciation 1,025 rupees, 9,225 rupees is the value. And where do we write it again? Profit and loss account under depreciation here. Look at the thing, furniture and fittings. So total depreciation for the year will be 4,025 rupees. Done with the adjustment. Let's go back to our trial balance here. Bank overdraft. Where will you write bank overdraft? Bank overdraft will go into balance sheet liability side, and this thing has got an adjustment, though it will not be adjusted directly in the account here, right? So bank overdraft, where will you find bank overdraft? Balance sheet liability side. Go to balance sheet liability side, see, and closing stock. The connected adjustment is closing stock adjustment G. Let's see working note number 3. Okay, let's go to working note number 3 and see. A simple calculation. 80,000 into 100 by, what do we call this? 80 into 100 by 80. You're getting 1,25,000 rupees as the value of closing stock. Why? You gave 1,25,000 worth of stock. Banker said that no, sir, only 80% is real value. From our point of view, after removing the margin, safety margin, it is only 80%. Out of that 80%, again they have deducted 20%. Okay, it's more like collateral security, primary security and collateral security, primary margin and collateral margin. Okay, more like that. Next, so where is that we will take this closing inventory? We'll be writing the closing inventory in our, okay, closing inventory comes here, 1,25,000 rupees. Done. Next, bank overdraft adjustment is over. Capital account, always will write that in the inner column because there will be a lot of adjustments which have to be done after closing trading and P&L account. So I'll go to balance sheet. Balance sheet, liability side, the first item, capital, inside inner column, 65,000. Take a different color. So capital 65,000, done. Next, drawings are there, but drawings has got an adjustment. What is adjustment? Drawings given to you are 8,000 and there are purchases adjustment that we have done. Yes, drawings are taken, goods are taken by the proprietor which are included in your purchases. So we have already done that adjustment in the calculations here. So what is the thing? Look at the thing. Drawings are given as 8,000. Capital, whatever thing is there, it will be adjusting it. We will be adjusting it later. Don't worry about that. Okay, when the adjustment comes in. Purchases. Look at the thing. How many are there? 4 amounts are to be adjusted in purchases account. Let's see the purchase account in our trading account here. Okay, purchases 1,60,000 balance given here. What is the first adjustment? A1, that is sales returns are included in that, minus sales returns. Okay, first you adjust this to purchases. We are adjusting what do we call this? Sales returns. Then drawings, goods are taken by proprietor XYZ for personal purpose, that is not adjusted, and goods are distributed for business promotion, free samples. After adjusting all that, you got the amount as 1,53,100. Okay, 153,100 is the amount of purchases, net purchases that will be. And after that, one more thing, we have got purchase returns which are taken out of sales, that will also be adjusted. And we have got purchase returns of 1,51,375 rupees. Done. Next, opening stock. Where will you write opening stock? Obviously, opening stock will be the first item in your trading account. To opening stock, what is the value? 32,500. No adjustments are there for the opening stock. Next, wages account, 12,165. There is an adjustment. We have to take out how much amount out of wages? Yes, installation charges. Look at the thing, 450 already we have discussed. 11,715 rupees is the value of wages. Next, Provision for doubtful debts. Now this is important. We have to do the working. Let's go and see the working notes that is given. Provision for doubtful debts, PBD. Provision for bad debts or provision for doubtful debts. Already we have a what do we call this opening balance given in your trial balance as 3,200. Okay, I think we already checked it once. Where is it? Provision for doubtful debts is given as 3,200. This will go on to the credit side of your provision account. Then to bad debts. Which bad debts are they? Trial balance bad debts. Already we have bad debts in trial balance given here 1,100. No further bad debts or additional bad debts are given in adjustment. If they are given, we would have adjusted it. And what is that we are maintaining on 1,20,000? What is this 1,20,000? Your debtors balance. No other amounts are adjusted. If any other amounts are to be adjusted, first you adjust the amount, then you do the provision calculation at the end. That is provision for bad debts or provision for doubtful debts has to be calculated after making all the adjustments, right? So 1,20,000, and what is the percentage that is given? E adjustment here 5%. So 6,000 rupees has to be maintained as the provision. Okay, that will be carried down and it will be by balance brought down. But how much is required? How much additional provision is required to be transferred from P&L account for the current year is 7,100 on the debit side minus 3,200. 3,900 has to be debited to P&L account because this is the deficit. Yes, already opening balance is there 3,200. Expected loss was 3,200. Bad debts turns out to be only 1,100. Whatever that surplus 2,200, 2,100 is there, that thing is reduced here. So 6,000 minus 2,100, 3,900. This will go into your profit and loss account. Look at the entry made in P&L account, debit side. Provision for bad debts, or technically we should be calling it as provision for doubtful debts. Since it is used as bad debts in ICA middle, we are using it, or else you are supposed to call it as provision for doubtful debts. They are bad debts, there is no need of a provision as such. Next, from the balance, like let's conclude the other provision also. What is the other provision? Go back to working notes. 3,900 is debited to P&L account, and what is the next adjustment that we have to do? Provision for discount on debtors. Okay, what is that we are reducing? To balance carried down, what is it given us? Already they have an opening balance here. How much opening balance is there in the question? Provision for discount on debtors is already they have a credit balance of 1,375, right? That will go on to the credit side here. See the calculation here, credit side. So what is it I'm doing? After providing current year provision on the balance, I have to calculate the provision for discount on trade receivables, which happens to be 1,14,000. On this I'm taking 2.5%, which comes to 2,850. Confirm the balance, 2,850. So what is the additional provision that has to be made now? Debit side 2,850 minus credit side old provision 1,375. The balance in P&L account, balance to be taken to P&L account or to be debited to P&L account is 1,470. Now let's see the what do we call this trade receivables value in balance sheet. Okay, let's first observe the thing in P&L account to get the thing. In P&L account, what is that you're doing? To provision for discount on debtors 1,475. Let's see how this thing is shown in your balance sheet. Debtors, see, gross value was given as 1,20,000 less provision for bad debts or doubtful debts 6,000, 1,14,000. This is the amount on which you have calculated just now, 2,850. The balance 1,11,150. This is the amount that will be. This is how we have adjusted. We are done with what we call this trade receivables adjustment. Debtors is over. Provisions, debtors are closed. Sundry creditors, no adjustments are there. Directly we'll take it to balance sheet, liability side, and show it as sundry creditors here. Look at the thing. Sundry creditors balance appears at 47,500. Next, bad debts already adjusted. This thing is adjusted. Bad debts recovered. This will be shown on the profit and loss account credit side because old previously recorded bad debts, yes, they have to be treated as income and they'll be shown in profit and loss account on the credit side. Let's see the credit side of profit and loss account. You'll find bad debts recovered here. See the thing? Bad debts recovered. It has nothing to do with your trade receivables, bad debts there in trial balance, provision for, yes, this thing is isolatedly recorded as income. Next, creditors is over, bad debts recovery. This side is over. Let's see the other side. Salaries. Obviously, no adjustments are there. Since we have already marked the adjustments, only thing is take them and write them in their respective statements or accounts. Salaries, profit and loss account debit side. Okay, let's see P&L account debit side. Where is it? Take a different color. So salaries account is shown here, 22,550. No change in the amount, no adjustment. Salaries payable. Okay, salaries payable. What is that they have done? Do you see adjustment here? No, it is not given in additional information. It is given inside the trial balance. If you prepare a trial balance with it, it will be there inside it. So it is already adjusted. It is only a liability. Salaries payable will be shown in your balance sheet on the liabilities side. See the thing? Salaries payable here, 2,450. Okay. Amount is already adjusted. It is already included in the salaries here because it is inside the trial balance. Though it is not given in trial balance, if you prepare a trial balance, it will be there inside that. Okay? Already adjusted. Don't adjust it again. Yeah, it's not outstanding. Prepaid rent 300. Asset. It will go into balance sheet on the asset side. Where is it? Prepaid rent is here. Next. Rent. Obviously, profit and loss account debit side. We'll be writing it as rent. So we have, yes, rent is here. Next. What is the next thing? Carriage inwards. Carriage inwards is carriage on purchases. This is an item which will go into trading account. Let's see whether it is there in trading account or not. Carriage inwards. Yes, carriage inwards is here. Done. Next, carriage outwards. This will be treated as a indirect expense. It will go into profit and loss account. Carriage on sales. Carriage outward is nothing but carriage on sales. Where do you have it? Yes, carriage outward is here. 1,350. Sales. We'll be recording this and we have an adjustment. What is the adjustment? By sales, first we remove purchase returns because already purchase returns are included in that. We wrote a rectification entry minus sales returns. 2,11,000 is the net sales that is transferred to the outer column of the trading account. Done. Next, what is the next thing? Advertisement expenses 3,350. Indirect expense will go into profit and loss account, but there is an adjustment. What is that adjustment? Advertisement expenses 3,350. Inner column, add free samples. You have distributed 825 rupees worth of goods for promotion of business, right? Which will be included in advertisement. If you remember, we have already deducted this from purchases. Advertisement expenses. Done. Next one. What is the next one? Printing and stationery 1,250 rupees. Direct entry into profit and loss account. There is no need of any adjustment as such. So profit and loss account. Do we have printing and stationery here? Free samples. Advertisement. Free samples. Like done with the thing. Okay. Cash in hand, cash at bank. Obviously, these items will go into your balance sheet on the asset side. Let's go and write them or see them in the balance sheet there. Cash in hand technically should be the last asset, but they gave it as cash at bank here. Okay. In the order of what we call as permanence, cash in hand should be the last one. Okay. So cash in hand, cash at bank, done. This is as per ICA material. The way it is given in ICA material, we are not changing any order. Okay, done. So I think trial balance is over. No, office expenses 10,160. Profit and loss account debit side. Go to profit and loss account debit side. Office expenses. Yes, office expenses are here. 10,160. And what is the other one? Interest paid on loan. Okay, and you should be checking this. Did they give you the loan amount with percentage? There will be a chance of hidden adjustment in this. What is the loan that you have taken? Where is the loan amount? They don't have a specific loan, or maybe this is the interest on overdraft. Okay. Do you see a loan anywhere here? I don't see a loan anywhere. Okay. Usually if they give you loan, and I told you whenever you see a date or a percentage inside your trial balance, there will be a chance of a hidden adjustment. Okay. We don't have a loan anywhere here. So technically it is the interest on overdraft which is charged by the bank. 3,000. P&L account, debit side, done. Let's cross check the advertisement. What do we call as additional information? Whatever adjustments are there, check whether you have done them, or all the adjustments are to be recorded twice, once in trading account or P&L account and definitely in balance sheet. Check that, and after that you can start doing the totaling of the thing. Okay, right, check it. I think I've covered most of it. Gross profit is left out. Everything that is colored is covered. Yeah, sales is also. Nothing is missed out in trading account. Nothing is missed out in P&L account. That's net profit actually. That you have to tell me the amount. This is also done. Capital will be doing it now based on your calculations here. So only thing is capital bank overdraft is also covered. We've used it for calculating closing stock. Close, done. Yeah. What is the gross profit? Gross profit amount, is it coming to 1,39,535? So transfer it. Do we have a net profit? Yes, net profit, is it coming to 83,800? So capital, to that what is that we have added? Net profit is added. 1,48,800 minus drawings 8,000. Done. And stock taken by the proprietor, that should be actually added to drawings, but they have shown it as a separate item. Stock drawings made by the proprietor. Final balance of capital that will go into the outer column will be 1,37,300. Done. And tell me whether the balance sheet total is tallying. Is it coming to 2,67,250? 2,67,250. That's it. Careful with this adjustment. That is closing stock adjustment. Okay. Closing stock is not specifically given, but it is tagged to bank overdraft. So you have to understand that and do it. Rectification entries first, always first in the presentation. Though they have given it in trading, P&L and rectification entries, better to write the entries. Okay. Right, let's continue with CRT problem number 2 here. From the following particulars extracted from the books of Ganguly, prepare trading and profit and loss account and balance sheet as at 31st March 2020 after making necessary adjustments. Okay, we'll be seeing the adjustments here. First adjustment, value of stock as on 31st March 2020 is given as 3,93,000. This includes goods returned by the customer on 31st March 2020. The value of 15,000. No entries have been passed. That is, goods are returned by the customer. They are added to the value of inventory. Inventory physically, but no entry for sales returns is passed. Two accounts will be affected. Sales returns are to be debited and trade receivables are to be deducted. Okay. So look at the adjustment here, how the adjustment is carried on. Trade receivables will be deducted with an amount of 15,000. Look at the thing. Sundry debtors or trade receivables as per trial balance is 1,20,000. Sales returns deducted 15,000. Balance will be 1,05,000. And we'll be adding this in the sales returns. Already returns are there. Look at the thing here. Returns 15,000 are added. Original returns are 43,000. To that we have added 15,000 rupees worth of returns. Okay, this is the first adjustment that is carried on. Second adjustment, purchase include furniture purchase on 1st January 2020 for 10,000 rupees. Purchase of furniture, capital expenditure has been treated as a revenue item. Furniture account should be added and purchase account should be deducted. Okay, what is that they have done? Go to your solution. You see an adjustment for purchases here. Yes, in purchases, they must have reduced the value of the thing. Look at the thing. Purchases, CRD 2. Returns, purchases, transfers to purchases, 10,000 rupees have been adjusted here. Okay. And where will be it? Will be added in your balance sheet. In balance sheet, they must have added it to furniture. Additions during the year, 10,000 rupees are added here. So this is your next adjustment. Next one, what is the next adjustment? Depreciation should be provided on furniture at 10%. So after adding this 10,000 rupees to furniture, then we have to calculate. So 9,000 original value of the furniture, which was there at the beginning of the year. 10,000 is added, 19,000. On 19,000, I'm calculating depreciation at the rate of 10%, which comes to 1,150. Why is it 1,150? During the year. Okay. And what is the calculation? Look at the calculation, depreciation calculation here. So how did we get this value of 1,150? Yes. 9,000 for full year, and on the additions it is taken only for the half of the year because the date is not given in the problem here. Next, loan from Dena Bank. They gave you an entire account in your adjustment. Careful with it. Nothing is there in this particular adjustment. Opening balance of loan, if you observe, on 1st April 2019, the loan balance was 50,000. And he said that on 31st March 2020, that is on the last day of the financial year, you have taken a top up on the loan, or additional loan has been taken to the extent of 50,000 rupees. So technically only 50,000 was due during the entire year, and this 50,000 is not the second 50,000 which is taken, the extended amount is not subject to something called as interest. Okay, now we'll get back to this once we see the thing, because what is the amount of interest on loan? Yeah, loan from Dena Bank is at 12%. This 1 lakh, don't calculate it on 1 lakh because we have to calculate it only on 50,000 rupees. Okay. And 50,000, 12%. What will be the amount? 6,000 rupees. But interest paid, look at the story here. Interest paid is 4,500. Does it mean that 1,500 is outstanding? No, there is one more adjustment. Look at this adjustment F here. Interest paid includes 3,000 paid to Dena Bank. Okay, which means that out of 6,000, only 3,000 is paid. And one more problem here is they have given you 4,500, which means that 1,500 is paid to some other party. Out of this 4,500, 3,000 is paid to Dena Bank, which means that another 3,000 rupees is outstanding towards Dena Bank thing. Look at the thing in balance sheet. They have added interest accrued on loan from Dena Bank. The amount of what we call as 3,000 rupees is shown as outstanding interest accrued on loan from Dena Bank, and they must have added interest trial balance amount of 4,500 plus 3,000 outstanding. Outer column they have shown it as 7,500. Okay. Next, this is the story of Dena Bank loan account. Sundry creditors include 20,000 due from Robert, and sundry creditors include 10,000 due to him. So this guy, Robert, is both a customer as well as supplier to us. We have to receive 20,000 from him. We have to pay 10,000. So these are cross transactions. Same party happens to be a customer as well as supplier. So out of these two amounts, whichever amount is low, 10,000 is the lower amount. 10,000, yes, shall be deducted from sundry debtors as well as sundry creditors, right? So let's see the adjustment. Did they deduct it out of what we call as sundry debtors and sundry creditors? Sundry creditors, let's see the adjustment here. Sundry debtors is adjusted 1,05,000 minus, just now we have reduced the sales returns part. 1,05,000 minus 10,000, 95,000 is the amount, and they must have done a similar kind of deduction even out of your sundry creditors. Where is sundry creditors? See, sundry creditors 74,000 amount minus 10,000 rupees, 64,000 balance is taken in your balance sheet. Let's see the next adjustment. Just now we have closed these cross transactions. We have to reduce the smaller or the lower amount. 20,000 is bigger, 10,000. We minus that. That is net of, we have to receive 10,000 rupees from Robert. Okay. Next up, interest received represents 1,000 from sundry debtors and the balance on interest and investments. Balance on investments and deposits. That is, you have an amount of, what is the amount? Let's check the amount of interest that is received in the problem. Interest received is given as what? Interest received is given as, okay, 7,250. And what is that they are telling you? Out of this 7,250, 1,000 is received from sundry debtors. Why? The customer has delayed the payment, and for that you have already seen that in account current chapter. Okay? You received 1,000. The balance 6,250 is towards what? The other investments, that is investments and deposits. What is the amount that is due? What is the interest amount? Let's see the interest amount. Deposits are subject to interest of 10% on 1,50,000. That comes to 15,000 rupees. Correct? Because these things are made on 1st April 2019. And investments are made at 5% on 1st April 2000. So that 25%, 5% on 25,000 comes to 1,250. So if total 16,250 was supposed to be received, you have received only 6,250, which means that accrued interest that is supposed to be received is 10,000. Okay. Let's check the solution interest part. Look at the thing. Just now we have calculated interest accrued on investments, okay, is given as what? 10,000 rupees. 10,000 is the value of the interest that is accrued, which is not received yet. Done. Let's see the next adjustment. Provide for interest to Dena Bank and interest receivable on investments. Just now we have completed this. They again rated it the same thing. What we have done. Make a provision for outflows at 5% of the balance under sundry debtors. Okay. No such provision is required to be made on deposit. So, what is the provision? Let's go back to the solution and see the working notes here. Already we have concluded the debtors balance is what? Debtors balance is concluded as 95,000, and on that 95,000 we have calculated the provision as 4,750. This will be deducted. Okay, do we have a old provision in the problem? Let's check the thing here. Do you have a old provision? No. Provision for doubtful debts, is it there? Right. So what is that we will do? See the balance sheet adjustment that is done to the trade receivables or sundry debtors. Sundry debtors provision 4,750 is deducted. 90,250 rupees is shown here. Okay, these are the adjustments. I think most of the adjustments are covered already. Done. Okay. Rest of the thing is just balance it. Balance your trading account, profit and loss account, transfer the net profit to it. Okay. Now, let's get on with another problem. CRD problem number 3. What is the CRD problem 3? This is an unstructured problem. They didn't give you a traditional problem where you will have a list of accounts given to you, a trial balance is given, and a list of adjustments. This is not a typical problem. This is not a regular problem. This is a typical problem where it is unstructured. No list is given. You should be very careful with this kind of problems. Okay, there will be a scope of, they gave you a list here. This is not the entire thing. Okay, look at the size. The problem is very simple problem, but since you guys are habituated of traditional trial balance and adjustment model, this will be a little odd. Okay, and I think this is a previous examination question. Karuna decided to start a business of fashion garments under the name of Messrs Designer Wear on 1st April 2020. He had savings of about 10 lakhs. So this is an information that they are giving you about the savings that this lady has. Okay, but is she bringing that entire 10 lakhs into business? No. Look at the thing here. She invested 3 lakhs out of her savings. That is, out of this 10 lakhs, she is bringing in only 3 lakhs out of her savings and borrowed equal amount from bank. So she is starting business with 3 lakh rupees capital from her personal amounts, and 3 lakh rupees is brought in as loan. Total amount invested is 6 lakhs. She purchased a commercial space with 5 lakhs and further spent 1 lakh on what we call this renovation of it. So entire amount of capital, whatever brought in by Karuna and loan taken from bank, this amount went for what? Building. She purchased a commercial property by spending 5 lakhs and 1 lakh rupees is spent. So what is the balance now? Nothing is there. Capital 3 lakhs is gone and loan amount 3 lakhs is also gone for this particular commercial space and renovating it. Okay. So again, she has to bring in what we call this additional thing. Let's see the solution here. So CRD problem number 3, a small problem. Look at the capital. 5 lakhs is the capital. Okay, why is it 5 lakhs? Because now she'll be introducing an amount of 2 lakhs as additional capital. Very soon we'll be seeing it. Now look at the status quo of this loan. Just now we have seen that she has taken a loan of 3 lakhs, right? She repaid loan in the form of EMI, equated monthly installments. Principal amount was fixed at 15,000 plus 9,000 interest was paid on 30th June, 30th September, 31st December and 31st of March. So the principal out of 3 lakhs, she has already repaid bank an amount of what we call as 60,000 principal is returned, repaid. And what is the amount of interest that is paid? What is the total coming to? Add these amounts. 33,300 is it? Let's check the amount. So interest that is paid is how much? Where is the interest part? Interest 33,300 rupees. And principal repaid already. So look at the loan here. Bank loan balance is 2 lakhs 40. How is it 2 lakhs 40? Out of 3 lakhs loan taken, 60,000 is returned. 60,000 is paid off. Okay. Balance is 2 lakhs 40,000 rupees shown here. Okay. Bank loan part is over. Then we have done what we called as the interest part. Okay. Next. Let's get back to the problem. So this is, we'll be adjusting 60,000 in interest, 60,000 in loan amount, and 33,300 rupees will be debited to profit and loss account. Let's see the later part. In view of the further capital requirement, because she is out of capital, everything is spent for commercial space and renovation. She transferred 2 lakhs from her savings bank account to her business account. So she has brought in additional capital of 2. That is the reason why your capital is appearing at 5 lakhs. She paid security deposit of 7,000 for telephone. This will appear as an asset in the balance sheet. Any amount that is paid as security deposit for telephone will appear as a asset. This is a refundable deposit. Tomorrow, when she surrenders the telephone, she will be getting this money back from the telecom department. Furniture of 10,000 was purchased. She bought an asset, furniture. This will be shown in balance sheet. All payments were made by checks and all receipts in cash were deposited in bank. So she is not dealing anything in cash. Anything that comes in cash will go into bank. And all the payments are made by check only. So bank account will be very important. All the amounts that are paid and received are routed through bank only. At the end of the year, her business showed the following. Total sales 20 lakh rupees. This will be going into your trading account, credit side. 20 lakh rupees is shown as, oh, this thing has got only 4 accounts here, right? Next thing, electricity expenses paid. This will go into your profit and loss account. Electricity expenses paid is 40. And one more thing is we have a payable amount here. Okay, paid and payable together 60,000, and this payable will be shown as a liability in your balance sheet again. Okay, is it shown as a liability? Outstanding electricity payable or electricity payable expenses to the extent of 20,000 rupees. Okay, next, carriage outwards will go into profit and loss account. Entertainment expenses, miscellaneous expenses, total purchases, purchase value will go into your trading account. Is it going into trading account? Let's check that. Yeah, trading account purchase 17 lakh rupees. Telephone charges 50,000, profit and loss account. Traveling expenses, maintenance expenses, electricity payable, that's, we have seen it just now. And apart from this, in addition to this, she withdrew 5,000 by check each month for her personal expenses. A total of 5,000 into 12, 60,000 rupees will be deducted from your capital because she has taken these amounts. Look at the drawings part here, drawing shown here, 60,000 rupees. Okay. Closing stock in hand as on 31st March 2020 was 5,50,000. This information will go into our trading account again. Where is the trading account? Here, closing stock 5,50,000. Okay, unstructured problem. Prepare trading account, profit and loss account, balance sheet. But what plays the important role in this problem is the bank account. That is the key. Okay, the rest of the things are very simple. Look at the bank account here. See the thing. Capital is given 5 lakhs, bank loan 60,000. Just now we have discussed repaid bank part. Initially, she has brought in how much of capital? 3 lakhs was brought in as capital. 3 lakhs is taken as loan. Further capital brought in was this, and sales was 20 lakhs. These are the receipts. Look at the payments here. Bank loan repaid 60,000. Just now we have seen 15,000 was paid on every quarter ending. Building was purchased by paying 6 lakhs. That is 5 lakhs towards property, commercial space and renovation. Interest part 33,300. Just now we have calculated the thing. Security deposit 7,000 for telephone. This is shown as an asset in balance sheet, right? This is a refundable deposit. Furniture was purchased by paying 10,000. Electricity paid is 40. Outstanding 20. That will not appear here. Carriage outwards. These are list of expenses which are given in our problem here. And all these things, entertainment expenses, miscellaneous expenses, purchases 17 lakhs was paid. Telephone charges 50,000, traveling expenses 45,000, maintenance expenses 25,000. Drawings, just now we have calculated 60. Bank plays a very important role. Bank, everything is routed through bank. She is not paying anything in cash. She is not receiving anything in cash. Even if she is receiving cash, she is depositing that into bank. Sales, entire amount is there in bank. So what is the bank balance that we have got? You should get a bank balance of how much? 89,700 is the bank balance here. So that is your CRD problem number 3. Okay, unstructured problem. Careful. If you miss out even a single amount, the entire story will be changing, right? Now let's see the next problem, general problems. Okay. These are adjustments, and there is a chance that you will get these problems for say 3 marks or 4 marks or something. Very simple, but adjustments. which are to be handled very carefully. Sen Gupta employed a team of what do we call this 8 workers. Already he has got a workshop where 8 workers are working, and this was the story till 31st December. At the start of financial year 2019 and 20, the company raised salaries by 10%. So from 30,000 they made the salaries of the 8 workers to 33,000 in the current year. On 1st October 2019, company has hired what do we call as 2 trainees. And what is the salary compensation that was fixed? 21,000 was the compensation that was fixed to them. And what is the story? Salary is for the, okay, they are paying. And what is the twist here? Look at the thing. The workforce was paid salaries on the first working day of every month, 1 month in a year. That is, salaries for the month of April will be paid on the first working day of May. May salary on first working day of June. That is the subsequent month on the first working day. And what is that they have asked us to calculate? Let's see the calculation part here. Amount of salaries which would be charged to profit and loss account for the year ended 31st March 2020. Why? 11 months paid, 1 month outstanding will be there. Okay. Amount actually paid as salaries. That is, he is talking about how much is actually paid. Last year, 1 month outstanding plus current year 11 months will be paid. Careful with the calculation. We'll see the calculations. Outstanding salaries, 1 month salary will be outstanding. Okay. How did they do the calculation here? Let's see the calculation part. Problem number 5. Look at the first calculation. Salaries of 8 employees for full year 33,000, 31 lakh 68,000. Salaries of 2 trainees for 6 months, because they are appointed in on which date? October 1st, October to March. Okay, so that is 34 lakhs 20,000 will be the amount that will be debited to profit and loss account, because this is a salary related to the current year. Now look at the second one. What is the difference in the second one? Calculation of salaries actually paid. First and foremost thing is, we will have outstanding salaries for the month of March, which are paid in April. So 2,40,000 last year, 30,000 per employee into 8 workers. Am I being correct? Yeah, 30,000 was last year March salaries, and how many workers were there? 8. To that, what is that we are adding? Current year, but how many months? Only 11 months. Okay, 11 months salary at the rate of 33,000, and 5 months salaries at the rate of how much? 21,000. So who are these? The trainees who are paid salaries here. Okay, next, what is the next calculation that he is asking us to do? He is asking us to do what we call as the outstanding part. How much will be outstanding? Current year, 1 month will be outstanding. How do we arrive at that? 8 employees, 33,000 for the last month, that is March month salaries, 2,64,000, 2 trainees, 42,000, 3,06,000. Done. Okay. So this could be a problem which can come for a what we call as a 3 marks or 4 marks thing. And look at the next one. Again, a similar kind of adjustment based problem. Kotriwala was engaged in the business of selling magazines. He is a magazine seller. Several of his customers would pay money in advance for subscription for his magazines. Okay, people are paying what we call as money well in advance to buy the magazines, which will be released in future. Information related to the year ended 31st March 2020 has been given below. On 1st April 2019, we had a balance of 2 lakhs advance from customers, of which 1,50,000 was related to the current year 1920. So on the first day, April 1st 2019, he has a balance advance of 2 lakhs. And what is that they are saying? Out of this, 1,50,000 is related to the current year. So this will be transferred to current year sales related to the current year, while the remaining pertaining to the year 2020-20. This is like advance for the next year. During the year 2019-20, he made cash sales of 5 lakhs. So sales made during the year are 5, and advances transferable to the current year out of 2 lakhs is 1,50,000. What is the value? Total income 6,50,000. Simple. Total money received during the year, if the closing balance in advance is what? 1,70,000. So if out of what do we call this? If advance is 2 lakhs, we have already transferred 1,50,000, right? Balance here is 50, and they are saying that at the end of the year the balance was 170. It means that the excess 120 is received. See the working notes here. Calculation of income. Okay, what is the value? 5 lakhs is the cash sale part, correct? 5 lakhs is the cash sale part, and what is the story here? Advance from 2 lakhs we have transferred 1,50,000. That thing brings up to 6,50,000. This is the revenue part. And what is the status quo of advance? Look at the advance here. Advance will show which balance? Advances from customers will show a credit balance. It is a liability. Buy balance 2 lakhs is the value. Clear? And how much did we transfer to sales? Just now we did the calculation here. 5 lakhs cash sales, 1,50,000 is transferred from advance. This is pertaining to the current year. I have transferred 1,50,000. Technically, I should have a balance of only 50, but I'm having a closing balance of 1,70,000. That is the information which was given there. So by bank, how much is received? 1,20,000. The total amount that is received during the year. 5 lakhs cash sales, 1,20,000. Advance part, total money received is 6,20,000. Okay, so this is it. This was your advanced concepts thing. Number 17, company accounts 1. So what is company accounts 1? We'll be dealing with shares issued by company. Okay, look at this. Issue, forfeiture and reissue of shares. So what exactly is a share? Share is a security issued by the company. The capital of the company, where it is divided into multiple parts, we call it a share. Okay, and in order to become a member, in order to take a part membership of a company, you have to buy what we call as a share. Okay, so look at the thing. Meaning of company. What exactly is company? When a group of people come together for a purpose, that is business, and to earn profit, we call it as a company. And company registered under Companies Act or any of the previous acts, right? So in order to do business, this company group of people, they collect the what we collectively contribute to the capital of the company, and that will be called as shares. Okay, and see the thing here. Capital funding process of different types of business firms can be summarized as follows. Sole proprietor, he will have only his own capital. In case of partnership, we'll have partners. In case of company, shareholders. People who are holding shares are called as shareholders. When the huge amount of capital of the company is divided into parts, we call it as share capital. Individually, each part is called as share. Okay. Now, types or categories of what we call as share capital. The share capital is categorized into different things. Authorized capital. What is this authorized capital? The maximum amount of capital that can be collected by the company, and which is mentioned in the memorandum of memorandum of association of a company. There will be a clause called as capital clause. Okay, in that thing. Issued capital. So out of authorized capital, the company may not need the entire amount of capital, authorized capital. They may need only a part of that. Okay. For example, a company registers itself with an authorized capital of 500 crores, but they don't need that 500 crores as of now, or they don't need that 500 crores, but they need only say 100 crores or say 200 crore rupees as of now. They will issue only that. The amount that is issued for public subscription is called as issued capital. Now, out of that, public, okay, and whatever is unissued, that is, in our example, 500 crores if it is the authorized capital of the company, 200 crores if it is issued, the balance 300 crores will be called as unissued capital. Subscribed capital. What is subscribed capital? The capital out of this 200 crores, whatever the company has issued, public will subscribe, and it will have three elements. It can be oversubscribed, or it can be par subscribed, or it can be undersubscribed. That is subscription, whatever public are ready to pay. And out of this, these three are counted on the full value. This calculated on full value. But out of 200 crores, companies usually, they divide the face value of the share. What is this? The denomination of a share will be divided into parts. Okay? And what are these parts are called as? They are application money, allotment money, and subsequent calls. There can be one call or two calls. There are no limits or no restrictions on the number of calls. So how much is called up on application? Imagine like face value of the share of the company is 10 rupees. Company is taking as of now 2 rupees or 3 rupees on application. That is called up. Okay. And how much is paid up out of this? Okay. That is paid up capital is equal to called up capital minus calls in arrears. Okay. Next thing. Reserve capital. What is this reserve capital? Reserve capital is that amount of capital which is set aside by the company, and this capital will be called up by the company only in the event of liquidation of the company. Okay, it is not capital reserve. Capital reserve is an accumulation of capital profits. This is reserve capital. Okay, now example, they gave an example here. Look at the thing here. Authorized capital is 10 lakh shares of 10 rupees each. Company is planning to collect 1 crore. This is the maximum capital that they are planning as per their project. But as of now, they don't need the entire 1 crore. They need only 90. Out of that, subscription has received. They have subscribed. Public have subscribed for 85 lakhs, and they have taken what we called as 8 each. And what is the thing? Paid up capital is 25,000 shares on which 2 rupees was not received. That is what is removed. Calls in arrears and all that. We'll be seeing them now. Okay, that is the categorization of capital. Now we are looking at types of shares. What are types of shares? Equity shares and preference shares. Okay. Equity shares are ordinary shares. These shareholders, they enjoy the ultimate control over the management of the company. Preference shares, as the name suggests, preference over equity. Okay, these shareholders, they will not have any sort of voting rights or anything like that, and since they are foregoing their voting rights, they'll be getting a fixed amount of dividend. That will not be there when it comes to equity shareholders. They have to take the profit in the form of dividend only if the profits are there, or else they don't have a option there. So preference over equity, why are they called as preference shares? Preference in the whatever we call as dividend at the time of payment dividend, they will get the dividend first. And in the event of liquidation of the company, the repayment of capital will be first made to preference shareholders. That is technically equity shareholders. They stand after what are we called as preference shares. Types of preference shares, we have cumulative, non-cumulative. There are different types of preference shares here. Equity shares are basically two types: equity shares as such and equity shares with differential rights as to voting and dividend. This concept is not there in foundation. Just have an idea: equity shares, ordinary shares, and equity shares with differential rights as to voting and dividend. They will be equity shares, but they will have a different right when it comes to taking dividend. They will compromise their voting rights. They compromise their voting rights, or it is like, ordinary shareholder will have 1 vote per share, but equity shareholder with differential rights as to voting and dividend, he will be getting higher dividend, but he will get 1 vote for 10 shares held or 1 vote for 20 shares held. Just in order to retain the control over the company, right? Issue of shares for cash. Okay, usually companies, they issue shares for cash. There is one more option: issue of shares for consideration other than cash, right? So what is this issue of shares for cash? Okay, companies usually they take the entire amount in lump sum, or they have another option. They can take that in installments, multiple installments. Just now we have discussed. The first installment is always called as application money. Okay, and the second one is called as allotment money. And all the subsequent installments, there is no restriction on the number of installments as such. Okay, they can take any number of installments and there will be numbered calls. The last one will be called as with the number and final call. Okay, first call, second call, third and final call. Okay, it depends on the company's requirement. Now, minimum application money, there is a section and a SEBI guideline regarding how much application money should be taken out of issue price. As per section 39, the Companies Act 2013, 5% of the face value shall be taken as what we called as application money. Let us take what we called as 10 rupees as the face value of the share. Face value is, right, what should be the amount here? 50 paisa. The company must take at least 50 paisa as application money. Okay, and there is a SEBI guideline which says that 25% of the issue price. Let us go with the assumption that face value and issue price are one and the same. Company is issuing shares at par. So as per SEBI guidelines, it should be 2 rupees 50 paisa. So if the company complies with SEBI guidelines, automatically they are complying with the section 39 provisions of Companies Act 2000, right? So next, allotment. What is this allotment? This is an exercise which will be confirming the application made by the applicant. Initially, when you pay application money, you are an applicant. Subsequently, on receiving the allotment letter, you become an allottee. And on payment of allotment money, the shares will be transferred to your demat account. And what is this minimum subscription clause? As per SEBI guidelines, okay, it is mandatory that they have to receive at least 90% of the subscription for the issue. If it is not receiving that 90%, the company is bound to refund the entire money. Now, what is the scenario? Imagine like all of you have applied for what we call the shares. Okay, if there is a full allotment, you will be receiving a letter of allotment. If the company has rejected all your application, entire 100 applied, 100 rejected, then they'll be sending you a letter of regret. Okay, all diplomatic sorries and all that in that. And if it is partly accepted and partly rejected, you'll be receiving a letter of allotment and what we call as a refund order accompanying that. Calls are like, these are the things which are made after allotment, and every call must have a clear what we call as 1 month gap between them, and the amount of each call must not exceed 25% of the nominal value of the share. The call should not be in excess of 25%. 10 rupees face value, 10 rupees issue price, but this is not issue price. We are going with the nominal value, 2 rupees 50 paisa. It should not be more than 2 rupees 50 paisa. Okay, and look at the thing here for raising funds through this. Let's go to a problem and see, try to understand. And what is this? Partial allotment and pro-rata allotment, just now we have discussed. Okay, subscriptions can be of three types. Full subscription, company is offering 10 lakh shares, public have applied for 10 lakh shares, hypothetical situation. Okay, but under subscription, what is under subscription? This is a sensitive issue. Why? Company has offered 10 lakh shares, 9 lakh shares must be applied by the public. If you have received applications for 8,99,999, you have not made it to the minimum subscription, you're bound to refund the money. Okay, and what is this over subscription? The company has that kind of goodwill in the market, they have got over subscription. If it is the over subscription case, what is that? The company has two options: partial allotment and pro rata allotment. What is this partial allotment? First come, first serve. First come, first serve. 10 lakh shares were on the offer. 12 lakh applications have come. The first 10 lakh applicants, whoever are there, share applicants are there, they'll be getting the allotment. The last 2 lakh applicants, they'll be getting a letter of regret, and they'll be getting a refund out of that. So first come, first serve. Now, what is the second one? Pro rata allotment. What is pro rata allotment? Proportionate. Okay, everyone will get a share, but not the full amount of application that you have done. Okay, so imagine like, let's go with the same application. 6 shares applied, 10 lakhs were on the offer, 12 lakhs were applied. So for every 6 applied, 5 will be allotted to you. Okay, so that's what pro rata allotment is. We'll try to see this, what do we call this thing with the thing? And what is the thing? Share can be issued at par. That is the face value and the issue price are one and the same. But imagine like face value of the share is taken as 10 rupees. 10 rupees share is issued at 10 rupees. That is what we call as par. And if the share of 10 rupees is issued at 14 rupees, whatever excess over and above nominal value or face value you are collecting will be premium, called as securities premium. And it has got its own what we call as restrictions in the Companies Act. We'll be seeing that when we go to section 52 of the Companies Act. Okay, next, and shares cannot be issued at discount. No, not to public, only for sweat equity to employees and directors of the company. We'll see that. We'll come back. Issue of shares at par. So when the face value of the share and the issue price of the share are one and the same, 10 rupees face value issued at 10 rupees, we say that the share has been issued at par. Okay, now two options are there. Just now we have discussed, full subscription has come and company can take the entire amount of what we call as this at one shot. Bank account debit, what are the entries that we are writing? If issue price is received in lump sum, entire 10 rupees at one shot, that is on application itself, then we'll be writing the entry as bank account debit to share application and allotment together. And this application and allotment account will be closed in share capital account. This is the usual scenario, but company has got another option. What is the option? They can take the same amount in installments. Let's see the installments. If issue price is received in installments, what is the first installment called as? Application money. Bank account debit to share application. This is the amount. Okay, and immediately will be what we call as closing this application. On the date of allotment, will be closing this application money transfer. First one, basically this is a receipt entry and this is a transfer entry. We are transferring the amounts from installment accounts to capital account. Okay, So share application account debit to share capital. So application, first amount comes in and then it will be transferred to, right, subsequent installments. What are the subsequent installments called as? Then we will write a due entry. First we'll write a due entry. Why? Because we already know whether there is an oversubscription or under subscription or par subscription. Based on that, how much amount is due on allotment, we'll pass an entry for that. And what is the next entry? Look at the thing. Share allotment account debit, okay, with the excess application money, whatever is there. And what is share allotment account? With the amount due. And to share capital is the thing. Instead of the above two entries, they have given you a compound entry. Not to write a compound entry, better write a individual entry. And when you receive, what do we call this? The amount on allotment, will be passing a receipt entry, bank account debit to share allotment account. And for calls, first we'll pass a due entry and then transfer entry. First transfer entry, then yes, receipt entry. Now let's see that with a basic problem. See that first we will see a basic problem and we will see what are the enhancements that are done in the later problems. A company invites applications for 10,000 equity shares of 50 rupees each, payable on application. So number of shares are 10,000. What is the face value? Is 50. Okay. Payable as 15 on application and 20 on allotment, and balance 15 on first and final call. Applications are received for 10,000. So issued is 10,000, subscribed is 10,000. And all the applicants are allotted the number of shares they applied for. Installment money was duly received by the company. Show the journal entries in the books of the company. Okay. Now let's see the journal entries. What is the company? Company's name is not given. In the books of a company, journal entries, CRD1. So how much money is received on application? 10,000 into 50. 15 is it? 1,50,000. 1,50,000 bank account debit to equity share application account. Being application money on allotted shares, 10,000 into 15 received. Okay. Next, equity share application account debit to equity share capital. We have to transfer it to equity share capital. And mind you, all the time make sure that you have this particular thing as a suffix in all the transfer entries. Whenever you are debiting or crediting share capital account, make sure that you write it as per director resolution or as per board resolution. Either ways it will be the same. Okay, in all the transfer entries. Next one, equity share allotment. Second installment is called as allotment. Equity share allotment account debit to equity share capital. So we are expecting 2 lakhs. Okay, that is the next one. And what is that you have received? Bank account debit to equity share allotment. No problems as such, called as calls in arrears and all that. And look at the thing, equity share first and final call account debit to equity share capital, 1,50,000 again, bank account. And look at the thing, director's resolution. Even in this entry, they wrote it very clearly as per board resolution, number dash, rated dash, and bank account debit to equity share first and final call. Okay, this is a receipt entry. Only for transfer entries, you make sure that you are writing it. Okay, this was a basic problem, very simple problem, no complications at all. Let's see the second problem, problem number 2. What is that is there in problem number 2? Okay, this should be a problem where company is collecting premium. Company is collecting premium. The company is collecting premium. Let's see the problem there. CRD problem number 2. On 1st April 2020, A Limited issued 43,000 shares of 100 rupees each at a premium of 20. So 20 rupees premium is collected. Payable as follows: 20 on application, 50 on allotment including premium. If the problem is silent, even if they don't include that including premium, by default we assume that the premium is collected in allotment only. Okay, by default. Next one, 25 rupees on 1st October 2020 and 25 on 1st February. Now what is the important element that you have to keep in mind in this problem is dates. Dates are given and you should be, yes, writing the dates correctly. Observe the dates also. Dates are very important because they gave you dates in this particular problem for all the installments. Next, what happened? So 43,000 are on the offer. By 20th May, 40,000 shares were applied for and all applications were accepted. Allotment was made on 1st June. So the company, they were ready to offer 43, but public have applied for 40. Are they within that 90% minimum subscription? Yes. 4,300 shares should be less, but we have only 3,000 less here. The company can go ahead with the allotment. Nothing is wrong. They made the minimum subscription. Now, what is the thing? All sums due on allotment were received on 15th July. Those on first call were received on 20th. And journalize the transactions when the books are closed on 31st March. And there is a SEBI guideline that the company must receive entire subscription money within 12 months from the date of allotment. Okay. So how much on application? How much did they receive on application? 43,000 into 20. Is it 43? No, 40,000 into 20. Bank account debit to share application 8 lakh rupees. Being application money on 40,000 shares at 20 per share received. Okay. Next entry. This is on May 20th. Don't write the entry on April 1st. It is the date on which the company has announced the issue. But by 20th May, they received the application money. So the date for the first entry will be May 20. And allotment, when did they make the allotment? Application allotment was made on June 1st. That is the date on which we transfer the application money into share cap. Because the company should fulfill a lot of what we call this guidelines, terms and conditions put by SEBI and a lot of other government organizations. So having fulfilled that on June 1st, when they are making the allotment, on that day we transfer the application money to share capital account. That is why it is written on June 1st. And the day you transfer application money, we write the due entry for allotment. So what is the due entry here? Look at the compound entry. What is the new thing that is added here? Securities premium. What is the amount that is due? Share allotment account 40,000 shares into 50. Breakup of that 50 is 30 towards capital and 20 towards securities premium. Right? Being share allotment made due at 50 per share, director's resolution number dated. Okay, for all the transfer entries, just now I told you, as per board resolution number or director's resolution number. Next, how much did you receive on what we call as no issues as such, no call scenarios and all that? Simple problem. Bank account debit to share allotment 20 lakh rupees is received. Next, what is the date? They gave you very clearly. The date is all sums due on allotment were received on 15th of July. So allotment received entry will be on 15th. Next, first call. All sums due on allotment were received and first call was made immediately on the same day. On October 1st, they made the first call, right? Received on the thing. October 1st, share first call account debit to share capital 10 lakh rupees, 40,000 shares into 25. Done. Next, bank account debit to share first call. This first call amount is received on October 20th. Next thing, next year, what is the story? And those on first call were received 20th October. Journalize the following. February 1st, did they make it? Yes, the dates are given in the question. Let's go back to the question and see here. October 1st it is made and the final call is made on 1st February. 1st February due entry, transfer entry, share second and final call account debit 10 lakh rupees and received on 31st March. Technically, they have time of 12 months from the date of allotment. What is the date of allotment in our problem? May 20th. Okay, but they have received the entire subscription by March 31st. The second and final installment, final call has been received on 31st. Okay, so this is your second problem. What is the unique thing that you have seen in this? Dates are very important. Okay, don't write the wrong dates. Next thing, let's see the next one. Okay, issue of shares at premium. And one more thing, whatever this securities premium is there, it can be used only for 5 purposes. Okay, this note is important, and all these 5 purposes for which the securities premium should be used by the company given as per section 52 or potential true or false. Any one of them can be asked as a true or false. Okay, true or false question out of first question. Yes, 1A. Careful with that. Next, issue of shares at discount. Can a company issue shares at discount? No, company cannot issue shares at discount to general public. They can issue shares at discount, that too only as sweat equity shares to their employees and directors. Okay. General public are not to be given shares. Now, what is this calls in arrears? When any amount due on installments, that is starting from allotment to calls, if it is not received, we will term it as calls in arrears. Okay, already we have seen this thing. And calls in arrears, that is if there is a delay in the payment made by the allottee or shareholder, they have to make the payment along with interest of 10% for the delayed period. That is the due date of the call to the date of actual receipt from the company point of view and the payment. What is the rate of interest that they have to serve it with? Maximum rate of 10% as per Table F of the Companies Act 2013. calls in advance. What is this calls in advance? Sometimes some shareholders, they will make the payment of next call. That is, along with allotment, this guy pays the balance. That will amount to what we call as calls in advance. Okay. If the company retains that amount, they have to pay interest on that. Okay. And what is the story? They have to pay the interest at the maximum rate of 12% per annum. This is again given in your table F. Okay. Next. Let's see, I think the next problem will be highlighting something like yes. CRD problem number 3. This problem, the new thing that you'll be seeing is the entire concept of calls in arrears and calls in advance. Both the concepts are given clearly in this problem. So if you concentrate on this, you will understand the calls in arrears, calls in advance concept, interest on calls in arrears and interest on calls in advance. Let's focus on the problem here. Rashmi Limited issued at part 1 lakh equity shares of 10 rupees each, payable 2 rupees 50 paisa on application, 3 rupees on allotment, 2 on first call and the balance on final call. Total how many installments? 4 installments are there. Application 250, allotment 3, first call 2 and balance final call will be 2 rupees 50 paisa. All the shares were fully subscribed, no issue at all. It is a full subscription that they have received, no oversubscription, no undersubscription. Mr. Nair, who held 10,000 shares, paid the full remaining amount on his first call. So what is that this person has done? There is a shareholder by name Mr. Nair who paid the final call, that is second and final call, along with first call only. Correct? Paid full remaining amount on first call itself. So he paid 2 rupees on first call plus 2 rupees 50 paisa second call amount on his 10,000 shares. So 10,000 into 2 rupees 50 paisa, 25,000. That will be your calls in advance. The final call, which was made after 3 months from the first call. So what is the gap that is there between your first call and final call? There is a clear gap of 3 months. So Mr. Nair becomes eligible for interest on this 25,000 rupees for 3 months at the rate of 12% per annum. Okay. Next, final call and 3 months from the first call, full paid except the shareholder having 1,000 shares was who paid the dues after 3 months. So there is a problem. What is the problem in your final call? Entire money was received except for one shareholder who was holding 1,000 shares. This guy made a delay in payment by 2 months. Again, we will take it along with interest. We'll see the calculations. We'll put it on a calculator and see. So there is a calls in advance from Mr. Nair to the extent of 25,000. And one person 1,000 shares into 2 rupees 50 paisa final call 2,500. That is your calls in arrears. Give journal entries to record the transaction. Simple problem. Let's see the journal entries. CRD problem number 3 in the books of Rashmi Limited. Journal entries. First entry for receipt of application money, bank account debit to equity share application. 1 lakh shares at 2 rupees 50 paisa, 2,50,000. Okay. Next, we will write a transfer entry on the date of allotment. Okay. So equity share application account debit to equity share capital 2,50,000, 2,50,000. Okay, and the narration. They didn't give this board resolution thing in the ICA material. Okay, but you have to write that for the transfer entries. Next, allotment story. Any problems in the allotment? No problems in allotment. 1 lakh shares into 3 rupees. No issues at all. Due entry. Equity share allotment account debit to equity share capital 3 lakhs. Bank account debit to equity share allotment 3 lakhs. Now the story begins in your first call. What is the amount of call per share? First call is 2 rupees per share. We are supposed to receive 1 lakh into 2. 2 lakh rupees should come. But how much did you receive? 2 lakhs 25,000. Why? Mr. Nair, who was holding 10,000 shares, he paid his final call amount along with first call itself. Look at the thing. Due entry. Equity share first call account debit to equity share capital 2 lakhs and 2 lakhs. But when it comes to entry, receipt entry, bank account debit 2 lakhs 25,000 to equity share first call 2 lakhs and the balance excess over and above 2 lakhs will be transferred or credited to calls in advance account 25,000. Okay, so calls in advance is created here. Next thing, what is the next installment? First call is over. Okay, first call is received on all. Next one, second and final call, that is equity share second and final call or equity share final call to equity share capital 2 rupees 50 paisa into 1 lakh. Done. Now In receipt entry, what is the first thing that you have to do is you have to close. Will you receive entire 2,50,000 rupees in your second and final call? No. Already 25,000 is received from Mr. Nair in the form of advance, calls in advance in first call only, right? So first we have to cancel that. Careful with this entry. Close calls in advance. Technically, I was supposed to receive 2,50,000. Did you receive 2,50,000? No. 2,25,000 was supposed to be received, but there is a problem. What is that? One shareholder who was holding 1,000 shares, this guy did not pay his final call. And when did he pay? 2 months late. Obviously, it was not received on the due date. So 1,000 into 2 rupees 50 paisa. Calls in arrears will be debited. So technically, you have received only 2,22,500 rupees on your second and final call. So bank account 2,22,500, equity share final call account closes 2,50,000, done. Next. Now, what is the immediate thing that you have to do is we have to make the payment of interest to Mr. Nair on his 25,000. Yes, calls in advance. What is the tenure gap between first call and second call? 3 months. 3 months? Yes. So when we calculate, put it on a calculate, 25,000 into 12 by 100 into 3 by 12, 750 rupees. We are creating a what? Due entry here. I created a due. Interest on calls in advance is what? It's an expense to the company. And to shareholder, who is it, Mr. Nair? Then we'll make the payment. Shareholder account debit to bank account. This is for the payment that is made. Okay, done. Next, calls in arrears are coming, but they are coming 2 months late. The person is making the payment after 2 months. So first, let us calculate the interest. Put the interest there. 2,500 into 10 by 100 into 2 by 12. 41.67. Keep it as 41.67. They have kept the fractions in ICA metal. We go with the same 41.67. Shareholders account debit to interest on calls in arrears. Interest on calls in arrears is what? This is a income to the company. They have created a due entry for that, and subsequently look at that. Bank account debit will receive a total amount of 2,500 plus 41 rupees 67 paisa. 2,541 rupees 67 paisa to shareholders account. Just now we have debited it, and calls in arrears account is closed. Okay, so this problem highlights the concept of calls in arrears, calls in advance, interest on calls in arrears, and interest on calls in advance. At the end of the year, we'll be closing them in our profit and loss account. Interest on calls in advance and interest on calls in arrears will be transferred to P&L account. Okay. Next, so this is your calls in advance and calls in arrears concept problem. Now let's see the next problem. JHP Limited. Okay, this problem is very important from what do we call this? Pro rata allotment point of view. Adjustment of excess application money. Two things. Pro rata allotment, how pro rata allotment will be done by the company, and what is the second point that will be highlighted in this is how to adjust the excess application money that is received from different group of shareholders who are given shares using different pro rata allotment. Okay, ratio is different. Read this problem very carefully. Now, JHP Limited is a company with an authorized share capital of 10 lakh equity shares of 10 rupees each. So the company is registered with 1 crore authorized capital in terms of money, of which 6 lakh shares have been issued and fully paid up by 30th June 2020. So the company has already issued 6 lakh shares. That is, they have already collected 6 lakh shares into 10. 60 lakhs is collected. The company proposes to make the further issue of 1 lakh. This is an FPO, further public offer of 1 lakh shares of 10 rupees each. And what is the price? Face value is 10. Issue price is 14 rupees. The company is charging 4 rupees excess towards securities premium because they have got that kind of goodwill in the market. They are capitalizing that. Okay. The arrangements for payment being, okay, the how exactly the company is planning to take this 14 rupees is 2 per share payable on application. They are taking 2 rupees on application to be received by 1st July. Okay, this is a date. Careful with the dates. Allotment to be made on 10th July. So allotment is done on 10th July, and a further 5 rupees including premium to be payable. So if your allotment is 5 rupees, if my allotment money is given as 5, what is the breakup of that? What is the premium amount? 4. So 1 rupee towards share capital, 4 rupees is towards securities premium. Next, the final call for the balance to be made and the money is to be received by 30th of April 2021. What is the last date? 30th of April 2021. Now look at the story here. Applications were received for 3,55,000 shares and that were dealt with as follows. Company is offering 1 lakh and public have applied for 3,55,000. This shows the kind of goodwill the company has got in the market. Okay. Applications for 5,000 shares received the allotment in full. That is, the company is dividing the applicants into 3 groups basically. First group is the first 5,000. First 5,000 applicants, they are getting the shares in the ratio of 1:1. For every 1 share applied, we'll give you 1 share. Second, applications for 30,000 shares received an allotment of 1 share for every 2 applied for. No money was returned to the applicants. The surplus on applicants being used to reduce the amount due on allotment. So whatever excess, why? Because here, what is the allotment ratio? 1:2. 1 share allotted for every 2 applied, or you can add as 2:1. 2 applied and 1 allotted to them. Okay. So whatever excess is there, how much excess will be there? 30,000 shares. Who are these? After the first 5,000, the next 30,000 are this group. They are getting the allotment in the ratio of 1:2. 1 share for every 2 applied, or 4 applied, 1 share given. Okay. So they have paid how much on application? Just now we have seen application money is 2 rupees per share, right? 2 rupees per share. So technically this group has paid 30,000 into 2 rupees, 60,000. But they are getting allotment of how many shares? Only 15,000, which means that half of their application money is in excess. That will go towards adjustment of allotment money. Next, applications for 3,20,000. I think the total count has come, right? 3,55,000, 5 plus 30, 35 plus 320. What is the story of the third group? We have 3 groups here. 3,20,000 shares received allotment of 1 share for every 4. That is 1:4. 1 share allotted for every 4 applied, or 4 applied, 1 share is allotted to them. Okay. So these are the ratios in which the allotment is made. And these people, this third group, will have a huge amount of what we call as excess application. Why? They received only 1/4. That is 3,20,000 upon 1/4, 80,000 shares. 80,000 into 20, 1,60,000 was their due. But what is that they have paid? 6,40,000 rupees. Okay. And there will be one more point in this. We'll be seeing that along with the solution. Next. The money due on final call was received on the due date. Everything was received. Everything was lined up by the due date. You are required to record the transactions including cash items in JHP Limited journal, right? Let's see the problem here. Solution. JHP Limited CRD problem number 4. JHP Limited problem. First thing, how much do you receive on application? 2020 July 1st, bank account debit to equity share. Application account 3,55,000 shares into 2. There is a table that we need to understand. Let's see this table so that we'll have a clarity and then we'll go back to the problem, right? So whatever we have discussed just now, again it comes back in the form of a table here. Look at the thing. First group, we are dividing them into how many categories? 3 categories. Okay. Category 1, 5,000. Category 2, 30,000. Category 3, 3,20,000. Number of shares allotted, they have applied, but how much did we allot? First group has received 1:1. Second group has received 2:1. That is 2 applied, 1 allotted to them, and 80,000 or 3,20,000. This is the share part. Let's see the amount part here. Amount received on application, 10,000 rupees were received from them. 5,000 into 2, that is 1, column number 1 into 2 rupees. 30,000 into 2, 60,000. 3,20,000 into 2, 6,40,000. Total amount received is 7,10,000. This is the journal entry that we have written here. Bank account debit to equity share application 7,10,000. Okay. Now, how is this amount adjusted? Let's go back to our thing. Now, if this is the amount that is received, what is the actual due? Company is offering only 1 lakh shares. 1 lakh into 2 rupees should be 2 lakhs only. So 7,10,000 minus 2 lakhs, 5,10,000 excess amount is there. Right? How do we adjust that? Allotment. So amount required on application. What is amount required on application is based on the allotment given to them. What was the amount that was due? We are calculating that. In order to get that, column number 2, that is number of shares allotted to them into 2 rupees. 5,000 into 2, 10,000. 15,000 into 2, 30,000. There is an excess of 30, 60 minus 30. And 80,000 into 2, 1,60,000. How much excess is there? They have got a total of, yes, 4,80,000 rupees excesses. And adjustment. This excess amounts will be amount adjusted in allotment is your column number 5, very important column. First group, first category, they don't have anything excess, so nothing is adjusted. Second group category, they have 30,000 extra. How is it 30,000 extra? 60 paid, but the due was only 30. 30 will be adjusted towards allotment. Next group, what is the due? What is the next thing? 4 lakh rupees. Sorry, 4 lakhs 40,000 is 4 lakhs 80,000 is excess, but we are adjusting only 4 lakhs here because application due 80,000 shares into 5 comes to 4. So over and above this, whatever is there will be refunded to them. Let's see the next column, refund column. First group nil, second group nil, third group 80,000. It is very clearly given. The excess application money was adjusted only towards allotment. Over and above that was supposed to be refunded. If the company retains this amount, it will be treated as calls in advance, and the company is supposed to pay interest. That is the reason why they are refunding this money. Okay, done. So allotment is, what do we call this? The next one. How much do we have to receive from the first group? Full amount, because there is no excess that is adjusted towards them. We have to receive 5,000 into 5. Next one, 5,000 into 75 was supposed to be received. Okay, due, and 4 lakhs is due. Now, what is the amount that you have actually received is given here. See, 25 full, no excess was there. 45, how is it 45? 75 is due, 30 is adjusted because it was excess in application. 45,000 will be received. And the last group, category 3, no excess amount. We have actually refunded the amount to them. Nothing will be received as allotment. The final call is very easy. There are no issues in the final call. Okay. So this is the statement. First conclude the statement and then start writing the entries. So see how your application money is adjusted. Okay. First one, equity share application account total of 7,10,000. Out of that we have transferred to equity share capital only an amount of 2, that is 1 lakh into 2 rupees. Equity share allotment account, how much is adjusted? 4 lakhs 30,000. What is the breakup of this 4 lakhs 30,000? 4 lakhs of third group and 30,000 of second group category. Okay. And bank, this is the refund part where we have given a refund of 80,000. Done. Okay. Next, what is the next entry? Allotment due entry. Allotment due 1 lakh shares into 5, but premium is how much in that? 4 rupees. Look at the due entry. Equity share allotment account 1 lakh shares at 5 rupees, 5 lakhs. To equity share capital 1 lakh, that is 1 lakh shares into 1 rupee. Securities premium account 1 lakh into 4, which comes to 4 lakhs. Now, did you receive all this 5 lakhs? No, already we have adjusted 4 lakhs 30,000. The balance due of 70,000, the last column in our calculation. This is the amount that we have received actually into bank towards allotment. Bank account debit to equity share allotment 70,000 and 70,000. Done. And next one is April 30. Equity share final call account debit to equity share capital 7 lakhs and 7 lakhs. And this amount is duly received. No problems are there. The entire problem story lies in here where you are adjusting your application money. Okay. Draw this table, get a clarity over the amounts, and only then start writing the journal entries. Okay. So this was your CRD problem number 1. And what did you learn? Adjustment of excess application money can be done in 2 ways. That is, company can keep the excess application money sufficient to allotment, and over and above that they can refund it. That is one thing. Or the companies, as per their memorandum and articles, they can go for retaining the money provided they are ready to pay the interest on that. Okay. Let's see the next one. What is the next problem here? This was JHP Limited's problem. Forfeiture and reissue of shares. What is this forfeiture? Forfeiture is when any applicant or allottee or the shareholder fails to pay the amount due on allotment or any of the calls, the company retains the right to cancel the shares, giving you notice to them and sufficient time. They will give you reasonable time. Okay? They'll be giving you reasonable time, and they'll be sending you whatever we call as a gentle reminder or reminder, and then you will be getting a letter of whatever we call as forfeiture. Okay. Now, why are we there doing it? Is, see the thing. Just now we have discussed it. As per SEBI guidelines, the subscription money must be received within 12 months from the date of allotment. Company must receive the entire amount from the date of allotment 12 months before, 12 months, within 12 months. So, if any of the shareholder fails to pay that, then the company reserves the right to forfeit them, cancel the shares, take the shares back, and they can reissue. Why are they forfeiting? This particular thing is a property in the hands of the company, which is meant for reissue again. Okay, reissue, or technically it is sale. Okay. Now, accounting entries, amount called up and all that. Look at the thing. Now you should be careful when you're dealing with the problem where company has issued the shares at premium. Okay, because the accounting entries will differ. If the premium is received, no effect will be there. If the premium is not received by the company, then we have to cancel the premium. Okay, now forfeiture of shares. Let's try to understand that with the problem here. Problem number 5. Okay, it's a very simple problem. Look at the thing. P Limited issued 20,000 equity shares of 100 rupees each at a premium of 20 per share. 120 is the issue price. Payable on application is 50 and allotment is 50. This is including premium of 20, so 30 plus 20. And final call 20. Only 3 installments are there. Applications were received for 24,000 shares. There was an oversubscription by 4. And what is that the company has done? Letter of regret was issued to the applicants for 4,000 shares. So the last 4,000 share applicants, whoever are there, who have applied for 4,000, they received the refund along with the letter of regret. And shares were allotted to the other applicants, obviously. Mr. A, the holder of 150 shares, failed to pay the allotment and call. This guy paid only application. He never paid what we call this allotment and call. The shares were forfeited. The company took back the shares. The shareholder, Mr. A, lost his rights over the shares, lost his property over the shares. Okay. What are the entries? Look at the entries here. Achha, are they asking you cash book? Show the journal entries and cash book. Yeah, this is a typical problem where they are asking you to write all the bank entries in a cash book format, cash book, and other transfer entries will go into your journal proper. That is your journal register. Look at the thing. First, how much did we receive? 24,000 into 50. First entry goes into your cash book. This is CRD problem number 5 in the books of B Limited. Cash book, bank column only. Okay. Now, let's see the order in which the entries are passed. This is your first entry. Okay, equity share applications on the debit side received on 24,000 shares at 50 per share. But what is the actual number of shares that are offered by the company? Only 20,000 shares were offered. 20,000 into 50. So there will be a refund. Immediately the company refunds. Look at the other side. Company refunded 4,000 shares into 50. Done. Okay. Then we will write the transfer entry. Okay. Transfer entry will go into your journal. Equity share application account debit to equity share capital 10 lakhs and 10 lakhs. Next. What is the story of allotment? 30 plus 20. What is the problem? On 150 shares, you didn't receive it. We received 20,000 minus 150. 19,850 shares. On that, we have received the amount. See the thing here. So equity share, allotment account, 19,850. You have received 9,92,500 rupees. Okay. And what is that? But before that, what is that we will do? We will write a transfer entry. Before this, we'll be writing a transfer entry. We'll be expecting how much? 10 lakhs, right? This entry comes first. Equity share allotment, 20,000 shares at 50, which is divided into share capital of 6 lakhs. That is at 30 rupees per share on 20,000 shares. And securities premium, 20,000 shares at 20. Okay. But out of that, you could not receive it on 150 shares which were held by Mr. A. And how much did we receive? 9,92,500. Okay. Next, what is due? Final call is due. Let's write the final call due entry here. What is the final call due entry? Equity share final call account debit to equity share capital 4 lakhs and 4 lakhs on 20,000 shares at the rate of 20 per share, right? And even on this, we didn't receive it on 50,000, 150 shares. That's again equity share final call account 3,97,000 rupees. Okay. So what is the next entry? The new entry, the forfeiture part. We are seeing the first forfeiture problem here. Focus on this entry. In order to forfeit the shares, first we will debit the share capital. Capital usually shows credit balance, but we are cancelling here. How many shares are cancelled? 150 shares are cancelled. And the share is a fully called up share. Careful with the thing, because you should be debiting this 150 into called up value. This share is fully called up. Sometimes share will be partly called up. Securities premium. Why are we debiting securities premium? Because Mr. A never paid securities premium. When premium is not received, we actually, yes, created a what do we call as due entry for a lot in the allotment thing. See, you were expecting this equity share allotment 10 lakhs. Out of this 10 lakhs, 4 lakhs is what? 4 lakhs is towards securities premium. We created the securities premium, but we never received it from Mr. A. That's why I'm cancelling securities premium at 150 per share and 3,000 rupees. Okay. And next thing is to equity share allotment account 7,500. This is the due amount, that is 150 shares into 5 rupees, and equity share final call 3,000 rupees, right? 150 into 20. Forfeited shares account 7,500. What is this account? This is the amount that is paid by Mr. A. He paid only application. Application was 50 per share into 150, 7,500. Okay, look at the note here. Securities premium on forfeited share has not been realized, so securities premium account will be debited at the time of forfeiture of shares. Every time, remember, if securities premium is not received by the company, we have to cancel it, right? So this is a basic problem on forfeiture. Now we'll be seeing forfeiture plus reissue in the next problem. Yeah. Multiple cases, all possible options, permutations and combinations are given of forfeiture and reissue in problem number 6. Okay. A good problem to revise before exam. Now look at the thing here. Give journal entries for forfeiture and reissue of shares. X Limited forfeited 100 equity shares of 10 rupees each held by RAM on 15 December 2020 for non-payment of first call 2 and final call 3. So if first call and final call are 2 and 3, RAM has paid application and allotment put together 5 because the face value of the share is 10. Okay. These shares were reissued to Sitaram on 25th December 2020 at a discount of 3 rupees 50 paisa. Now, go back to the problem and see solution. We'll discuss it along with solution one by one. Let's say yes. Okay, journal entries in the books of X Limited. First case, share capital account debit 100 shares into 10. Share is fully called up, 10 rupees. Shares were there with RAM, 1000 shares debited. And what is not received? Look at the thing. To first call account 100 shares into 2 rupees and final call 3 rupees. And how much did you receive will be credited to forfeited shares account. To forfeited shares account 100 into 3 rupees, 5 rupees, a total of 500. Okay. So the company has already received 500 and the company did not receive 500. That is in first call 200 and final call 300. Now alternatively, these two accounts, that is first call account and final call account, can be routed through a common account called as calls in arrears. Okay, you can write the entries either ways. Let's see the reissue part. The share is offered at a discount of 3 rupees 50 paisa. Okay, 3 rupees 50 paisa discount is given. Out of 10 rupees, if 3 rupees 50 paisa is given as discount, it is offered at 6 rupees 50 paisa. Bank account debit 100 shares at 6 rupees 50 paisa, 650 rupees. Whatever discount is offered, that discount 3 rupees 50 paisa per share will be routed through, will be debited to forfeited shares account. Why? Because the company has already received 5 rupees per share from RAM, which total to 500. Out of this 500 will be taking out 350 by debiting forfeited shares account. Okay, to share capital account 1000. And what is the profit that company has made? Total 500 received from RAM, 350 discount offered now 150, or we can calculate per share also. What was the original amount that was paid by RAM? Application was 5. Out of that, if you reduce 3 rupees 50 paisa, balance 1 rupee 50 paisa will be the profit on, yes, 1 rupee 50 paisa into. Next, let's see the second problem. The intensity of the problems will increase gradually. B. X Limited forfeited 200 shares of 10 rupees each issued at premium 5 per share held by Moturam on 15 December 2020 for non-payment of final call of 3 per share. Okay. So, these shares were reissued to Loknath on 25th December at a discount of 4 rupees. First thing, whenever you see a premium, get a clarity whether the premium is received from the allottee or not. Okay. So, what is the issue price of the share? 15 rupees. Face value is 10 plus 5 rupees, 15. Held by Moturam for non-payment of final call. So, out of 15 rupees, this person has not paid 3, which means that he has paid 12. If final call is, and what is the thing? Premium is usually received along with allotment. Correct? So, Once the premium is received, forget about premium. Do the calculations only based on the value other than premium. So out of 10 rupees, 3 rupees is not received. Balance 7 rupees is received. Technically, we have received 12 rupees from him, but we are writing it as only, yes, premium once received cannot be cancelled. Right, next. So what is the next part? See the next part. B. Forfeiture entry. Share capital debit for 200 shares, 2000. Final call is not received, 600. And what is already received is 1400. Okay, towards capital. See, do you see anything called a securities premium here? No. Premium once received cannot be cancelled. Don't talk about premium. Simple logic. Bank account debit. This has been reissued to someone. Okay. Loknath, at what value? Discount of 4 rupees. So on face value, okay, don't calculate it on issue price. It is not 15 minus 4. It is face value. Discount is always calculated or deducted from the face value. Bank account debit 200 shares at 6 rupees per share. 1200. Forfeited shares account. How much discount are we offering? 4 rupees per share into 200. 800. How much is already collected from the party here? 14. 14 minus 8. Balance 6 will be taken as profit. Forfeited shares account debit to capital reserve. 600. 600. Okay, this is second case. Look at the third one here. Mr. Long, who was holding 2000 preference shares of 100 rupees each, on which 75 per share has been called up. Mind you, this is not a fully called up share, it is only partly called up share. Out of 100, only 75 is called up. So we'll be debiting share capital with called up amount of 75 only. Could not pay his dues on allotment in first call at 25 per share. So if 75 is called up, 25 on allotment, 25 on first call, what is application money is balance 25. So all the installments are equal in this. The directors forfeited the above shares and reissued 1500 of such shares to Mr. Short at 65 per share, paid up as 75. Okay. Now, new point that we are seeing is share is not a fully called up share. Share is only a partly called up share, and subsequently the share has been issued at discount. And are we issuing the entire forfeited shares? No, we are issuing only a part of forfeited shares. Okay. So next one, look at the thing. First, let us write the forfeiture entry. These are preference shares. Preference share capital 2000 to 75, 1,50,000. To preference share allotment 50. To preference share first call 50. To forfeited shares, this is the amount that is received, 50,000. 3 parts. Now, alternatively, this preference share allotment and first call can be grouped as calls in arrears. Now you are reissuing the shares at what value? 65 per share. And how many shares? 1500 shares. Bank account 1500 shares at 65, 97,500. Forfeited shares, what is the discount that is offered? 10 rupees. Why? Because the share is called up to the extent of 75. Out of that you are taking 65. 10 is the discount. 1500 into 10, 15,000. To preference share capital 1,12,500. The balance 500 shares are yet to be reissued. They are there with the company pending for reissue. Forfeited shares account debit to capital reserve. Now, how much money did you receive? They gave you a working notes here. It can be done like this, or you can make it very simple. 25 rupees is already received and 10 rupees is given as discount. 15 rupees per share is the profit. 1500 shares are being reissued to the other party. So that is what is given. Forfeited shares amount 25, 10 is offered as discount, 15 rupees into 1500. We are getting a value of 22,500. The balance 500 shares are still lying with the company pending for reissue. Okay. Let's see the next case. All combinations of forfeiture and reissue are given in one problem. Mr. Shami has applied for 1000 shares of the company XYZ Limited, paying application money of 2 per share, but had been allotted only 600 shares. There was a pro rata allotment. Why? Because there was an oversubscription. And this guy has received how many shares? 3 shares for every 5 applied, right? The shares have a face value of what we called as 10 and the premium of 2 per share. So issue price is 12 rupees per share, which was payable on allotment 5 including premium and final call of 5. Mr. Shami doesn't pay this guy did not pay the allotment money and the final call. So this guy paid only application. So what is the important element that you have to keep in mind is premium of 2 rupees is not received, and this premium is subject to cancellation now. While writing the forfeiture entry, we have to make sure that we are cancelling the premium as well. Okay, premium will be debited, corresponding credit will be taken out of allotment. Okay. Let's see the thing. What is the reissue part and all that? On final call, Mr. Sami doesn't pay and the shares were forfeited. 400 shares are reissued to Sarita at 11 per share. Okay. So, what is the face value of the share? 10 rupees is the face value of the share. This share is reissued at 11. That is over and above face value. So, whatever excess 1 rupee is there, that will be securities premium. Any amount that is received on reissue over and above face value will be credited to securities premium. Okay. A very important conceptual problem. First, let us forfeit them. Share capital account debit, 600 shares into 10, 6,000. Securities premium, 600 into 2, 12. Now, this calculation is important. This guy has applied for how much? 1,000. And he paid how much? 2,000 rupees. 1,000 into 2. But how much was allotted to him? 600 into 2. 1,200 was due. So out of whatever payment he has made, 800 excess is there, which will be adjusted towards allotment. But allotment has got two parts, capital part and securities premium part. Whatever excess application money is there, if it is carried forward to the allotment, the excess application money should be first adjusted to capital amount, and if the capital amount is full, then the excess will be taken to securities premium. Okay. So let us see that with the calculation. This is the thing. Total amount received from Shami is how much? 2,000. And what is the actual due? Because he's allotted only 600 shares, 1,200, 800. 800 excess on allotment, premium is 1,200 and capital is 1,800. So this 800 will be adjusted towards what? Premium. It will be adjusted towards capital amount. Out of 1,800, 600 into 3, 1,800, 800 is gone. So 1,000 of capital is not received and 1,200 of premium is not received. Technically, nothing is received in premium. That is the reason why we have cancelled the entire premium. Okay. This is a very important point which is highlighted in this particular problem. So premium is debited completely and 2,200. Actual due is 3,000 rupees. 600 into, yes, but 800 is adjusted already, and final call is obviously 600 into 5. Done. This is a forfeiture part. And how much is received? 2,000. Whatever he has paid will be adjusted. Out of this, careful, bank account debit 400 into 11, 4,400 to share capital 4,000. Securities premium 1 rupee per share 400. There is no discount given at all to Sarita. Is it? Forfeited shares account debit to capital reserve. If what is the value? How did you get this valuation? 2,000 rupees are received on 600. And how much is it proportionately on 400? 1,333 running decimal. Okay. Round off to 1,333. This is your next one. So what are the important elements here? Securities premium was not received. It should be cancelled. There was a pro rata allotment. Excess application money was adjusted, and excess application money will be adjusted in allotment first towards capital amount. Yes, it will not be adjusted towards premium. So technically in this problem, you never received what we call as premium at all. That is the reason we have cancelled it. Yes. And all the forfeited shares are not being reissued or sold. And look at the last one. Mr. A holds 2,000 shares of 10 rupees each on which he paid 2 as application money. B holds 4,000 shares of 10 rupees each on which he paid 2 per share application and 3 per share on allotment. And C holds 3,000 shares of 10 rupees each and on which he paid 2 application, 2 on allotment, 3 on first call. They all failed to pay their arrears on second and final call, and the directors have forfeited the shares. So they have given cases where individuals are not making the payment after their first allotment. I mean, after what we call as application, they didn't pay the balance. Second guy has not paid the calls. Third guy has not paid the final thing. Okay, how do we handle this? This is all a calculation based chapter. Look at the calculation here. Application, money received and money not received. On application, 2,000. We didn't receive the other, what we call as amounts here. Okay. Allotment is not received, first call is not received, and final call. A has paid only application. B paid application allotment, he didn't pay first call and second call, multiplied with the number of shares, whatever they are having. 3,000 shares of C. This guy has paid 3 installments. He failed to pay the last installment. So what is the total here? And multiplied by whatever we call as the number here. Okay, look at the entries. Share capital account, 9,000 shares into 10 rupees, 90,000. To share allotment, 6,000 rupees are not received. First call 18,000 is not received. Final call 18,000 is not received. Forfeited shares, we have received a total of 48,000 rupees. Okay, 18 plus 21 plus 9, and these parts are not received. This is what we have debited in the forfeiture part. Bank account debit, how many shares are reissued? Are they reissued? Yeah, these shares were reissued subsequently for 12 rupees per share. What is the face value? Yes. So look at the entry. Bank account debit 9,000 into 12, 1,08,000. Share capital 90,000. Securities premium 18,000. Over and above face value, whatever is received. So do they have any loss? No. Entire amount of 48,000, whatever is received, will be profit. So these are the different scenarios, different cases of what we call this forfeiture. Okay. Let's see the next problem here. The form of balance sheet is given, and from next problem they'll ask you to show the accounts in balance sheet. Okay, look at this. Problem number 7. Beautiful Co Limited issued 30,000 equity shares of 10 rupees each, payable as 3 per share on application, 5 per share on allotment including 2 premium, on allotment 4 per share. Okay, all the shares were subscribed. It's like fully subscribed, 30,000. Money due on all the shares was fully received except Ram holding 5,000 shares failed to pay the allotment and call money. Okay, this guy failed to pay 2 installments. He paid only application. And Sham holding 1,000 shares failed to pay call money. Final call was not paid. All those 1,500 shares were forfeited. Of these shares, 1,250 shares reissued to Ram's reissued, and this 1,250 has got all 500 shares of Ram. The balance 750 is of Sham. Were subsequently reissued to Jadu as fully paid up at a discount of 2 per share as the necessary journal entries. Okay. Only the what do we call this? The rest of the part is same except for what do we call this? Forfeiture. Let's jump into what we call this forfeiture and see. Okay, let's quickly run the entries here. 30,000 into 3, application money, transferred it to share capital. Allotment was 90 and 60 because 3 rupees and 2 rupees you received. Problem was there in the thing because Ram did not pay on his 500 shares. There is a due. Okay, call scenarios. It is not transferred to call scenarios here. Next one is first call. Even on this we have a problem. Okay. Then what happened? After first call in this problem, immediately they are going for forfeiture of shares. Okay. Equity share capital 1,500 shares into 10. Securities premium. Who did not pay? Ram did not pay. We received it from Sham. We are not accounting for that. Equity share allotment account 500 into 5. This is not received. Equity share call amount 1,500 into 4. Okay. And forfeited shares account 7,500. Bank account, these things are reissued. Okay, you should be careful in this problem. The entire thing will be there in the calculation of profit to be transferred to capital reserve. Okay, transfer to capital reserve will be Ram's share. We will be doing a calculation here. Look at the thing. Application, Ram's thing was Ram paid 3 rupees only application money. He did not pay the balance. So the loss is 2 rupees. The discount offer to Jadu is 2. The profit that is made on Ram's share is 1 rupee per share surplus. And when it comes to Sham, 6 rupees were received from him. Yes, premium is also received, but once received cannot be cancelled. 2 rupees discount is offered, 4 rupees here. Okay. How did they calculate the profit? Ram's share 500 into 1 rupee, 500. Sham shares 750 because only 1,250 shares are reissued. It's not 1,500. 750 at 4, 3,000. 3,500 will be transferred to capital reserve as profit. Okay. Journal entries are regular journal entries, but what is a new thing that is given in this problem is they have asked you to show that in balance sheet. Look at the balance sheet here. Balance sheet first one, share capital 2,99,000. How did they get this 2,99,000? Authorized capital was 3 lakhs. They received it on 29,750 because balance 250 shares which are forfeited from Sham are still there with the company. So plus forfeited shares balance, whatever is there, it will be shown as capital only. That thing makes it 2,99,000 rupees. Next, reserves and surplus, securities premium 59,000. 29,500. What is this 29,500? On 500 shares of Ram, we never received it. And capital reserve of 3,500. Just now we have calculated the profit on reissue of forfeited shares. That will go into your reserves and surplus. Then cash and cash equivalents. For that purpose, we have to prepare a bank account. Application money 90, allotment money 1,47,500, first call 1,14,000, and reissued shares 10,000. Total comes to 3,61,500, and your balance sheet tallies on both the sides. Okay, very important. They may ask you to present that in balance sheet also. You have to draw the balance sheet, journal entries, balance sheet, show the notes to accounts very clearly, and if required, we may have to do the calculation by preparing bank. Okay, profit bar, careful with the profit. Always take it on per share basis. Ram has paid 3, discount 2, profit is only 1. Ram has paid 6, premium is excluded, 2 rupees discount offered, 4 rupees. And number of shares by multiplying it, careful with the multiplication part. Premium is already discussed here. Okay. Now let's see the next thing, comprehensive problems. What are these comprehensive problems, sir? Like, yeah, one more thing. Issue of shares for consideration other than cash. We have seen in part 2, shares are usually issued by the companies for cash. Sometimes the companies can give these shares other than cash for consideration other than cash. Now, what are the scenarios? When they are acquiring a, what do we call this? Fixed assets, or they are acquiring a complete business altogether, they will issue shares. They are giving it to promoters. These shares are called as qualification shares, not required at this level. They are giving it to promoters. To underwriters. Okay. And to what do we call this? Sweat equity shares, we have discussed in section 53. Shares must be offered to employees and directors at discount. No other parties, that is general public, are not given shares at discount. So these are the scenarios, very simple entries. If you are acquiring a complete business, then the story, look at this, problem number 8. Exco Limited was incorporated with an authorized share capital of 90,000 equity shares of 10 rupees each. The company purchased land and buildings from Y&Co for 4 lakhs, paying in full paid up shares of the company. The balance of the shares were issued to public, which were fully subscribed. A simple problem here. What is that the company has acquired? And they have acquired land and buildings from Y&Co Limited. Land and buildings account debit to Y&Co Limited, 4 lakhs and 4 lakhs. And Y&Co Limited is discharged by giving what we call as equity shares for 4 lakhs. And what value? 10 rupees per share. How many shares are on the offer? 40,000 shares were offered to them. And balance will be out of 90,000, 50,000 shares were issued to public, and that too, no installment information is there. We are taking it as like one installment. Bank account debit to equity share application and allotment 5 lakhs and will be transferred to capital account. Okay. Now they have shown that in balance sheet. Look at the share capital 9 lakhs, fixed assets 4 lakhs, cash and cash equivalents, that is bank 5 lakh rupees. Done. Let's see the next problem. Comprehensive problems, that is whatever we have done till now, starting from basic problem to this, that is issue of shares. Okay, the complications of what we call as calls in arrears, calls in advance, and what we call as forfeiture and reissue, they are all given in one problem. Okay, comprehensive problems. Careful with the problem. Part 4, comprehensive problems. P Limited issued 2 lakh shares of 100 rupees each at a premium of 20 per share, payable as follows. On application 20, on allotment 50 plus, that is including premium 30 plus 20. Allotment is done, first call is 30 and second and final call is 20. Let's see the core content of the problem. Applications were received for 3 lakh shares and pro rata allotment was made to the applicants of 2,40,000 shares. That is 3 lakh applications received, 60,000, the last 60,000 were refunded. Excess money received on applications of 2,40,000 shares was employed on account of sum due on allotment as a part of share capital. Okay. So it was adjusted towards share capital, share allotment thing. E to whom 4,000 shares were allotted failed to pay the allotment money, and on his subsequent failure to pay first call, his shares were forfeited. And if the holder of 6,000 shares failed to pay 2 calls, and his shares were forfeited after second call. So the company is forfeiting. In this particular one, what is the typical element that you are seeing? The new point is after first call, yes, the money when it was due from E, who failed to pay his allotment in first call, immediately they forfeited. So that is for your second call, the shares due will be 2 lakhs minus 4,000, 1,96,000 shares. Let's see the problem here. And what is it? Of the forfeited shares, 8,000 shares were reissued to G at a discount of 10%. The whole of E shares were being reissued, past necessary journal entries. So everything in one problem. Look at the first one. 3 lakh applications have come. Let's study the entries one by one. Bank account debit to what do we call this? Share applications. 3 lakh shares into 20. 3 lakh. This amount has to be adjusted. Now, what is the thing? You are refunding how much? 60,000. Look at the next entry here. Share application account is closed by debiting to 2 lakh shares at 20. 40 lakhs goes into share capital. Share allotment account 8 lakhs transfer 60,000 into 20. This is refunded. Done. Next one. Share allotment account debit to share capital. How much is it? Like 50 rupees. We have to receive a total of 1 crore. Out of that, 60 lakhs is towards capital and 40 lakhs is towards premium. But will you receive 1 crore? No, we are supposed to receive only 92 lakhs. Already 8 lakh rupees is adjusted in application. Look at the thing. What is the problem here? We were supposed to receive 92 lakhs, but we have received only 90 lakhs 16,000 rupees. Why? One shareholder, Mr. E, to whom 4,000 shares were allotted. How many shares were applied? What is the allotment ratio? 6:5. 6 shares applied and 5 shares were given. So this guy is applied for how many shares? 4,800 shares. Correct? Mr. E has applied for 4,800 shares. And obviously, how much money was paid by him? Look at the thing here. Calculation of calls and errors of E. Shares applied by E are 4,000. Allotted to him are 4,000. Applied will be 4,800. Application money 4,800 shares at 20 per share 96,000. Actually due is only on 4,000, that is 80,000. 16,000 excess is there. This was adjusted towards allotment. So whatever due amount is there from him, it will be reduced by 60,000. And what you can also calculate what we call as effective rate per share. That is, if this person has paid 4,800 shares into whatever 96,000 is paid by him, allotted to him is only 8,000 shares. Okay, allotted to him, how many shares are allotted to him? 4,000 shares are allotted to him. 4,800 applied. Effectively, it will be 24 rupees paid by him on what do we call this thing? Application. Okay, 96,000 rupees divided by 4,000. Is it coming to 24 rupees? Which means that 4 rupees excess whatever is paid, it has been adjusted towards allotment, and technically due from E is only 44 rupees on allotment. This calculation can also be made. Now let's go with the journal entries here. Okay, so we received how much? 90 lakh 16,000 and 1 lakh 84,000 is due. After deducting that 16,000, actually we are supposed to receive 2 lakhs from E. We received 16,000 already in application, 184 is due. Next. Now share first call. After making first call, in this problem, they have immediately forfeited the shares of E. So equity share first call account debit to share capital. This is a due entry. Bank account debit only on 1,90,000. What is the problem here? One more person, Mr. F, has also failed to pay his first call. Is it? Failed to pay the calls. Who failed to pay 2 calls? So 4,000 of E and 6,000 of F. Put together 10,000. We got the money only on 1,90,000 shares. 57 lakhs. Calls and errors is 3 lakhs. And for first call 60. Now look at the thing. This is a new thing. This is the first time you guys are forfeiting the shares after first call. That is, before the shares are fully called up, the forfeiture exercise is completed. Share capital account 4,000 shares of E at 80 rupees, because only 80 is called up, 20 is still yet to be called up, which is on final call. 3,20,000. Securities premium 4,000 into 20. We never received the premium. Premium is cancelled. Forfeited shares account. How much is paid by this guy? 96,000. What is the breakup of 96,000? 4,800 shares applied into 20. And whatever balance amount is there, the difference amount, 3 lakhs 4,000 will go into this thing. Okay, calls in arrears account. Next, what is the story? Final call is made. Final call is made on how many shares? Only 1,96,000, because 4,000 shares of X are already forfeited. So due is only on 1,96,000 shares, and you received on 1,90,000 shares. 38 lakhs 1,20,000 is calls in arrears here. Now you are going for forfeiture of shares of, yes, F. And what is the amount that you have already received? 3 lakhs is already received. This guy has paid half and the balance half is not received. Okay? And premium is not cancelled. Why? Because premium is received from F. Reissued. Look at the reissue story. How many shares? 8,000 shares are reissued to G at a discount of 10%. The bank account debit 8,000 shares into 90. Face value of the share. Discount is always calculated on the face value. 7,20,000. Forfeited shares 8,000 into 10. 80,000 is the discount. Share capital account 8 lakhs. Forfeited shares. What is the profit part? How did they arrive at the profit part here? Look at the profit on forfeited shares. Forfeited shares, profit from whatever we call as this 96,000, and the amount received from F is 2 lakh rupees, excluding whatever we call as premium. 2 lakhs 96,000. Discount offered is whatever we call as 80,000, because the entire shares of E are given. 2 lakh 60,000 will be the 16,000 will be the balance of profit, which will be transferred to your capital reserve. Okay. Simple problem. The only unique point in this particular problem is they are forfeiting the shares after first call and before final call in this particular problem. Now let's see the next problem. This is again a unique problem where, okay, careful with the calculations in this. Sunshine Limited invited applications for issue of 1 lakh equity shares of 10 rupees each, issued at premium of 3 rupees. Okay, uniqueness is on application 5 per share including premium of 1. That is a combination of 4 plus 1 on application they are taking, and again on allotment 5 rupees 4 plus 1. What is the balance? 2 plus 1. On call 3 installments. Application 4 plus 1. Application premium is 1. Allotment premium is 1. Call premium is 1. Now what happened? Applications were received for 2,20,000 shares. Oversubscription by 1,20,000. Applications for 20,000 shares rejected and their application money was refunded. That is, they are going for refunding the last 20,000 applications and refunding them. Shares were allotted to the remaining applicants as follows. Allotment in full to Karishma, who applied for 10,000 shares. So this lady applied first and she got the full allotment 1:1. Applications for 40,000 shares were allotted. 30,000 shares on pro rata allotment 4:3. Okay, 40,000 applied, 3. Allotted the balance share. So what are the balance now? 1,50,000 balance. Balance shares applied. For this particular thing, we are offering how much? 60,000. So this is in the ratio of what is common? 3 is common, 5:2. The ratio is 5:2. So 3 pro rata allotment ratios are there in the problem here. And the problem with premium, especially when forfeiture is done, you should be careful with the forfeiture. Now let's see the complications here. Excess application money was utilized in payment of allotment and calls. They are adjusting it. Unlike in the previous problems, any amount in excess received on application was only adjusted towards allotment. Now they are adjusting it towards calls also. The call was duly made, right? The problem, look at the problem here, co part. X applied for, careful with the wordings here. Applied for, this guy has applied, okay, for 800 shares in category 2. What is the allotment ratio in category 2? 4:3. So if he has applied for 8, he is allotted only 600. In category 2, failed to pay allotment money and his shares were forfeited immediately after allotment. Now, in the previous problem, we have seen that allotment and first call, when they were not paid, there was a forfeiture. But here, immediately after allotment, if you are not, yes. Y to whom 600 shares were allotted. One more guy is there. Here it is not applied. This is allotted. Careful with this. First one is complicated. Y's calculation will be simple. Category 3 failed to pay the call money and all his on his failure call money, his shares were forfeited. Of the shares forfeited, 900 shares were reissued. Trading fully paid as 9 rupees. Okay, the whole of Y shares were being included in that. Okay, whole of Y shares being included. Pass the necessary entries. Now, whose shares are being reissued? 600 out of Y and the balance 300 is of X. Okay, let's see the calculations. You should be careful only while doing whatever we call as this. Let's understand this calculation first. Category 1, statement showing the adjustment of application money. Why are we very serious about this? Is application money is being adjusted towards allotment and calls. First, we are dividing the applicants into 4 categories. Okay, first category, refund category. This category is Karishma, lady who has applied it, and this is the second category where X is a part of this and Y is a part of this group. Okay, So 20,000 into what do we call this? Application money 5, that is 4 plus 1, but nothing, entire amount will be refunded. 20,000 into 5 rupees. First category is all a refund category. Balance left out shares applications that we have received is 2 lakhs now. Karishma has applied for 10,000 shares. She is allotted 10,000. She has paid 5. That will be adjusted towards share capital is 40 and securities premium is 10. No issues here. The problem will start with the second category. 40,000 shares were applied, but we have given the allotment of only 30,000 shares to them. Amount received from them is 2 lakhs. And how do we adjust this is, first share capital 30,000 into 4 and 30,000 into 1. What is the excess now? 2 lakhs. Yes. Whatever excess application money is there, it should be first adjusted towards capital part. Okay. Allotment 50,000 rupees, no refund. Third category, 1 lakh 50 applied, but we gave them only 60,000 allotment. 7 lakhs 50,000 is received. 2 lakhs 40,000 is adjusted towards the 60,000 into 4 and 60,000 into 5. How much excess is there? 3 lakhs. What is their due on allotment? Again, 60,000 into 5. Okay, 4 plus 1, 4 plus 1 and 2 plus 1. So 3 lakh rupees. What is the thing? Entire amount over and above allotment will be treated as calls in advance. This is a new thing that you're seeing in this particular problem. Okay, subject to calls in advance. Yes, interest is also, but they didn't give us any information regarding the interest, or else we would have accounted for that. Next, let's see the solution part, entries part. Careful with this calculation. Look at the first entry. Bank account debit to share application. Okay, we received 11 lakh rupees. Okay, 11 lakhs. How is it 11 lakhs? How many shares are actually applied for? 2 lakhs 20,000 shares into 5 rupees. Done. What is the breakup of this 5 rupees? Second entry. Share application account 11 lakhs is closed. Out of that, 1 lakh shares into 4 rupees, 4 lakhs. 1 lakh shares into 1 rupee premium. Okay. Share allotment account. Just now we have adjusted. Second category 50,000, third category 3 lakhs, 3 lakhs 50,000, bank refund of 1 lakh and calls in advance of 1 lakh 50,000 in the table. Okay. Next, allotment. Share allotment was made. Again, allotment is 4 plus 1. Share allotment account debit 5 lakhs to share capital 4 and to securities premium 1 lakh rupees. Now, what is the problem here? Bank 5 lakhs is supposed to be received. Out of that, already 3 lakhs 50,000 is received. We have adjusted that in application. Balance was supposed to be 1 lakh 50, but we are accounting for only 1 lakh 48. Why? Look at the thing. X is applied for 800 shares, correct? Look at the total number of shares applied, allotted to X are only 600, but actually applied by him are 800. So excess money, let us see the excess money part. Application money received from the defaulter X, 4,000 rupees are actually paid by him on 8,000. Allotted are only 600 into 5, 3,000. 1,000 rupees excess amount is there, which will be adjusted towards allotment. Again, allotment is 600 into 5, 3,000 minus excess of 1,000, 2,000 rupees is due. This is the amount that is not received from X. Okay, so that is the reason why we have got 1,48,000, that is 1,50,000 due minus 2,000 rupees not received from X. And what is that the company has done? Company immediately forfeited the shares of X. Share capital account 600 shares of X, 8 rupees is called up. Okay, 8 rupees called up. What is the value? 4,800. Securities premium 600 into 1. We never received this. Yes, on allotment. Premium is already received. Forget about the premium received on application money. Okay. To share allotment account 2,000 rupees. To forfeiture account 4,000 rupees are received from him. Actually, he applied for 800 into 5. 4,600. Premium amount is not received. We are cancelling that premium. 3,400 rupees. Okay. 600 and 600, whatever this thing is. Okay. Go back to calculation and see. Okay. 2,000 rupees out of this. Yes, 4,000 first it is adjusted towards it, and excess 400 rupees whatever is there, it was adjusted towards is capital money. Okay. Now, next thing, share first and final call is made, and what is the value? Share first and final call value is 3 plus 1 or 2 plus 1. 2 plus 1 is it? Yeah, balance this is like 5, 5, 3, 2 plus 1. So how many shares? Only how many shares are forfeited? Yes, already 400 shares. Shares forfeited account debit 2,98,200. 400 shares are already gone out of it. Share capital and securities premium accordingly. Next one, bank account debit 1,47,900. Calls in advance. Calls in advance cancelled is how much? Is it 1,50,000? Yes, 1,50,000 is adjusted towards this particular group. Yeah, 1,50,000 calls in advance. Calls in arrears is 300. Only 300 rupees is not received because what is the allotment ratio? 5:2. Okay, there is a lot of excess money. Whatever this 300 is there, that thing is purely towards premium. Look at the thing. So how did we arrive at this 300? Y's part. How did we arrive at this 300, right? See the calculation here. Y has applied for 1500 shares. How did we arrive at that? He applied for 1500, 600 are allotted to him, 600 into 5 by 2, 1500 shares are applied by him. And he has paid how much? 7,500. 1500 into 5 shares, application was 5, 7,500. Now when we bifurcate this amount based on installments, application, allotment and first and final call, he was supposed to pay us 600 into 5, 3,000, 600 into 5, 3,000, 600 into 3, 1,800. Now what he paid is 7,500. Receivable from him was 7,300. The difference is 300. Or still, if you are not clear, let's see the thing. Application money is received completely. Application complete 3,000 is received. This thing is gone. Next, allotment is done. What is the balance that is left out? Is out of 7,500 minus 6,000, 1,500. Out of that 1,500, first we will adjust capital amount 1,200. Left out is what? Only 300, which means that out of the premium due on first and final call 600, 300 is received already. The balance 300 rupees is your calls in arrears. Clear? So this is what the 300 is. Amount due but not received on call purely towards premium is 300, right? So we are done with company 1. Right, well, let's see the next chapter, chapter number 18, company accounts 2. Okay, issue of debentures. Just now we have completed what we called as company 1, wherein shares were issued, shares were forfeited, and shares were reissued by the company. Now, what exactly is this debenture? It is a debt instrument which is issued by a company. It is more like a loan taken by a company from individuals. Usually, whenever you talk about loan, we think that it will be from a bank. Now, when the company approaches public, general public for loans, that loan will be there in the form of debenture. It is an interest-bearing security. Okay, look at the features. It is a document which is evidencing the loan made by the company. It has got a fixed interest. Interest is payable at a premature fixed date, and regardless the level of profit. This is not dividend. It has no connection with what we call as profit. Company must pay interest irrespective of the fact whether they have got profits or not. Okay, and the original sum is repaid. These are not like ordinary shares or equity shares. They will be redeemed. That is, company will take back the debentures, then they'll give you money back. Okay, and these are some of the different types of debentures which are issued by the company based on security, convertibility, permanence, negotiability, and priority. Okay, so these are types of debentures. Next thing is issue of debentures for cash. Just like the way shares are issued for cash and for consideration other than cash, even debentures can be issued for cash or consideration other than cash. When company issues the debentures in what we call as for cash, debentures payable in full, that is lump sum, entire amount of debenture taken at one shot. Okay, and one more thing is debentures, unlike shares which are issued at par or premium, debentures can be issued at discount also. Debentures can be issued at discount. Look at the first problem. We'll try to see this with a problem here. Give journal entries for the issue of debentures from the following cases. Poinal Chemicals Limited issued 15 lakh. This is number, not rupees here. 15 lakh 10% debentures of 50 rupees each at a premium of 10%. Okay. Payable as 20 on application, balance on allotment. So what is the premium that they are collecting? 5 rupees. So issue price is 55, face value of the debentures 50. Debentures were redeemed at par after 6 years. All the money due on allotment was called up and received. Record the necessary entries when the monies are included. The money included is the premium part is included in application and the premium part is included in allotment money. That is, if the application is 20, in the first option, option A, they are asking you to divide the amount application money as 15 for debenture and 5 for premium. And in allotment, entire 20 will be application, the balance 30 will be, balance 35 will be divided into, yes, premium and this. Let's see the solution here. These are like, very simple. Bank account debit to debenture application form. Previously we wrote a share application, now we'll be writing it as debenture application. 3 crores is collected and debenture application is divided into 2 parts because in the first option the premium is included in application money. Debenture application account debit to securities premium. 15 lakh debentures at 5 rupees. 75 lakhs is the premium in the first option. 10% debentures, and always write the percentage before the debentures. Debenture account starts with a prefix of percentage all the time. Okay. Next, debenture allotment. What is the balance in debenture allotment? If 15 plus 5 is received, balance 35 will be received on allotment. Debenture allotment account debit 10% debentures, allotment due entry, and after that you are receiving the money into bank. And what is the value? 5 crore 25 lakh rupees is received. The same problem, if the premium is collected along with the allotment, not on application, unlike the previous one, bank account debit to debenture applications 3 crores, and here look at the thing, the previous one you split the amount into 2, 10% debentures and securities premium, but here 3 crores is completely towards 10% debentures. Now where will you split the amount? While writing the due entry for allotment account. Debenture allotment account debit to 10% debentures account 4.5 crores and securities premium 75, and you receive the amount into your bank account. Okay. Now option B, what is the second one? I think we have second 2 problems given in the same one. Atul Limited issued 1 crore 8% debentures of 100 each at a discount of 10%, redeemable at par at the end of 10 years. So these things are getting redeemed at a tenure after a tenure of 10 years. Money was payable as 30 on application 60. So where is the discount part? Did they give you a clarity? So what is by default? Discount is always, premium and discounts are by default considered in allotment only. Bank account debit 1 crore debentures of 30 crore rupees to debenture application. Debenture application to 8% debentures. These are 8% debentures. Yes. Okay. Next, debenture allotment account debit 60 crores. Discount on issue of debentures 10 crores to debenture 8% debentures account 70. Discount on issue of debentures is a loss. Bank account debit to debenture allotment account, you'll receive 60 crores. Simple. Basic problem. Next, what is the next thing? Debentures. Okay, just now we have discussed. Debentures can be issued in 3 different modes. What are they? Debentures can be issued at par, debentures can be issued at premium, and debentures can be issued at discount. But when it comes to redemption, debentures will be redeemed at par or debentures will be redeemed at premium, but they will not be, practically they will not be redeemed at discount. Okay, that is what is given. They gave you all the combinations here, 6 combinations, and look at the note, redemption at discount is a rare case in practical life. It will not be the case there. Next, what is the next thing? Let's see the next problem. Debentures issued as what are we called as collateral security. So what is this collateral security? At times when companies they approach, no, there's a regular problem here. Debentures, give journal entries for the issue of debentures from the following thing. Modern Equipment Limited issued 4 lakh 12% debentures of 100 payable as follows. On application 30, now they are taking it in multiple installments now. On allotment 70, applications were received for 4 lakhs 20. Now, can they go for pro rata allotment? No concept of pro rata allotment in debentures. Excess application money was refunded on the same date. All the money was duly received. As per the terms of issue, the debentures are redeemable at 110. That is, at the time of taking the money, you are taking 100, but you are giving a commitment that you will be repaying it at 110. That is 10 rupees extra, which means that You are giving a commitment that in future you will pay 10 rupees extra, which is a loss to you, future loss. For that, we have to write the entry now itself. Okay. Now, look at the entries here. Journal entries in the books of Modern Equipment Limited. How many debenture applications have been received? 4,20,000. Bank account debit to 12% debenture application. They have divided, they don't write the amounts in what we call the 6 digits or 8 digits and all that. Try to condense them. These amounts are in lakhs. So 126 lakhs. Okay. After that, look at the thing. 12% debentures account debit to bank. What is this? Refund on excess. Okay. Because we have received 20,000 debentures, excess money. Next entry, 12% debenture application account and 12% debentures account, 120 lakhs. And look at this entry. 12% debenture allotment account, 4 lakh debentures at 70. And we have accounted for what do we call as the loss, future loss. Loss on issue of debentures, you are giving a commitment that in future you will pay 40 extra. And this thing is called as what? Debenture redemption premium. Okay. One nominal account and the other one is a liability account that is created. Yeah. Next thing, bank account debit to 12% debenture allotment. How much will you receive? Only 280 rupees. This is a future thing. We are just accounting for that and we are keeping it there. Okay. Next, what is the second one? Agrotech Limited issued 1 crore 50 lakh 9% debentures of 100 rupees each at a discount of 6%, which comes to 6 rupees. Redeemable at a premium of 5% after 3 years. Payable as 50 on application and 44 on allotment. So these guys, initially they are offering what we call as discount. 6 rupees is the current loss that they are making. Out of 100 rupees, 6%, and the balance on redemption, 44. Okay. Look at the entries here. So how much are they receiving on application? Bank account debit, 1 crore 50 lakh debentures at 50 rupees on application comes to 7,500 lakhs to debenture application, and this is closed. The twist is there in the allotment thing. Look at the thing. Debenture allotment account debit, 1 crore 50 lakh debentures, 44 rupees, 6,600. Loss on issue of debentures, 1,650. How is it 1,650? You are giving a commitment that you will be repaying it along with premium. What is the breakup? They must have given you the breakup here. See, loss on issue of debentures, amount of discount on issue, that is current loss plus premium payable on redemption into number of debentures, 6% and 5%. Total put together 11 rupees into 150. That comes to 1,650 lakhs here. Okay, this is a combination actually, discount slash loss or loss slash discount. Two things. Technically, you have to write it as loss slash discount or discount slash loss. Two amounts combined, right? And after that, bank account debit to debenture allotment account. Let's see the next problem. Country Crafts Limited issued 1 lakh 8% debentures of 100 each at a premium of 5%. So at the time of collecting the money, they are collecting 105. Fully on application and redeemable at a premium of 10. So at the time of collecting, they are collecting 5 rupees more and they are giving a commitment that they will be paying 10 rupees more. So, see the thing, bank account debit to debenture application, done. And next one is, see the thing, what is the breakup of this? Debenture application 10,500. Out of this 10,500, we are transferring it to what? Premium 500 and debentures 10,000. What is the story of this 1,000? This is again a isolated entry where you are giving a commitment that 10% extra will be given at the time of redemption. So loss on issue of debentures to premium on redemption, 1,000. Okay, this is altogether a separate entry. We are just writing it together in the allotment entry. Next, issue of shares as collateral security. What is this collateral security? Okay, whenever a company is approaching for a loan from a financial institution, it will be serving them with a primary security. If the bank insists upon some additional security or collateral security, companies usually they will issue debentures as collateral, additional security. Already primary is given. In addition to that, they will be giving a secondary or collateral additional security. And what is the accounting treatment here? Method 1, no entry is made. Why no entry is required? Because these debentures are not subject to any sort of interest. We are giving them as collateral security. Okay. Or you write an entry, debenture suspense account debit to percentage debentures account, in order to avoid the confusion, because when you have taken a loan from a bank, you are already serving that bank with interest. Again, will you pay interest on debentures to the bank? No. That is the reason why no entry is usually. This is a first method actually. Always go with first method. But if the problem is prompting very clearly to write an entry, then write as debenture suspense account debit to 10% debentures account. Okay. To get the thing, students should note that method 1 is more logical from accounting point of view. Therefore, it is advised to follow method. But if the problem specifically says that no, you have to write, then we write the entry. CRD problem number 3. X Limited obtains 10% loan from IDBI of 1 crore, giving a collateral security of 1.5 crores of 10 each, 14% first mortgage debentures. So they are giving collateral itself is more than the loan amount. How do they do the accounting? First, bank account debit to IDBI loan 1 crore. What does method 1 says? Method 1 says that no entry is required, but only a note to, yes, note will be given. Under this method, no entry is made in the books of the accounts of the company at the time of making issue of debentures. In the notes to accounts of the balance sheet of X Limited, it is shown. Notes to accounts, extract, okay. Secured loans, in that IDBI loan, and below that we will be writing it as collateral security by issue of 1.5 crore, 14% first mortgage debentures. Just a note is made under first method. Second method, we will be writing an entry, debenture suspense account debit to 14% mortgage debentures, first mortgage debentures 1.5. Okay. Next, this was the thing. Now, issue of debentures for consideration other than cash. We have already seen the same thing in shares also. Okay, under different thing, when a complete business is acquired or only assets are acquired, promoters are given. Yes, right, the same thing. Issue of debentures for consideration other than cash. They are giving you share debentures for consideration other than. Let's see that in a problem here. X Company Limited issued 10,000 14% debentures of nominal value 50 lakhs as following. To sundry persons for a cash at 90% of nominal value 25 lakhs. They are giving this to general public. And next one is to a vendor for purchase of fixed asset worth 10 lakhs, 12 lakh 50,000 nominal value is issued. And for banker as a collateral security, just now we have seen collateral security of 10 lakhs loan, you are giving that. So what is the accounting treatment? Let's see the accounting treatment. Fourth one, bank account debit to debenture applications 22 lakhs 50,000. Why? Because you are offering 50 per 50. What is the face value of the debentures? 50 lakhs divided by 10,500 rupees is the face value of the debenture. You are offering it at 10% discount, which comes to 50. 450 rupees is the issue price, right? That's why it is multiplied with 450. Clear? Next, what is the next one? Debenture application account debit, discount on issue of debentures to 14% discount, 14% debentures account. Now we are accounting for, we are closing this debenture application and we are accounting for 2 lakhs 50,000 rupees discount. How did I arrive at this 2 lakhs 50,000? 5,000 debentures into 50 rupees discount. Next, fixed assets are purchased, and as against this fixed assets, what is the value of fixed assets? You are purchasing fixed assets worth 10 lakhs. For that, entry will be fixed assets account debit to vendor. No name of vendor is given. Then you are issuing, vendor account is closed. Discount on issue of debentures. You are offering it at discount. You are giving 12 lakhs 50,000 worth of debentures in exchange of an asset worth 10 lakhs only. Discount on issue 2 lakhs 50,000. And next one is bank account debit to bank loan. You are getting a loan of 10 lakhs. And in this, we are going with the first method. No entry is passed. Or if the problem is insisting, you write it as what? Debenture suspense account debit to percentage debentures account. Okay, this is your problem number 4, where debentures are issued as collateral security. The next one, what is the accounting treatment for this discount slash loss on issue of debentures? Two losses are there. Present loss, if you are issuing the debentures at discount, that is your present loss. And if you are giving a commitment, the company gives a commitment that in future, at the time of redemption after 5 years or 10 years, we will redeem it at premium. That future premium, whatever is payable, is also, yes, it is a loss, which is a future loss, right? So what is the accounting treatment of that? It will be debited to profit and loss account over a period of time of debentures. For example, if the debentures are having a life of 5 years, now it depends upon the procedure of redemption. If the debentures are written off over a period of time, that is every year, at a particular percentage. Say 5 years is the life of the debentures. Every year company will draw 20%. Company will redeem 20%. Then we'll be using a method called a sum of years digit method that you have done in your depreciation chapter. Same method. Or if they say that the redemption will happen only after 5 years, then we will go for fixed installment method for writing off the discount or loss on issue of debentures. The same thing is given in your CRT problem number 5. Look at the problem here. Yes. HDC Limited issued 2 lakhs 12% debentures of 10 rupees each at 9 rupees 40 paisa. So immediately the company is making a loss of 60 paisa because they are issuing debentures at 60 paisa each discount. On 1st January 2020, under the terms of issue, 1/5 of the debenture is annually redeemed by drawings. The first redemption occurs on 31st December 2020. Calculate the amount of discount to be written off. They are asking you only to write off or calculate the amount to be written off as yes. So, what is the calculation procedure? What did I tell you just now? When the company says that every year, life of the debentures is 5 years, every year 20% will be withdrawn. At the end of first year, 20% gone, balance left out is 80. At the end of second year, another 20 is gone, 60 is balanced. Like that, by the end of last year, fifth year, it will be 0. Okay. So it is in what ratio? Sum of years. What is n here? 5. N into n plus 1 by 2 gives us, right, look at the calculation here. Only calculation is asked. They didn't ask you for any accounting treatment. Years starting from 2020 to 2024. Debentures outstanding before redemption. At the beginning of the year, not at the end of the year. After redemption, we're talking about before redemption. Or simply take it as at the beginning of the year. What is the outstanding? 20 lakhs. Second year beginning, because second year beginning will be after redemption of 1/5 in the first year, end of first year. 16, 12, 8 and 4, they are in ratio of what? 5 is to 4 is to 3 is to 2 is to 1, and n into n plus 1 by 2 comes to 15. So first year, what is the discount amount first of all? 2 lakhs into 60 paisa comes to how much? 1,20,000 rupees. First year 5 by 15, 40,000 will be transferred to P&L account. Second year 32,000, third year 24, fourth year 16 and last year. So by the end of fifth year, entire 1,20,000 is gone. Now, in the same problem, if they say that, okay, in the same problem, they say that debentures are redeemable only after the expiry of fifth year or after completion of 5 years, then we will follow straight line method. Simple, 1,20,000 divided by 5 comes to how much? 20, 24,000. 24,000. That 24,000 will be charged every year. That is the difference. Okay. Next, what is the next thing? Interest on debentures. Interest is charged, and interest is a charge and it is not an appropriation. Just now we have discussed, company, it doesn't matter whether they have profits during the year or not, they have to serve this interest to the debenture holders. Payable on the face value. This particular debenture, just now we have discussed, every debenture's name will start with a prefix of percentage, and this percentage will be applied on face value, not on the issue price. Debentures may be originally issued at par or premium or discount, doesn't matter. We always calculate the interest on face value. Rate prefixed on debenture. Rates are prefixed. There will be no fluctuation in the rate. Tax deducted at source. Whenever the company is making the payment to the debenture holders, whenever they are crediting this money to their bank account, they will retain the amount and they will deposit it with the income tax department. Okay, and that is called as TDS. As against this, you will be receiving a tax certificate, TDS certificate. Okay, it doesn't matter whether the payment is made to the debenture holders or not. First thing that they have to do is, as on the due dates, as per Income Tax Act, they have to deposit this TDS into their account. No interest on debentures issued as collateral security. Why? Because just now we have seen already I've taken a loan, say 16% loan or 14% loan from bank. I'm serving that 14%. If you give interest again on this collateral debentures, what will happen? Yeah. So obviously we will not be paying any interest on debentures provided to a bank as collateral security. Okay. Now look at the accounting entries. Interest is a expense to them. Out of this interest, we'll be dividing that into two parts, debenture holders part and TDS part. One is payable to the debenture holders, the other one is payable to TDS, government. And we'll make payments to government and debenture holders individually, and interest eventually gets closed in profit and loss account. Look at the problem here. A company issued 12% debentures of the face value 10 lakhs, value is 10 lakhs at a discount of 10% on 1st January 2020. So we have to take care of what we call as discount on issue of debentures also. Debentures interest after deducting tax at TDS at 10% was payable on 30th June and 31st December. So twice in a year. All the debentures were to be redeemed after the expiry of 5 years. So these are to be redeemed after 5 years. Unlike in the previous problem where 1/5 is withdrawn by drawings every year. Okay. Period at premium at a period of 5% premium. So even future loss is there. Past journal entries. This is more like a comprehensive problem. Whatever we have done till now in debentures is everything is here, including the concept of TDS. Let's see the calculations and journal entries here. Bank account debit. How much did you receive? 9 lakhs. Out of 10 lakhs, if 10% gone, 9 lakhs bank account debit. Next one, discount / loss on issue of debentures. At the time of issue, you are making a loss of 1 lakh and you are giving a commitment that you will pay 50,000 extra on the face value. That is 5% here. Okay. So discount and loss put together comes to a value of 1 lakh 50,000 rupees here. To 12% debentures, 10 lakhs will be transferred. To debenture redemption premium, 50,000. Done. First entry is over. Next, on 30th June, this is as on 1st January 2020. On 30th June, this is first 6 months when the interest becomes due. Interest on debenture holders, 10 lakh value, face value is 10 lakhs, always calculate on face value into 12 by 100 upon 6 by 12, 60,000. Will you pay entire 60,000 to the debenture holder? No. Out of this, what is the TDS percentage? 10%. 6,000 will be retained, 54,000 will be deposited. Okay. Done. And after that, what is the next thing? I have to make the payment. TDS payable, they have passed a compound entry. TDS payable to government, debenture holders payment and bank. Next, again after 6 months, 31st December 2020, interest on debentures, second half of the year, 60,000, same calculations, no change. TDS payable again comes to 6,000, debenture holders 54,000. We'll make the payment now. TDS payable, debenture holders and bank, same entry. Next, at the end of the year, whenever they are closing books of accounts, profit and loss account debit to interest on debentures. How much did we pay? Total 60,000. See, when you see the interest on debentures, 60,000 plus 60,000, 1,20,000 is being closed. And what is the other entry? One more entry will come. Yes. Profit and loss account debit to discount / loss on issue of debentures. Debentures are being redeemed after 5 years. 1,50,000. Just now we have calculated the loss part and discount. And what is the method? Since they are redeemed at the end of the tenure of 5 years, debentures will be, discount on issue of debentures will be withdrawn in equal installments. That is over a period of time under straight line method. 1,50,000 divided by 5 brings it to 30,000. So this is it. Debentures. Chapter number 19, Financial Statements of Not-for-Profit Organizations, NPOs. So, what exactly is this NPO? An organization or an institution which is established not with a view to earn profit is called as a non-profit organization. The basic motive is these organizations, they are started for charitable purpose or for social purpose, for providing some sort of service to the society. Such organizations are termed as not-for-profit or non-profit organizations. Okay. Now, non-profit organization is a legal accounting entity, just like the way we are maintaining books of accounts for a regular business, which is started with a motive of profit. Even these non-profit organizations, they will also have what we call as a accounting thing. Okay. Now, what are these? Let us see some examples. Schools, colleges, universities, hospitals, libraries, Okay, and societies which are started for the promotion of art, culture, commerce, education, sports and religion. All these things are termed as, yeah, non-profit organizations. So financial statements of not-for-profit organizations, how exactly are they prepared? First and foremost thing is, these non-profit organizations are covered under Section 8 of Companies Act 2013. They must be registered just like the way a business is registered. Even these organizations must be registered under Companies Act 2013. Okay. There is a difference in final accounts prepared between profit-making organizations and not-for-profit organizations. Okay. Now here, what is that they will prepare? Look at the statements or accounts that they prepare. They prepare a receipts and payments account on cash basis, income and expenditure account on accrual basis, and balance sheet, the same old balance sheet what is prepared by a profit-making concern. Receipts and payments account is basically a summary. Okay, what is this receipts and payments account is? It is a summary of all the receipts and payments made by a not-for-profit organization during the year. It is complete 12 months summary of payments. Okay, look at the features here. And what is the basis? We are using cash basis of accounting here. Summary of cash and bank transaction. This thing is a combination of cash and bank transactions together. The sides of the account, just like the way we have a cash book, debit side will be writing receipts and credit side will be writing payments. Even this thing, debit side will be receipts and credit side will be payments. And capital and revenue, this account does not bifurcate, or it will not differentiate between what we call this, what are capital items and what are revenue items. That is, it doesn't matter whether it is a capital receipt or a capital payment or revenue receipt or revenue payment, it will be recorded in this particular account. And this account shows both cash and bank balances at one place. Okay, and not a part of double entry system. It is only a summary sort of thing wherein it shows how much of cash inflow has occurred and how much of cash outflow has occurred from an organization. It covers the entire 1 year period of thing. Okay. Surplus or deficit of an accounting period cannot be ascertained from this account. Now, why are we using the word surplus and deficit? Since these are non-profit organizations, the word profit or loss should not be used. Instead of that, we are using it as surplus and deficit. And this account, receipts and payment account, will not tell you what is the surplus or deficit that is made by a non-profit organization. Now, nature of the thing, it is an asset account. Basically, if you are looking at from modern approach, it is an asset, or real account if you are looking at the account from traditional point of view. Basis of accounting, obviously cash basis, no treatment of adjustments. Obviously, when something is prepared on cash basis, we cannot adjust anything. Only accounting records or accounts which are prepared on accrual basis will undergo something called as adjustments, right? Purpose, to understand the cash transactions, cash and bank transactions that have occurred in a non-profit organizations. And this thing will not have any sort of non-cash item because it is prepared on cash base. Okay. Now let's see that with what we call as preparation of a receipts and payments account. Let's see that with a what we call as example here. A small problem. The RD problem number one, the receipts and payments account for the Swaraj Club for the year ended 31st March 2020, where entrance fees is a receipt. It will go on to the debit side. Membership fees, receipt, all that we need to judge is whether it is a receipt or payment. Donations for club pavilion, 10,000. Foodstuff sales, receipt. Salaries and wages, payment. Purchase of foodstuff, payment. Contributions for construction of club pavilion, an expense, 11,000 outflow, payment. General expenses, payment, rates and taxes, and what do we call as bank charges. And look at the last detail. Cash balance, cash in hand, cash at bank. They gave you the opening balance as on April 1st and closing balance. Just like the way your cash book opens up with a opening balance, even this thing also starts with a opening balance, and closing balances are also given. Okay. So you're required to prepare a receipts and payments account. Simple thing. All receipts will go on to the debit side. Look at this thing. CRD problem number one, receipts and payments account of Swaraj Club for the year end so and so. To balance brought down. Okay, cash and bank balances on the debit side, opening balance, and bank may have overdraft balance. Just like the way if a bank has got OD balance, we'll be writing it on the credit side. All the receipts are here: entrance fees, membership fees, donations for club pavilion, sale of food stuff, and all the payments are given on the other side. Net of balance, you should be getting a balance 350 plus 590 and bifurcation. Okay, total this up. Yes. So this is basically just a simple cash book, a consolidated cash book for 1 year. Okay. What is the next thing that these people, they prepare. Let's go to preparation of income and expenditure account. What is this income and expenditure account? Just like the way we have a profit and loss account in a profit making organization, which tells you whether the business has earned a profit or it has sustained a loss. This income and expenditure account tells you whether we have surplus or deficit. Okay. So look at the thing, meaning of this income and expenditure account. The income and expenditure account is equivalent to profit and loss account. Okay. And it is prepared on what? Accrual basis or accrual principle. And this thing will have what? Only revenue items pertaining to that particular year. Okay. Unlike in receipts and payments account, it will not see whether a inflow or outflow is capital or revenue. And second thing is, it will not see whether the amount is related to the previous year or current year or the future year. It sees only one thing. Is it an inflow? Write it on the debit side, that is receipt side. Is it an outflow? Write it on the credit side. That's it. But this particular account, it records only revenue items, and capital items will go into balance sheet, and that too revenue items of current year only for this 12 months. Okay, if it is more than 12 months, we'll remove that excess and write that in balance sheet. If it is less than 12 months, we will add it and make it 12 months. Okay, let's try to understand the nature of this account. Nature of account is income and expenditure account is a revenue account prepared at the end of the accounting period to find out surplus or deficit. And what is the thing? It is prepared by matching expenses against the revenue of that particular period. So what is the idea? We are trying to match how much of revenues are received and how much of expenses are incurred. Square of that, we should get surplus or, and cash items and non-cash items like depreciations. Okay, all those things are recorded in this particular thing because it is prepared on accrual basis. Exclusion of items of capital nature. Obviously, all the capital items will go into balance sheet. It will have only revenue items. Unlike receipts and payment account, it will have both capital and revenue items. Current year items only. Just now we have discussed only current year items. Closing balance. What is the closing balance? The difference in debit side and credit side will be termed as surplus or deficit. Sides. Expenditure side. Debit side is expenditure side and credit side is income side. Basis of accounting. It is prepared on accrual basis. Receipts and payments account on cash basis. Period, it will have all the revenue items related to a particular period. And can I do adjustments? Yes. Just like the way you were doing adjustments in your profit and loss account for a profit making concern, all the adjustments are made in income and expenditure account as far as this non-profit organization is concerned. Revenue items only, obviously only revenue items. What are these revenue items? Expenses incurred in running the NPO or to run the day-to-day activity of an NPO, whatever are incurred during this 12 months are recorded here. Purpose, it is prepared to find out surplus or deficit. They just gave you a specimen, but we'll see that with the problem here. Let's see problem number 2. Okay, so following is the receipts and payments account of Newbird 40 Club for the year ended 31st March 2020. Receipts and payments account is given to you. Based on receipts and payments account, you're supposed to, yes, prepare a income and expenditure. I've just marked the adjustment. They gave you 4 adjustments, small adjustments. Okay, let's see the adjustments. First, we'll read the adjustment, then we'll see the solution. Receipts and payments account opening balance, they have 2,50,000 opening balance here. Okay, that could be cash and bank together. Subscriptions 2018, received subscriptions are 2018-19. And what is the year for which you are preparing this? This is for 19 and 20. So for the previous year 2018-19, you received 65,000, and for the current year received 3,55,000. Donations are there. Donations to the extent of whatever we call as 55,000, and entrance fees to the extent of 85,000. And all the payments made during the year are given here. Let's see the adjustments. What are the first one? Outstanding subscriptions for the year ended 31st March 2020 were 55,000, which means that whatever is shown here, 3,55,000, whatever they have shown here, this thing is, yes, we have another 55,000 rupees outstanding subscriptions yet to be received during current year. Now, will I record this 18 and 19 subscriptions in my income and expenditure account? No, they are related to the previous year. Okay, they will not be recorded here. We'll be recording only this 3,55,000 plus outstanding of 55. Okay, where is it shown? See the solution here. CRT problem number 2. Income and expenditure account of Newport 40 Club for the year ended 31st March 2020. Okay. Subscriptions, outstanding, outstanding. How much did they add? Only 55. And what is shown in the outer column is 4,10,000 rupees is shown, only current year. Just now we have discussed income and expenditure account purely pertains all the revenue items of current year. Done with the subscriptions. Let's go back to what we called as the problem. Okay. So what is the next thing? Adjustment. Outstanding salaries and wages for the year ended 31st March 2020 are 40. So adjustment number 2. Already you have paid 1,65,000 salaries and wages during the year. And what is that we are doing? How much is outstanding? 40,000. Now when you go back to solution, what is that they have done? Salaries. This is an expense. Outstanding salaries are added. 2,05,000 is the balance. Okay. Next one. What is next segment? Depreciation. Depreciate sports equipment for the year ended at whatever we call as 25% here. What is the value of sports equipment that is there? They didn't give us any opening balance. Sports equipment is given as 3,42,000, which is purchased during the year. And for that, we are providing depreciation at the rate of 25%. Obviously, income and expenditure account debit side. Let's see, where is it given? Depreciation here, depreciation on sports equipment. See the valuation, 25% on 3,42,000, which comes to 85,500. Next up, capitalize 50% of the entrance fees. So what is this entrance fees? We'll see that in the theory part when we discuss about balance sheets. Now, this is like, for taking the membership, you have to pay some entrance fees. Okay. That fees, and what is the accounting treatment? They said 50% to be capitalized. 50% capitalizing is adding it to the capital fund, and balance 50 is to be treated as revenue. So we'll be showing this in income and expenditure account credit side as entrance fees, 50% of it. Okay. So these are the adjustments. Basic adjustment, 4 adjustments are given. Rest of the thing is only thing that you have to do is identify them as expenditure or income and write them accordingly. Okay, opening balance will not come into this because this will be going into opening balance sheet and this will be going into your closing balance sheet, both brought downs and carried down. Subscription already done. Donations 55,000 will go on to the credit side of the account here. Donations, look at the donations part. 55,000, no adjustments being there. Next one is entrance fees. Just now we have adjusted. Let's go to the payment side. Office expenses, no adjustment. Where will you write? Office expenses will go here. Next, sports equipment, just now we have provided the depreciation on it. Telephone charges, electricity charges, traveling and conveyance, all these 3 expenses will go on to the expenditure side. These are the things here. Okay. Now, when we total up the credit side, we are getting a total of 5,07,500 minus all the items. Yes. Credit side is excess, that is income side is excess than expenditure side, the so-called thing, excess of income over expenditure, or we call it as surplus, and this 55,000 will be added to your capital fund, which will be there in your balance sheet. So this is all about the same concept what we apply in preparation of profit and loss account of a profit making organization. The similar kind of logic will be used here, except for we are calling it as income and expenditure account and profit is termed as surplus. Okay, let's go back to our what are we called as next topic here. Now you know the meaning of balance sheet. Balance sheet is a statement which is prepared to understand the financial position, but in NPO, if the problem is silent regarding the capital fund, okay, general fund or capital fund of a particular problem, if the problem is not giving you whatever we call as the capital fund amount, we have to prepare a opening balance sheet based on the information provided to you. So there will be 2 balance sheets that are to be prepared. You have to prepare the opening balance sheet in order to find out the balance of capital fund. Okay. And obviously we'll be preparing a balance sheet at the end of the year to know the financial position. Okay, let's try to understand some special items in NPO. Donations. What are these donations? When a donor gives money, specifying that this donation is, it can be coming in the form of whatever we call as cash or kind. Okay. Now donations are one of the important sources of revenues. Entrance or admission fees. Just now in problem number 2 we have seen entrance fees. In order to take the membership, you have to, what do we call this? pay membership fees or admission fees. And the treatment usually it will be given in the problem. Accordingly, we follow. Previously, we have seen capitalized 50%, or sometimes they will say that entrance fees has to be capitalized completely or to be treated as revenue completely. Depending upon the treatment, we do it. Subscription, this is one of the important source of revenue to a non-profit organization. What exactly is the subscription? It is the amount that is paid on annual basis by members to keep their membership intact. It is more like a renewal fees for membership. Okay, and one of the typical adjustment, most of the time we'll be adjusting this thing. Life membership fees, this is like one time thing which is added to, treated as capital receipt and added to the capital fund directly. Other things, just now we have seen donations, specific donations and general donations. Specific donation will not be what we call as routed through income and expenditure account. It will be shown as a separate item in the balance sheet because there is a specific purpose for which the donor has given you money. Okay, but if it is a general donation, the donor said that take this money and please fulfill your requirements. Use this money for whatever you need. Entrance fees, just now we are saying, should be capitalized by default. Okay, but the amount, if it is substantially low when compared to the balance sheet size, we can treat it as revenue item and route it through income and expenditure account rules. Legacies, what are these legacies? When a person writes a will stating that after his demise the property will go to the non-profit organization, okay, we call them as legacies. Okay, it is called as probate of will. A person's last wish is executed on a paper, and accordingly the NPO will receive this particular assets covered under the will after the demise of the person. Okay. A life membership, we have seen it just now. Endowment fund, what is this endowment fund? Uniqueness of endowment fund is only the income from this fund is disbursed to the, what do we call is given to the NPO. The NPO is not authorized to take the principal or the main source of revenue. For example, a donor, he gives some fixed, they gave fixed deposits to NPO. They have given fixed deposits and they call it as endowment thing. That is, this bank is supposed to give only interest to the NPO. The original deposit amount will not be given to the NPO. It will always remain with the bank, and only the income, whatever is generated from that, will be given to NPO, and that can be used by NPO for any purposes. It depends. Okay. See the thing. Only income from the donation is to be used for certain specific purpose. Again, they may specify accordingly. It should be used. Treatment of sale of old newspaper. This is again a sale of scrap and all that. We have seen it, regular thing. Sale of old fixed assets. If any profit is made, it will be credited. Loss is made, will be debited to income and expenditure account. Honorarium. Okay, whenever some prominent people or some celebrities they address, okay, a particular thing. Imagine like there is a non-profit organization which promotes culture, and some celebrity comes in and he gives what we call this thing. Or let us take it as like there is a hospital or a medical college. A prominent doctor comes in and delivers a lecture on a particular subject. In respect of him, we are paying something, and that is called as honorarium. In respect of them, we are giving something, and that cost, whatever is there, it will be treated as honorarium and it will be debited to income and expenditure account. Okay. Receipts and payments, expenses for special occasions and all that. At times, these non-profit organizations, they'll be conducting a lot of what we call as occasions. There'll be celebrations, something like dinners are organized, what do we call as cultural meet, sports meet, tournaments, all these things. So whatever money is received, okay, we can either write the net of proceeds. That is, expenditure is so much, and income generated from that is so much. If income is more, we'll show that as a profit. If expense are more, loss from so and so activity and all that. Sale of sports material. Usually, this is in case of sports clubs. Okay, they sell the equipment, and again the same treatment. It is a revenue item. Grant or aid from the government and other institutions. So what are these grants? Government says that if you fulfill this particular condition, we'll be giving you grants. Okay. So on fulfilling that, they will be getting grants. And again, these grants are like, general grant is it can be used for any purpose. And it is usually routed through income and expenditure account. Special grants are, these are grants which are given for a specific purpose, and NPO must use this fund only for that particular thing. So these grants are, grant is something that you receive on fulfillment of certain conditions. If all the conditions are affirmative, you get the money from government. Treatment of fund, general fund and specific fund. What is a general fund? This is a fund which can be used for any purpose. Okay. It is called as general fund. Usually we address it as capital fund. The first item that we write on the liabilities are a balance sheet. Okay. And what is this thing? In case of non-profit organizations, the excess of assets over liability is termed as general fund or capital fund or accumulated fund. It's like the way assets minus liabilities is equal to capital. This is the same. Next thing is the balance of income and expenditure account in the form of surplus or deficit is transferred to capital fund. Just like the way we transfer net profit, we add net profit, we'll minus net loss. The same thing is done. And look at the third point, a very important one. Point number 3. This fund does not carry any restrictions and the management is free to use it. The NPO's management or board or whatever is controlling it, they are free to use this particular money. Okay, that is why it is called as general fund or capital fund. Now, let's see the next one. What are these specific funds or special funds? Special funds. You receive these funds and these funds are meant for a specific purpose and they should be used only for that particular purpose. Prize fund. This you will have it in sports clubs and other things. Okay? Sports funds or prize funds, match fund, sports fund, building fund or the construction of building. The funds out of this must be used only for the purpose. They are not allowed to be what we call is used for any other purpose. The use of such fund is restricted either by the management or by the donor for a specified purpose only. Either donor restricts it or the management of NPO restricts the use of fund on its own. And look at the thing. The income and expenses related to these funds are directly adjusted to the concerned fund on the liability side of the balance sheet. Okay, where will you show a fund? Fund is basically something which gets onto liability side. If any income is there from this fund, how do they get the income on fund is when they invest this money outside the, yes, from whatever source of income is coming, that will not be routed through income and expenditure account. Any income on fund investments would be routed through fund only. It will not be routed through income and expenditure account. It will not go into simple thing. Don't take it to surplus. Don't add it to surplus. And let's see the next one. Balance sheet is, yeah, model number 1 from our examination point of view. Usually, what is that they will give you? Okay, they will give you a receipts and payments account and they'll ask you to prepare income and expenditure account, balance sheet, and if the capital fund information, usually it will not be provided, you may end up preparing a opening balance sheet as well. Okay, so in this model, let's try to understand, see this with a problem. Okay, adjustments are marked. Let's see the adjustments here. CRT problem number 3. Okay, they gave you what? They gave you a receipts and payments account of Mumbai Club and they are asking us to prepare income and expenditure account and balance sheet as on 31st December 2018. Receipts and payments account, opening balance, cash in hand, cash at bank is given. This will go into your opening balance sheet when we have to find out. Obviously, we have to find out the opening capital fund. Donations, subscriptions, entrance fees, interest on investments, interest received from banks, sale of old newspapers and sale of drama tickets. These are the receipts. Salaries, repair expenses, purchase of furniture, miscellaneous expenses, purchase of investments, insurance premium 200, billiards table, paper and ink 150 rupees, drama expenses, cash in hand and cash at bank. These are closing balances. So where do we write them? Cash in hand on the debit side will go into your opening balance sheet. Cash in hand and cash at bank at the closing end, this thing will go into your closing balance sheet. Now they gave you some adjustment, 5 to 6 adjustments are given. Let's mark them. Already I've marked them, we'll discuss them. First adjustment, subscriptions in arrears for 2018. That is, they have outstanding subscriptions to be received 900 and what is that we will do? Whatever is received during the year, to that we have to add that 900. The subscriptions is marked as A, 12,000 plus 900 and one more information. Subscriptions in advance for 2019 are 350. So out of this 12,000, we have subscriptions which are related to the next year, which are to be deducted. So 12,000 plus 900 minus 350. Next, insurance premium outstanding. Add outstanding insurance premium. That is your adjustment B. Insurance premium 200. To that 200, I'll be adding 40. Miscellaneous expenses prepaid. Less prepaid because it is not related to the current year. Miscellaneous expenses 500. Adjustment C 500 minus, how much is it? 90. So effectively only 14 rupees will be debited to your income and expenditure account. 50% of the donations are to be capitalized. That is, how much of donations are actually received? Donations received are 5,000. 2,500 will be credited to income and expenditure account, and 2,500 the balance will be added to the capital fund. Next, entrance fees are to be treated as a revenue income. So the problem is very clear that entrance fees should not be capitalized. Entrance fees should be routed through income and expenditure account. Eventually, it will come and get added to capital fund only, but routed through surplus. Okay. Indirect way of adding it to capital fund. So entrance fees adjustment E. 8% interest is accrued on investments for 5 months. So how much of investments did you purchase during the year? Interest on investments is given as 100, but what are the investments that you have purchased? Purchase of investment 6,000, and 6,000 8% for 5 months. What is the amount that you're getting? Calculate the amount. Yes, already I've received 100. So whatever is, if it is outstanding, it will not be in advance, it will be outstanding. We'll be adding that. We'll be seeing the solution, okay, while doing the solution thing. Billiards table costing 30,000 was purchased during the last year, and 22,000 was paid for it. That is, previously in the previous year 2000, yes, 17, they bought a billiard table. Here they gave us billiard table adjustment G 8,000. Means that purchased during the last year, at that time for 30,000 they paid 22, but the balance 8 is still pending, and that 8,000 rupees is paid here. And this will be appearing in your opening balance sheet. There will be a what do we call this creditor for billiards table. The supplier balance is still due to the extent of 8,000. Okay, let's see the solution now. A very simple problem. Income and expenditure account. They have prepared what? Balance sheet, and balance sheet opening, because if you observed in this problem, they didn't provide us, in order to prepare balance sheet I need capital fund, but they didn't give us any information, and we found the information by preparing the opening capital fund, opening cap what you call as balance sheet of Mumbai club as on 31st thing. And what is that we are doing? We are finding out the assets and liabilities which were there as on the last day of the previous year. Billiards table just now gave you information that 30,000 worth of billiards table was purchased during the last year. That goes in as your first asset. Okay. Cash in hand, cash at bank. Where are they? Opening 4,000 and 10,000. They will go into your opening balance sheet. That's it. And next thing is creditor for billiards table. Just now I told you 8,000 was still pending because last year you paid only 22 for that. So what is your difference? The difference is your capital fund. 36,000 is the capital fund which will be taken as the opening capital fund in your current year balance sheet. So to find out this figure, we have to prepare opening balance sheet in this model, this particular model problem. Okay. Now let's see the solution here. Adjustments are already marked and we have already discussed the adjustments. Let's complete what we called as this thing. Donations, adjustment D. It says that take half of it to income expenditure account. Donations, half of the donations are capitalized. Look at the thing. Donations shown as 5,000, less capitalized. Effectively, we have shown only half, and the balance will be added to your capital fund here. See, they have added to the capital fund after surplus. Done. Next one. What is the next thing? Subscriptions. Just now we have calculated. Let's go and confirm the amount. Subscriptions. What is that they have done? See the second adjustment. Subscriptions. Subscriptions as per receipts and payments account is 12,000. Add outstanding at the end of the year and less advance 2019. Effectively, we have got 12,550. And what is the status of this 900 and 350? 900 will be shown in your balance sheet as an asset and 350 will be shown as a liability. Let's go and confirm it. Outstanding subscriptions. Look at this. Outstanding subscriptions 900 and subscriptions received in advance for 2019 is shown as a liability. Twofold effect of adjustment. Done. Subscriptions are over. Entrance fees 1,000. What is the treatment that the problem is asking you to do? Entrance fees are to be treated as a revenue item. So take the entire amount and credit it to your income and expenditure account. Look at the thing. Do you have entrance fees here? Where is it? Income and expenditure account credit side. Look at the thing. Entrance fees completely credited to income and expenditure account. Next. Interest on investments 100. They gave you an adjustment. Adjustment F. What does adjustment F say? 8% interest has accrued on investments for 5 months. They purchased these investments just 5 months ago and they must have calculated thing. Interest on investments, look at the calculation here. 100 rupees plus received already. On that, what is that we are calculating? 6,000 into 8 by 100 into 5 by 12. 200 is outstanding. That will be shown as an asset again. 100 is already received, 200 is outstanding. In balance sheet, interest accrued, look at the thing. Interest accrued happens to be 200. Next, interest received from bank 400. I don't think any adjustments are there as far as this thing is concerned. So we can just directly write that in. Yes, interest received from bank, no adjustments being there. We'll be writing it as by interest received from bank 400. Done. Sale of old newspapers directly credited to income and expenditure account as sale of old newspapers here 150, no adjustments being there. Sale of drama tickets, we can write off the net amount. Just now I told you. Sale of drama tickets, expenses 1050. And how much revenue did you receive? Drama expenses, this is revenue part 1050. Expenses part is 500. So effectively you made 550 rupees profit. We can directly write it, or you can see the thing here. Sale of drama tickets is shown as 1050 and drama expenses here. On the contrary, you can write it as profit on sale of drama tickets as 550 on the credit side of income and expenditure account. Look at the next one. Receipt side is over. Let's see the payment side. Salaries, no adjustment is there. Repairs, no adjustment. So both these things will go into your income and expenditure account debit side. Salaries, repair expenses, no adjustments being there. Salaries here, repair expenses. Purchase of furniture, obviously this is a capital expenditure which will go into your balance sheet. We'll write purchase of furniture. Okay, furniture 6,000. No adjustment has been given in the problem. Maybe the furniture was purchased on the last day of the financial year. That is the reason why they are not providing any sort of depreciation on. Miscellaneous expenses adjustment C. 500 is already paid as miscellaneous expenses. They are asking you to adjust C. Miscellaneous expenses prepaid. So out of this, only 14 rupees pertains to the current year and the balance 90 is prepaid. So miscellaneous expenses in your income and expenditure account will appear at 410. Okay, look at the thing. Miscellaneous expenses 500, prepaid 410, and this 90 will be shown in our balance sheet as a prepaid expense. Miscellaneous expense 90 rupees here. So twofold effect of the adjustment done. Next thing is purchase of investments. It will go into your balance sheet and there is a accrued interest to the extent of 200. Just now we have concluded that will also be shown there. Balance sheet. Interest is already done. Investments are shown at what? 6,000 rupees here. And this 200 is accrued interest on those investments. Insurance premium adjustment B. What does it say? Adjustment B says that insurance premium is outstanding. Add outstanding. So what you paid is 200. It was due to the extent of 240. Okay. So in this income and expenditure account, we'll be debiting the insurance premium as 200 and 40 is added, 240, and this 40 rupees will be shown as a liability in the balance sheet. Insurance, outstanding insurance premium is shown as 40 rupees. Done. Next one is billiards table 8,000. Already we have written this 8,000 in our opening balance sheet, which is cleared in the current year. Okay. So already this thing is taken to our opening balance sheet. Okay. It will not have any impact, but it will be shown as an asset. Billiards table will appear as an asset in your balance sheet at 30,000. So don't write this 8,000 rupees again because the amount is already cleared. We have already cleared that in our opening balance sheet here. 8,000 rupees due towards billiards table. Next, paper and ink. It falls in stationery category. You can add a stationery or paper and ink directly to income and expenditure account. Paper and ink 150 done. Drama expenses, just now I've shown you. You can debit that to income and expenditure account. Cash in hand, cash at bank will go into your closing balance sheet. We've already discussed it. Closing balance sheet, cash in hand, cash at bank. Okay. Now, when you total up income and expenditure account, you should be getting a total on the credit side as 17,950 minus less the debit side amounts, excess of income over expenditure or so-called surplus 14,000 150. Okay. And what is that we will do? The same treatment what we give to a profit, net profit in profit and loss account, it will be taken to capital fund. Opening capital fund, just now we found out from the opening balance sheet. Add surplus. The surplus part is how much? And donations capitalized to be getting a capital fund of 52,650. Balance sheet total is a tallying on both the sides, 53,040. Done. So this is a basic problem on how income and expenditure account and balance sheet along with opening balance sheet is prepared based on the receipts and payments account that is given in the question. Okay. So this is model number 1. Let's see the next problem. Okay. Problem number 4. Now look at this problem number 4. The Sports Writers Club gives you the following receipts and payments account for the year ended March 31st, 2020. The receipts and payments account is given. We'll be discussing only adjustments in this. It is almost the same model problem which we have discussed this now. Okay. To balance brought down, obviously this thing will go into your opening balance sheet. Subscriptions, we have an adjustment number 5. I've already marked it. We'll be seeing the adjustments. Miscellaneous income 700, interest on fixed deposit 2000. Payment side, salaries are paid, rent and electricity, library books are purchased during the year. This is an asset which is acquired. Okay. Asset acquired. Magazines and newspapers, sundry expenses, sports equipment, and balance, closing balance of cash and bank, closing balance sheet, right? Next, what are the adjustments? Already I marked the adjustment. Let's see the adjustments. Salary is outstanding, but here they gave you outstanding at the end of the year and at the beginning of the year. Okay. Now, what is this? Look at the thing. As at March 31st, 2019 and 2020. These are current year outstandings. These are amounts to be paid or received during current year. And all these, the other side, whatever we have, they are all the amounts which are related to the previous year. And tentatively, these are the items which will go into our opening balance sheet. Right? Now, look at the thing. Salary is outstanding. What is that you will do with the current year outstanding? Add current year outstanding minus opening outstanding, because these 710 rupees salaries, whatever you're seeing here, these are the salaries of previous year which are paid during the current year. That we will adjust in salaries account. That is why I've given the numbering based on the order in which they are given in the problem. Salary is 1. Next one, outstanding rent and electricity at the end of the year, outstanding is 973. Add 973 minus 864. Outstanding for magazines and newspapers 340. Add 340 and minus 226. Okay. And what other expenses do we have? That's it. Sundry expenses, we have 10,278 given. In sundry expenses, we have an adjustment number 6 here. What is adjustment? Prepaid expenses are there. What is that we will do with prepaid expenses? Less prepaid 620 and add 417. Okay, these are paid during the last year which are pertaining to the current year. And for this, we'll be preparing a statement. We'll draw because 4 expenses are there. For 4 expenses, instead of doing them individually, the format is given where we write them individually. Okay, and after that, furniture at the beginning of the year. Look at the details here. We have to arrive at the opening capital fund also. Furniture is given, sports equipment is given, library books are given. In addition to that, we have opening balance here, cash, right? So let's see the solution for this. Let's start the CRD problem number 4, Sports Writers Club. You are preparing what do we call this? Balance sheet of Sports Writers Club, income and expenditure account, and again the closing balance sheet. The opening balance sheet is prepared here. As at 31st March, the balance sheet as at 31st March 2019. This is the opening balance sheet. Just now we have discussed. Furniture value is 9. Where are you taking this data from? We are taking this information from here. Furniture, sports equipment, and library books. 3 assets. 3 assets are gone here. Fixed deposits are there. You made a fixed deposit of how much? One more sentence point is given here. The closing value of furniture and sports equipment are to be determined after charging depreciation at of 10%, 20% respectively. We'll charge depreciation. And if any during the year, the club library books are revalued at the end of the year and they have value of 5,250. Right. So what is that they are doing? This is done. Fixed deposits are already there. Okay. Accrued interest. Now, what are the items? All these items, accrued interest part that will go in as an asset. Okay. And rest of the thing, outstanding subscriptions, they gave outstanding subscriptions here, subscriptions receivable 1002, all this data whatever is given under 2019 would go into your opening balance sheet. And after balancing it, three expenses were outstanding at the beginning of the year. These are expenses which would go into balance sheet, and most of them are assets here. Okay. Fixed deposit, interest accrued, subscriptions receivable. In fact, starting from this 20,002, entire all this list goes onto the asset side. Minus that, what is the balancing figure that you've got? You've got a balancing figure of 47,000 rupees as, and this thing is prepared as a part of your solution because they are asking you to prepare opening balance sheet as a part of solution. First part is club's opening balance sheet, income and expenditure account, and closing balance sheet. So we arrived at what we called as the capital fund as 47,000, which will be taken to your closing balance sheet. Capital fund 47,000, to that we will make the adjustments. Let's see the income and expenditure account thing. Subscriptions. What are the adjustments that are to be made to subscriptions? Subscriptions receivable. We add 1,575 and we deduct 1,263. Okay. Working notes is given. Go and check the working notes here. Working note number 5. Let's conclude the subscriptions thing first. Subscriptions part. What is given? Subscriptions received is given here. Receivable at the end of the current year is added minus received in advance at the outstanding at the beginning of the year. They are included in this. So 28,912 rupees are taken to your income and expenditure account as subscriptions. How much is credited to your income and expenditure account here? By subscriptions, 28,912 rupees. Next, miscellaneous income. I don't think it has got any adjustment. Interest on fixed deposits, 2,000. They gave you an adjustment. What is that? Interest accrued thereon is 500 and 500. At the end of the year, they were supposed to receive. These fixed deposits are eligible for interest at the rate of 10%. 20,000 into 10%, 2,000. Out of 2,000, you received only 1,500. Balance 15 is due. But your receipts and payment account says that we have received an interest of how much? 2,000. Out of this 2,500 is pertaining to the previous year. Balance 1,500 is pertaining to the current year. Eventually, both the amounts are same. So you can just directly write that. Okay, not a big adjustment at all. And what is the next thing? Accrued and all that. So debit side, credit side is over. Debit side, salaries part, working note number. Now let's go to this consolidated working note. They have prepared a working note which covers all the 4 expenses. Look at the thing. Okay, working notes is done in a table form. Salary is add outstanding at the end of the year and prepaid part is not there, and add less outstanding at the beginning of the year. You're getting salaries as 11,460. Rent and electricity same, outstanding at the end is added, at the beginning is deducted. Magazines and newspapers same, outstanding at the ending is added, outstanding at the beginning is closed, deducted from it. Sundry expenses, they have a prepaid situation. Less prepaid at the end of the year, add prepaid at the beginning of the year. That's the balance. So these things are taken to your income and expenditure account on the debit side. All the adjustments are made. And next thing, salaries, rent and electricity, magazines, sundry expenses done. Depreciation, they gave you a complete adjustment for depreciation below the problem. So they are asking you to depreciate what? Furniture at 10% and sports equipment at 20%. Accordingly, we will provide what we call as depreciation on them. They give you a depreciation chart. Yeah, opening value of sports equipment is given. This we will calculate it separately. Sports equipment part, the part of it. Opening balance is 7,200, which is given in your question. Sports equipment opening balance, and what is that they have given? Sports equipment gets depreciated at 20%. But there are purchase of sports equipment during the year. See, so add additions first. 1,000 rupees purchases are there. We are adding that first. Okay, purchases are added, and then we calculate the depreciation on the amount after adding the net. So depreciation 1,640 will go into income and expenditure account, and closing value of sports equipment will be shown in balance sheet as 6,560. Okay. Next, what is the next thing? Sports equipment is over. Library books is 750. They gave it very clearly. Library books adjustment is like Calculation of depreciation on library books. Opening balance was 5,000, purchased during the year 1,000, 6,000 minus closing balance. Instead of giving you the percentage on this, the problem is giving you the closing value of library books. So square of that, we get a balance of 750, which will be debited to your income and expenditure account. Okay. And obviously the balance 5,250 will be shown in balance sheet. We'll be seeing the balance sheet also. That's it. So after adjusting it, what is that you're getting? Depreciation and all that, 750, 1640, 960 on furniture. So excess of expenditure over income. In this problem, we are getting a deficit which will be deducted from your opening capital fund. 47,000 opening capital fund minus deficit of 2,888, and rest of the thing in place. Furniture less depreciation is shown. Sports equipment, library books, fixed deposits at 10%. Okay. Next, cash and bank, and all these things are prepaid expenses, outstanding subscriptions, and accrued interest. Okay. So this is one of the model of problem which you may come across, which will be given, where receipts and payment account is given, and from that you are supposed to prepare income and expenditure account, closing balance sheet, and for capital fund purposes we have to prepare opening balance sheet as well. This is one of the model. Let's see another model of problem here, wherein this is again the same thing. Receipts and payments account is given. Let's see another model problem. This is preparation of receipts and payments account from income and expenditure account. Question is giving you income and expenditure account, and it is asking you to prepare receipts and payments account. Look at the things. CRD problem number 8. The income and expenditure account of youth club for the year ended 2020 is as follows. Salaries, list of payments or expenditure for the year. These are current year expenses which are pertaining to this 12 months thing. Salaries 4,750, general expenses, audit fees, secretary's honorarium, stationery and printing, annual dinner expenses, interest and bank charges, depreciation and surplus. Okay, already we have a surplus here. Subscriptions, entrance fees, contributions for annual dinner and annual sports meet receipts. These are the incomes pertaining to the current year as such. And they gave you adjustments. I've marked the adjustments already. Let's see the adjustment. This account has been prepared after the following adjustment, because usually we prepare income and expenditure account by making the adjustments. So what are all the adjustments that are made? We have to reverse it now in order to find out what is the amount that is received or paid. So this account has been prepared after the following adjustments. Subscriptions outstanding at the end of 2019. Subscriptions received in advance on 31st December 2019. Subscriptions received in advance as on 31st December 2020. And subscriptions outstanding on 31st December 2020. So previously, what is that we were doing? By taking the amount that is received during the year from receipts and payments account, we were adding closing outstanding and we were deducting opening outstanding. Okay, we were deducting closing advance and adding open advance. That we will be reversing it now. It will be exactly the opposite of that. Okay, how do we do the adjustment? Let's see what do we call this adjustment of subscriptions here. Look at the thing. They gave you the subscriptions in the form of an account here. Okay, so subscriptions, where is it closed? Subscriptions part is received is given as 7,000. What is the value? 7,500 as per income and expenditure account. This will highlight. 7,500 is given in your income and expenditure. This is pertaining to the current year. Outstanding subscriptions at the beginning of the year will show a debit balance. Outstanding subscriptions at the beginning of the year will show a debit balance. We'll close it by writing the entry subscriptions account debit to outstanding subscriptions opening. Okay. Now, next, if opening subscriptions are there on the debit side, the closing subscriptions outstanding will go onto the credit side for adjustment purposes. Doesn't mean that it shows a credit balance. We are writing it only for adjustment purposes. Next thing, closing subscription, advance subscriptions received at the end of the year will show a liability credit balance. In order to close that, what is that we are doing? Look at the thing. Subscriptions received in advance at the end, that is closing, 270. If it is debited, obviously opening subscriptions will be credited. Net of difference, when you, yes, you're getting 7,170. This is the amount that is received as per receipts and payments account. Okay, so what is that we will write in receipts and payments account? Look at the receipts and payments account here. Receipts and payments account, subscriptions, working note number 1 here, 7,170. Next, subscription adjustment is over. Salaries. What is adjustment for salaries that is given? Salaries outstanding at the beginning and at the end of 2020 were respectively 400, 450. What is that we have to do? The salaries, whatever are given to you in income and expenditure account, are related to this year. Okay, usually what is that we will do? Add outstanding at the end of the year, but we minus outstanding at the end of the year. That is minus 450 plus 400. What is the amount that you're getting? Salaries 4,750. There it is, 4,700. Done. Let's see the next adjustment. General expenses include insurance premium to the extent of insurance prepaid to the extent of 60. What is the amount of general expenses that are charged to income and expenditure account here? General expenses are 300. This is after removing the prepaid insurance of 60, which means that general expenses before this adjustment was 560. That is what we'll be writing it. General expenses, where is it? Like 560 rupees here. Add the 60 part, 560 will be the thing. We're simply reversing whatever adjustments were previously made. Now adjustments are reversed in order to find out how much of cash is received or actually paid. Then our audit fees for 2020 was yet unpaid. In your income and expenditure account, you are showing the audit fees. Where is the audit fees? Yes, here audit fees is shown as 250. And what is that they are telling you? This audit fees for 2020 is audit fees for 2020 was yet to be unpaid. During 2020, audit fees for 2019 was paid. So actually, whatever you're showing in your income and expenditure account is 250 is outstanding audit fees. Okay, this audit fees, whatever is given here, it is outstanding. Okay, so that what is that we are adjusting? If current year is 250, we are adjusting last year outstanding at the end of last year to 450 rupees, and current year outstanding is minus net off. Instead of doing all this, 200 is paid, last year amount is paid, and current year is still outstanding. Okay, next, the club owned a freehold lease ground of 10,000. This is an asset that will go into a balance sheet. The club had a sports equipment as on 1st January 2020 valued at 2,600. Okay, at the end of the year after depreciation, the equipment amounted to 2,007. So what is that they are giving you is, at the beginning it was 2,600. They depreciated it. After depreciation, it comes to 2,700. So what is that we have to do? Find, like, did they purchase anything? So what is this depreciation? This depreciation, whatever 300 is shown here, it's purely towards depreciation on sports equipment. Okay, so if 2,600 is the value, after removing a depreciation of 300 to the existing closing value of 2,700, I will add the depreciation, make it 3,000. So if 3,000 rupees was the value and the beginning value is 2,600, how much is purchased during the year? The balance 400 was purchased as sports equipment. Is it given here? Sports equipment? Yes. Working note number 2 here. Sports equipment 400. 2,700 closing balance plus 300 depreciation gives you the value before depreciation, and difference between opening value and before depreciation value is your acquisition during the year. Next, in 2019, the club has raised a loan of 2,000. This was outstanding throughout 2020. On 31st December 2020, cash in hand amounted to 1,600. They are giving you the closing balance of what we call this thing. So what is the story of this club raised a loan? Do we have any surprise element of interest in this? So interest is what? How do we calculate the interest amount here? Interest paid is 150. Next, what is the next thing? Closing balance is given. Accordingly, though they are asking us to prepare only receipts and payment, rest of the things, whatever are there, they don't have any sort of adjustment. So we're just taking them directly from our question and we are writing them in the thing. Okay, interest and bank charges 150 direct, no adjustments are there. So all these items, secretary's honorarium, stationery and printing, annual dinner expenses, interest and bank charges will go on to the expenditure, will go on to the your payment side directly. Okay, how many payments? 1000, 450, 1500 and 150. No adjustments being there. Okay, and receipts part. Let's go to the other part. Entrance fees, contribution for annual dinner, annual sports meets, receipts. All these things will go on to your receipts side directly. And closing balance is given as the last item carried down is 1600. So what is the thing that we are doing here? You are preparing opening capital fund in order to find out, or opening balance sheet in order to find out the opening capital fund. You got the opening capital fund balance is 11,540. The same thing has been taken here, and accordingly we have prepared the balance sheet. Okay, whatever adjustments are done, those adjustments play a very key role in preparing these two statements. Okay, now sports equipment, we have done the adjustment here. Okay, that's what we have done, 400 rupees acquisition. Now let's see the next question, the next model, one more model which can be asked in your exam. Yes, preparation of receipts and payments account from income and expenditure account and balance sheet. The question will give you income and expenditure account as well as balance sheet, and you are supposed to prepare only receipts and payments account. Okay. So look at the problem here, problem number 9. I have already marked the adjustments. From the following income and expenditure account and balance sheet of a club, prepare its receipts and payments account and subscription account for the year ended 31st March 2020. So only receipts and payments account and subscriptions account here. Income and expenditure account is given. To upkeep of ground, they paid 10,000, or expenses related to the current year is 10,000. Printing 1,000 pertaining to the current year. Salaries, depreciation on furniture and rent. Subscriptions, sale of newspapers, lectures, entrance fees, miscellaneous expenses, income, and deficit. They already gave you a deficit here. In the balance sheet part, balance sheet has got subscriptions in advance. Okay, at the end of the year, they have advance subscriptions. Prize fund, they have a separate fund called as prize fund, and they have got investments, and whatever income is related to this prize fund investments, okay, it will be routed through prize fund only. So any payments out of prize fund or any incomes of prize funds will be routed through balance sheet. See the thing, we have done that here. We'll be discussing it in a way when we are seeing the problem. So receipts and payments account, and what else is given here? Let's see the adjustments here. Adjustments, upkeep of ground 600 and printing 240 relating to 2018-19 were paid in 2019-20. So previous year outstandings were paid during the current year. One half of the entrance fees has been capitalized by transferring to general fund. Okay, this is adjustment B. One half of the entrance fees has been capitalized, and the balance of which means that effectively 2,600 is received. Subscriptions outstanding in 2018-19 were 800, and for 2019-20 700. Subscriptions received in advance in 2018-19 were 200, and thus. So he's asking very specifically to prepare what we call as subscriptions account. So first we will go for receipts and payments account, right? Receipts and payments account. Income and expenditure account is giving you 17,320 rupees as the subscription amount. Subscription is given as income and expenditure account 17,320, 17,320. We have to adjust 4 figures. Outstanding subscriptions at the end of the year and outstanding subscriptions at the beginning of the year. Then what is the next thing? We are adjusting the subscriptions, advanced subscriptions at the end of the year and advanced subscriptions at the beginning of the year. The balancing figure is 17,220. In this problem, we got the same amount. So subscriptions received actually are the same amount, because what we added and what we deducted must come to the same thing. Opening balancing figure, this we'll find out later. Subscriptions are 17,320. And interest on prize fund investments 1,000. This is given your question, balance sheet. Interest received is 1,000. Lecture fees 1,500. This is given directly, no adjustments being made to this particular thing. Lectures 1,500. Entrance fees, okay, 1,300 is here, and the balance 1,300 is added to the capital fund. Total put together 2,600 rupees is received as entrance fees. No change in lectures or lecture fees. Next one, miscellaneous income, no change. Okay. And deficit is already adjusted in your what do we call this general fund or capital fund. Next one, go back to the question and see. So sale of all newspapers, no adjustment being there, taken to the receipts and payments account directly. And what do we call this miscellaneous income 400. Okay. Now upkeep of grounds 10,600. Okay. What is that they are trying to tell you? There is a adjustment to be made in your upkeep of grounds. You have shown it as only 10,000. That 10,000 is pertaining to current year, but there was a outstanding which was cleared during the year. Upkeep of ground 600 and printing 240 related to 2018-19 were paid in the year. So amount paid towards upkeep of grounds totals to 10,600, and printing obviously 1,000 is debited to the current year thing, but actually paid is 1,240 rupees because it was given as outstanding part. This is your adjustment number one. One half of the entrance fees has been capitalized. We have already discussed it. Subscription adjustment is over. Total of the receipts and payments account. The closing balance will be taken. What is the closing balance that you're getting? The closing balance is already given in the problem, is it? Yeah. Closing balance is already given. Cash in hand 2,300. That we will take it to your, yes, by balance carried down is already given. The difference will be your balancing figure. The balancing figure opening balance is 4,660. Right? So this is your problem number 9, wherein the question is giving you income and expenditure account and it is asking you to prepare receipts and payments account and subscriptions account. Okay. Let's see the next question. This is an educational institution problem, okay, wherein we are dealing with the final accounts of an educational institution. From the following balances and particulars of Venkateshwara College, prepare income and expenditure account for the year ended 31st March 2020 and balance sheet as on that date. They gave you a list of accounts here. Or typically you can say that it is a trial balance that is given. And this is the only problem which is in trial balance model in our ICA material. And they gave you some adjustments here which are already marked. Let's see the content that is given in the question. Seminar and conference receipts. They have received 6,08,000. You will find what we called as seminar and conference expenses somewhere here. Seminar and conference expenses are given here. You can write the net of amount in your income and expenditure account. So out of this 6,08,000 square of 4,50,000, the balance will be taken to your income and expenditure. Okay. Security deposit students. This is an educational institution problem. This could be a library deposit where this money is kept by management as a caution deposit or security deposit, and this money is a refundable amount. 1,50,000 has to be refunded to the students. So this will be shown as a liability. It will not be shown as an income. This amount, best example is your library deposit. If you want books, you have to pay some security deposit, and when you're leaving the institution, you can, yes, surrender the card and take your deposit back. So it's basically a liability. Capital fund is obviously a liability that will go into a balance sheet. Tuition fees received. Okay, it's more like reimbursements received from the government side. Tuition fees receivable from government for backward class scholarships. Scholars are 80,000. So we have an adjustment. This thing has to be added. Outstanding part, income and expenditure account will be showing it as 10,35,000 plus 80,000 rupees. Government grants, by default, they have to be taken to what do we call this? Income and expenditure account only, because these are not specific grants. These are general. They didn't give you government grants for what purpose? Purpose is not mentioned. Yes. Next thing, hostel room rent. These are like hostel rooms and all that. Mess receipts are there to the extent of 2 lakhs. This is again a income and expenditure account item. And college store, sale of stores and supplies. They have a store where they sell the stationery items or food, eatery items and all that. So they have received something like 7,50,000. We have an adjustment number 3. What is that adjustment number 3? Store selling price are fixed to give a net profit of 10% on selling price. So this particular stores, they are selling the item in the stores at 10% of profit. So this is selling price is 7,50,000. Upon that 10% on selling price, not on cost. So 75,000, 6 lakhs, 75,000. That is the cost of stores and spares or cost of stores and supplies sold during the year. Okay. And one more thing is they are giving the stock levels also in a continuity. At the beginning of the year, there was 3 lakh rupees worth of stock that was there in the store, and during the year they have purchased it. So we can find out how much is sold and how much is there in the stock. And salaries are given, teaching staff and research staff. Scholarships, these are like, next one is like games and sports expenses. Investments are there, seminar run, conference, consultation expenses. Scholarships given by the management to the students. These are paid by the scholarships. Are grants are different. What we have seen is backward scholarships and all that. This is like scholarships given by the management, which is an expense to them. Next one is consultancy expenses. Furniture, we have an adjustment. Yeah, and one more twist in the problem is only for furniture and fittings. Usually, educational institutions will have a major asset in the form of a huge amount of investment will be there when it comes to furniture. Okay. So, what is that they have done is they are following provisioning method for depreciation on furniture. Original cost of the furniture here, historical cost of the furniture is 6 lakhs. Until now, they have already provided 3 lakhs 36,000. Accumulated depreciation is 336. Okay. And how much depreciation is being asked to provide? Depreciation is to be provided on straight line basis, furniture and fixtures, 10%. So 10% on what? On 6 lakhs. 60,000 shall be added to this provision for depreciation or accumulated depreciation from 3 lakhs 36,000 plus 60,000, 3 lakhs 96,000. We'll be seeing the solution very soon. Okay. And when it comes to motor vehicles, usually educational institutions, a major part of it will be buildings and furniture and fixtures. And in a way, they also have motor vehicles for transporting students and all that. These motor vehicles are there to the extent of 1,80,000. And on that, what is that you are doing? 20% on that we are providing it. Okay, this is WDV given. 6 lakhs is furniture cost, historical cost. 1,80,000 is the WDV. No, we have to see, check the thing. Okay, next. So what is it we are doing? We are preparing income and expenditure account. Okay. What is the first item? Let's go with the solution. Tuition fees received 10 lakhs 35,000 received already. Just now we have discussed the adjustment. 80,000 is added. 11 lakhs 15,000. And where do we show this again? We will obviously show this 80,000 again in our balance sheet, as this is receivable on the asset side. Let's check that. Balance sheet, tuition fees receivable, 80,000 rupees. Next, government grants 5 lakhs. Okay, yeah. Just now I told you government grants, they are not given for a specific purpose. Since the purpose is not mentioned by the government, they are to be treated as revenue item only and credited to your income and expenditure account as such. Government grants are credited to your income. If the purpose is specified, I would have taken it to what we call this balance sheet. The next one, what is the next one? Get the question here. Let's go in the order of the solution only. Seminar and conference receipts. Just we have both. Receipts are given and expenses are given. Square of that, what is that we are getting? The first thing that we have discussed, 6 lakhs 8,000 minus seminar expenses of net of we have 1 lakh 58,000 profit on conduct of this particular seminar. And rest of the things are straight. Hostel room rent, get your trial balance. Hostel room rents 1,75,000. Mess receipts are given as what do we call this? 2 lakhs. These two items, they go straight into your. Okay. Now, what is the next thing that we are dealing here? Like profit on stores and thing. They gave you 7,50,000 rupees worth of stores are sold during the year, correct? Here. And these things are sold at 10% profit. So how much profit is being made by the institution here? 75,000. And the 75,000 will help us out in finding out what do we call as the cost of stores and spare supplies sold during the year. So out of 7 lakhs 50,000 minus 75,000, 6 lakhs 75,000 is the cost. And this 6 lakhs 75,000 will be used in finding out the balance, if any, of stores and supplies. How do I find out? Opening stock is given as what? Opening stock is given as 3 lakhs. Purchases made during the year are given as 8 lakhs. Total 11. And in adjustments, they gave you one more adjustment to be made. Material supplies consumed by staff given here Teaching staff and research staff have consumed 50 and 1 lakh 50, 2 lakhs. So how do we arrive at the closing stock of stores and supplies is opening stock plus purchases minus cost of sales of supplies 6,75,000 minus that. I think a clear working notes has been given here below the solution. See the calculation. Yeah. Computation of closing stock of stores and supplies. Opening balance is 3 lakhs, 8 lakhs rupees purchased during the year, 11 lakhs was the total available. And out of that, sold is 6 lakhs 75,000 after deducting the profit margin, and consumed by the staff 2 lakhs. We have 2 lakhs 25,000 closing stock of stores and supplies, which will be going into our balance sheet here. 2 lakhs 25,000 rupees. Next, what is the next thing? So credit side, that is income side of it is over. Let's see the expenditure side. What are the expenditures that are made? Stores, supplies, or salaries is the first one. All the debit accounts now. Salaries, teaching and research salaries, no adjustment being there, taken directly to your income and expenditure account here. Teaching staff and research staff, done. Next one is scholarships, 1,18,000. Medal consumed, yeah, medal consumed, again we'll be writing it as 2 lakhs. This has been expensed by the college. 2 lakh rupees consumed by the staff. Next one, scholarships, straight away 1,18,000. Next thing is games and sports, no adjustments being there, taken to income and expenditure account. Investments will go into your balance sheet. Investments made will go into your balance sheet as such. Okay, done. Seminar conference expenses, we have already adjusted this. Consultancy expenses, no adjustment being there. Okay, it will be taken to your income and expenditure account. Consultancy expenses. Furniture, just now we have calculated, we have a provisioning method, it will be charged, but in balance sheet we'll be showing the furniture at its original cost. And 1,80,000 is the cost, it is not the WDV on that because no information is provided, and they are asking us to calculate on straight line basis. 1,80,000, yes, straight away 20% on that. That will go into your income and expenditure account again as depreciation on furniture. So that's most of your income and expenditure account, and rest of the things, furniture and motor vehicles, asset side is done, cash and bank balance is given, closing balances, capital fund balances are given in your trial balance very clearly. Capital fund is here, 31 lakhs 46,000. And what else is provided to us? Capital fund, security, yeah, security deposit of 1,50,000. We have discussed the first thing. Security deposit to the students will be taken as a liability because this is a refundable amount, library deposits and other things. Next, I think we're done with almost all the adjustments. So if you total up income and expenditure account, you should be getting a surplus of 6,49,000, which will be transferred to your balance sheet. 6,49,000 here. The capital fund closing balance will be 37,95,000. Balance sheet, do we have a agreed balance sheet? 39,45,000. All right, let's continue with a comprehensive problem. CRT problem number 11. Summary of Research and Payments account of Bombay Medical Aid Society for the year ended 31st December 2020 is as follows. They gave you a list of payments and receipts, and they gave you additional information here. Okay. And what is that you're required to prepare? You're required to prepare a receipts and payments account, income and expenditure account, and a balance sheet. So you have to prepare all the entire set of financials, 2 accounts and a statement. Okay. Now let's see what are all the list of payments and receipts are given. Opening cash balance is given 8,000. Subscriptions received during the year are 50,000. Donations received are 15,000. Raised for meeting revenue expenses, yes, to be credited to income and expenditure account. Interest on investments at a rate of 9% per annum comes to 9,000. Payment for medicine supplies 30,000. During the year, this particular Bombay Medical Aid Society, they paid 30,000 rupees to the medical supplier or medicine supplier. Okay. Honorarium to the doctor 10,000. Salary is 28,000. Sundry expenses are 1,000. Equipment purchase is 15,000. Charity show expenses were 1,500 and charity show collections were 2,500. Now, what is the additional information that is provided to us? Subscriptions due. What is that we will do? I'll be writing this 50,000 in my receipts and payments account. and I'll be adjusting the subscriptions due and subscriptions received in advance. Okay, we'll take care of the calculations now. Let's complete the problem first. Stock of medicines. They had 10,000 worth of stock of medicines at the beginning of the year, and at the close of the year, they have got 15,000 worth of medicines in their godown. And amount due for medicine supply, that is, this Bombay Medical Aid Society, they are purchasing medicines from a supplier or a pharmaceutical company on credit basis. Now, what is the value? 9,000 was the opening due, and at the end of the year, 13,000 is due. Value of equipment at the beginning of the year is 21,000, and just now we have seen, I think they have purchased some equipment during the year. Is it? How much of equipment purchased during the year is 15,000. Net of whatever closing value is there, that will become your depreciation on equipment. Value of building at the beginning of the year is 50, at the end of the year is 48, and the difference should be taken as depreciation. No additions are there to the building as such, right? So let's see the receipts and payments account. How many receipts are there in this? Opening balance, this will go as to balance brought down. Receipts and payments account of Bombay Medical Aid Society for the year ended 31st December 2020. To balance brought down or cash in hand, either ways it will be 8,000. Then we have subscription, receipt, subscription 50,000 on the debit side. Donations 15,000, 15,000 donations. Interest on investment is received. This is again a receipt 9,000. Payment for medicines. This is a payment that you are making. It will be going on to the credit side by medicine supplier. Actually, supplies like medicine supplier or the pharmaceutical company. 30,000 rupees. Honorarium to the doctor. You paid 10,000 rupees in honor of a doctor who must have addressed some sort of seminar, or he must have done something for them. So in respect of him, they have paid 10,000. Then salaries are paid to the extent of 28, sundry expenses, equipment purchase, charity show expenses. All these four things: salaries, sundry expenses, equipment purchase, charity show expenses. All four payments will go on to the credit side. Salaries, sundry expenses, purchase of equipment, charity show expenses. And what is the last thing? Charity show collections. This will go on to the debit side. Goes on to the debit side. Charity show collections here. Last one. Okay. So we are done with what we call this receipts and payments account. Okay, these are all adjustments to be done in your income and expenditure account. So what is the balance, closing cash balance? You should be getting 9,000 closing balance. Debit side 94,500 minus credit side 86, right? This was your receipts and payments account. Now we have to prepare income and expenditure account. Okay. First thing, opening balance will not come. Subscriptions adjustment. If 50,000 is received, how much is pertaining to the current year? First thing, subscriptions due. What is it I'll do with the closing outstanding? 2,200 should be added because this is due. What is that we'll do with the 1,500 part? Should be deducted because this is previous year subscriptions received in the current year. Next, advance subscriptions. What will I do with the 700? Minus, because this is related to the next year, minus 700. Add 1,200. These are opening advance which are related to the current year. So what is the amount that you're getting? Check that in the solution. Calculation of subscriptions, 50,000, 1,500 plus. These two things are subtracted and added. Are we getting 51,200? Subscriptions at the end of the current year, okay, receivables are to be added. That's what they have done. Add this. Subscriptions at the receivable at the beginning of the year should be deducted. That's what we have done, right? So are we getting 51,200? This is the amount that will go into your income and expenditure account. Okay, let's see the solution part. Income and expenditure account created by subscriptions, 51,200. Done. Next, donations raised for meeting revenue expenses. Donations will go here. No adjustment being given. Next one is investments or interest on investments at what we call as 9,000. 9% is 9,000. Okay, this will go into your income and expenditure account. Next one is payment for medicine supply, 30,000. During the year, you paid 30,000 to the medicine supplier. Let us understand this adjustment. How much of amount was due actually? See this amount due for medicine supply. At the beginning of the year, supplier was supposed to be paid 9,000. and at the end of the year 13,000. When I adjust this payment of 30,000 in the account of trade payable, the so-called supplier of medicines, I will get to know what is the purchases, what is the amount of purchase that are made by this particular Bombay Medical Aid Society, right? So trade payable account, opening balance, credit side by balance brought down 9,000, okay, and debit side to balance carried down is 13,000. And when you make payment to the supplier, supplier account will be debited, supplier account debit on the debit side to bank 30,000. So what do we have here? 30,000 plus 13,000 minus 9,000. How much did you purchase during the year? 34. Let's check that in the working notes here. So first I have to find out the purchase value. Actually, they calculated it in what we called as a statement form. I gave it in an account form. Okay. Calculation of purchase. Payment made during the year 30,000. Amount, less amount of medicine supplied 1st January 2020. This 9,000 is deducted. Why? Because this particular 9,000 was due for the medicines which were taken in the previous year and which is cleared in the current year. That is, out of this 30, 9,000 is related to previous year medicines taken by them, and balance 21 is pertaining to the current year which is paid. And still we are saying that current year outstanding is 13. Total put together, when I add how much is paid and what is still due, I'll get the balancing figure. That is your purchases. So 34,000 worth of medicines are purchased during the year, and I don't need how much is purchased. I want how much is consumed, how much is distributed. For that, I have to reconcile the stock of medicines thing. So what is the stock of medicines that you have? Stock of medicines is given as 10,000 opening, closing 15,000. 10,000 plus 34,000 purchase, 44, 44 minus 15. Okay, let's see that calculation here. The second working note. Calculation of medicines consumed during the year. 10,000 opening plus purchase 34. We have taken it from here, 34,000. And what is the thing? 44,000 minus 15,000 closing balance. 29,000 rupees is your medicines consumed or medicines distributed by this Bombay Medical Aid Society. Okay, that will go into our income and expenditure account. Look at the income and expenditure account. Debit side, medicines consumed, working note number 3. Next, honorarium to the doctor. So payment to the medicine supplies is over. Honorarium to the doctor 10,000, no adjustments. Okay, because only equipment and building have got the adjustments here. Honorarium to the doctor, expense to be debited to income and expenditure account. Salaries 28,000 to be debited to income and expenditure account 28,000. Then we have sundry expenses debited to income and expenditure account. And now we will calculate, this is purchase of equipment and charity show expenses. Net of how much profit did you make? 11,000 rupees profit on charity show expenses. See, the profit on charity expenses 11,000. So we are left out with only one part, that is one adjustment. Value of equipment. So what is the opening balance of equipment? 21,000. How much did you acquire during the year? 15,000. 21 plus 15, 36,000. At the end of the year, if the balance is given as 30, obviously the balance 6 due 6, whatever is their gap, that is your depreciation, which will go into your depreciation on equipment 6,000. Buildings. Buildings are 50,000 and no additions being there. Do we have any additions here? No. No additions are being made to the building. So 50,000 minus 48,000, 2,000 is the value of done. Income and expenditure account is over. Calculated thing, are we getting 86,200 on the credit side, income side, minus all the expenses? Do we have a surplus of 10,200? Done. What is the thing left out now? We're left out with what? Balance sheet, right? For balance sheet purpose, first and foremost thing is I need what we call as opening capital fund. Okay, look at the thing. How did they arrive at this opening balance of 1,80,300? Let's go to the working notes and check. Yeah, opening balance sheet. Buildings are given, all the list, whatever is provided in the question, these things, out of them, I'll pick up the assets. First and foremost thing is opening cash balance of current year was closing balance of previous year. This is one. Next one is they are giving you a hint that interest on investments, if it is 9%, comes to 9,000. When we reciprocate, we get 1 lakh as the value of investments that will go into your balance sheet. We have value of equipment and value of buildings here. And liability side, we have what? Stock of medicines, 10,000 is to be paid to the supplier. And subscriptions, 1,500 and 1,200 will go into your opening balance sheet. Look at the thing. Buildings, 50,000. Equipment, 21,000. Stock of medicines, 10,000. Investments, 9,000 into 100 by 9 gives us 1 lakh is the value. Subscriptions receivable, 1,500. Cash in hand, 8,000. The opening balance, so-called opening balance that we have taken. And credit side, we have subscriptions due and amount due for medicine supply. Difference you are getting is 1,80,300. We take this figure and write that in our balance sheet as the first one. Then add back what we call as a surplus carried from income and expenditure account. Subscriptions in advance already provided in the question here, 700 rupees. This is a liability. Advance will go on to the liability side. Amount due for medicine supply at the end of the year, we have 13,000 due to be cleared to the medicine supplier. Next, buildings, 50,000 minus 2,000. Depreciation is deducted, 48,000 closing balance. Equipment, 21,000 plus 15,000. Just now we have calculated the depreciation. 36,000 less depreciation, 6,000 not given but found out, and 30,000 is the closing balance. Stock of medicines, 15,000 given in the problem straight. 9% investments, subscriptions receivable 2,200, cash in hand 9,000, and your balance sheet total comes to 2,04,200. Right, that's most of it. We are done with non-profit organizations. Chapter number 20, partnership accounts 1. So what exactly is this partnership? When two or more persons, they come together to start a business with a view to earn profit and share those profits. Okay. Now look at the thing. What is this partnership? An individual, that is a sole proprietor, may not be in a position to cope up with the financial and managerial demands of the present day business. So what exactly gave birth to this concept called as partnership is sole proprietary business is the basic model. And the problem with sole proprietary business is he can't get capital, okay, beyond a particular limit. And it will be extremely difficult to manage the business because only one person will be there and he has to take care of entire activity. So in order to overcome the drawbacks that are there in your partnership, a new form of business called as partnership has come into existence. That is, instead of one person, two or three people, more minimum is two, maximum limits are there in the law. We'll be seeing that. Okay. So these people, they come together, they pool their resources together and they do business. So when multiple persons are there, it will become easy to mobilize finance for the purpose of business and to manage the business. So in order to overcome the drawbacks, whatever are there in sole proprietary businesses, they came up with the concept called as partnership. Okay. And what exactly is this partnership? When we see the legal aspect of it, Section 4 of Partnership Act 1932 says partnership is the relationship between persons who agree to share the profits of a business carried on by all or any of them acting for all. Is it mandatory that all the partners should participate in the business? No. All of them can, or if some of them can't do it, only few of them can act on behalf of all the partners. Okay. And individually, they are called as partners and collectively they are called as firm. Okay. Now, from now on, whenever we are using the word firm, it is implied that it is partnership firm, all partners put together. And they have something called as partnership deed. This is an agreement. Okay. The relationship between the partners is governed by something called as a mutual agreement and we call it as partnership deed. And why do we have a deed? Just to avoid any sort of disputes in future, partners, they enter into an agreement. They agree upon the clauses or terms and conditions that are there in the partnership deed. Is it mandatory that they should have a deed? No. Okay. Still, in spite of not having a written deed, partnership can come into existence orally. Two members, they meet up at a place and they say that from tomorrow we are equal partners and this is what we are doing and this is my investment and this will be your investment. Partnership has come into existence. Okay. So rules in the absence of partnership deed. Imagine like there is no partnership deed. Law has imposed some restrictions. What are the restrictions? Sharing of profit, all partners are equal partners. If you don't have a deed, you distribute the profit equally so that no confusions and no disputes will come in future. Interest on capital, no interest on capital will be given to you. Interest on drawings, no interest on drawings will be charged. Interest on loans and advances given by the partner. Yes, we will provide interest subject to a maximum limit of 6%, not beyond 6%. And remunerations, no sir, no remunerations or commissions or bonus or whatever you're calling it as, the remunerative part, okay, nothing will be paid to you. Unless otherwise stated, interest on partners' capital and remuneration to the partners are allowed only if the partnership firm earns profit. That is, until unless it is specified, that is, they have written in the deed very clearly that if remuneration and whatever we call as interest on capital, it will be paid irrespective of fact whether the firm has got profit or not. But usually this will not be the case. Only if profits are there, they will take it. That is interest on capital and remuneration. Now, capital accounts of partners and profit and loss appropriation account. Okay, distribution account, because multiple people are there. I can't show the entire, imagine like there are 10 partners in a firm. So imagine a balance sheet liability side making all the adjustments individually for a partner. Capital amount, okay, add profit or minus loss, minus drawings, minus interest on drawings, add interest on capital, okay, add remuneration, all these things. Can you imagine adding all of them on balance sheet liability side? No. So technically it will not be possible to prepare balance sheet like that. So what is that we are doing? We are preparing capital accounts separately, and all the partners, after making all the appropriations, the final amounts will be transferred to balance sheet. We'll have one line for one partner, that is A's capital account, so and so amount, B's capital account. If you want the details, go and refer the capital accounts. Okay? And these capital accounts, they are maintained in two particular orders, that is fixed and fluctuating. What exactly is this fixed and what exactly is fluctuating? Fixed capital is whatever initial amount that is brought in by the partners, it will be kept in a separate account, and all the appropriations, the so-called interest on capital, interest on drawings, remuneration, salaries, bonus, commission, or whatever they are taking, that will be routed through a separate account individually. For each partner will maintain a current account. So under fixed capital method, we'll get two accounts, capital account and current account, which is meant for appropriations. So technically, fixed capital account is meant to be fixed during the, yes, and we are not supposed to change it. Yeah, we are calling it as fixed capital, but even fixed capital account changes because of capital. That is, only when additional capital is brought in by the partner, it increases, or partner has withdrawn the capital. It is not drawings. We are not talking about drawings done on periodical basis. We are talking about something like a huge amount of money is pulled out by a partner for his personal purpose. That is withdrawal of capital. Only in the event of these two things, we will have a change in capital account. So technically, capital account changes. Why are we calling it as fixed? You may say that, sir, you're calling it as fixed, but it is changing. Yeah, it is changing because of capital, not because of appropriations. If it changes because of appropriations of profits and all that, then it will be fluctuating capital. Okay. So partners capital accounts, look at the thing here. Capital always shows credit balance, right? This is the first entry. And it changes only because of two things: by cash or bank, additional capital, and by withdrawal of capital. This is the closing balance. All the other appropriations. So can I say that capital of a partner under fixed capital method changes only because of capital, that is either additional capital or withdrawal of capital. All other appropriations will be routed through an account called as partners current account, and this account may have debit balance or credit balance. There is no hard and fast rule like capital account, which shows only credit balance. Current account may have debit balance or credit balance. And all appropriations like interest on capital, this is the amount that has to be paid by the firm to the partner. Partner's salary, partner's commission, partner's share in profit, they'll be credited to this current account. And drawings made by the partner, drawings are what? Periodical amounts taken by the partner for personal use. Those will be debited to current accounts. Interest on drawings, profit and loss appropriation, if it is a loss, and the balance carried down will go to balance sheet. Again, closing balance, just like the way opening balance, can be a debit balance or credit balance. It can be a credit balance or debit balance. Okay. Now, what is this other one? Look at the thing. fluctuating and all that, they gave you what we call as fluctuating, or it is also called as floating capital. Usually we use the word as fluctuating capital. Now, why is it called as fluctuating capital? Because every year, because of appropriations, your capital account keeps on changing. What is that we are doing is, instead of maintaining two accounts called as capital account and current account, we are clubbing everything. Every year, all the appropriations are routed through only one account. Okay, and that account will be your partner's capital account. By default, if the problem is not prompting anything, you're supposed to prepare the capital accounts under fluctuating capital method only. Opening balance, credit balance, whatever you wrote in what we call as fixed capital method, change of capital because of capital, additional capital, and what we call as withdrawal. Here they have not given it, but if you have withdrawal, you will have it here on the credit debit side. And all the appropriations, see, interest on capital, partner salary, partner's commission, partner share of profit if it is there, partner share of loss if losses come. Drawings and interest on drawings will be debited to partner's capital. This thing changes every time whenever appropriations are made. Okay. So P&L appropriation, all this time we were talking about appropriation. So what is this appropriation? Whatever net profit you calculate in your profit and loss account, whatever net profit you have calculated in your profit and loss account, it will be transferred to an account called as P&L appropriation account. Since multiple owners are there and every owner will have his own thing. Imagine like some partners are taking active part in the business. We will pay remuneration to them. Some partners are dormant partners. We will not be paying anything to them. All partners are eligible for interest on capital. So for this purpose, we are preparing an appropriation account wherein we show it very clearly how this profit has been distributed to these partners. Okay, that is what the basic purpose of appropriation account is. So they gave you a format here. Let us understand the format and then we will see a question here. Profit and loss account. The first entry will be made on the credit side. By profit and loss account, amount is given here. To that, what is the first thing that I am adding is interest on drawings. This is the amount that partners are supposed to pay. Though it will not be paid by the partners, it will be adjusted in their capital account. So whatever adjustments that we do in capital accounts are taken from P&L appropriation account. Okay, interest on drawings. This is the income that the firm has to receive from the partners. Okay, see, they gave you example A and B. They have to pay so much. This will be credited. So we are adding it to net profit transferred from profit and loss account. Go on to the debit side. What is the first thing? To interest on partners loan. A has given a loan to the business. B has given a loan to the business. Okay, we have seen it. In the absence of agreement, 6%. If there is an agreement, whatever agreement says, that percentage will be served. Then remunerations. Partners may take remunerations in the form of salaries, commissions, a lot of things. A and B are taking it in our example here, format. Next, interest on capital. This is the amount that the firm has to pay and it will be appropriated out of profits of the year. Okay. Reserves. After making all the appropriations as given in the problem, the left out balance in your P&L appropriation account will be called as divisible profit. And we create reserves out of divisible profits, usually out of divisible profits. Okay. So reserve. Why this reserve is created? Just in case in future, if there is any unexpected, unseen, what we call as contingency comes up, then the business uses this money to overcome that particular problem. And after creating reserve, the balance is divisible profit, and this is the amount on which we apply our profit sharing ratio as agreed by the partners in their deed. In the absence of deed, it will be equal between the partners. This is what appropriation, basically to appropriate the term called as net profit between the partners as such. Okay. So let's try to understand this with what we call this problem here. Okay, the problem number 1, CRD. On 1st January 2020, ABC entered into partnership contributing 2,50,000, 1,30,000 and 1,20,000 respectively, and share profits in the ratio of 5:3:2. B and C. Okay, so PSR is 5:3:2. B and C are entitled to salary of 16,000 and 14,500 respectively per year. So technically, B and C are active partners. A is a dormant partner. He doesn't take active part in the day-to-day activity of the business. Done. Interest on capital is to be allowed at 5% per annum. And 5% interest is to be charged on drawings. Drawings draw the during the year A is drawn 40,000, 25,000. Drawings amounts are given. Interest being, we don't have to calculate anything called as interest on drawings. They have provided the amounts directly. Just pick up the values and write them in the appropriation account. Profit in 2020 before the above mentioned adjustments was 71,400. They are talking about net profit that was transferred from P&L account to P&L appropriation account, which should be credited now. 10% of the divisible profits are to be transferred to general reserve. Show how the profit is distributed and also prepare capital accounts if they are fluctuating and if they are fixed. So we are preparing a P&L appropriation account and capital accounts under fluctuating capital method and fixed capital method. Let's see the solution here. First, let's complete what we called as the P&L appropriation account. Problem number 1, profit and loss appropriation account for the year ended 31st December 2020. First amount will be there on the credit side by net profit 71,400. Just now we have discussed it. Interest on drawings, we don't have to calculate it, it's provided already. 2,250 of A, 1,120 of B, and 725. We credit that because this is the amount that has to be paid by the partners to the firm. Okay, next. Nothing to be credited to P&L appropriation. Now all debits are there. What is the first thing? BNC are entitled to a salary of 16,000 and 14,500 respectively per year. Let's give BNC their salaries here. First appropriation done is salaries paid to BNC. Done. Interest on capital. Just now we read interest on capital is to be paid at the rate of 5% per annum. Interest on capital, individual capitals of A is 2,50,000, B is 1,30,000, C is 1,20,000. 5% upon that comes to is 12,000, 12,500, 6,500, and 6,000. 25,000. Now, do we have any other appropriation apart from salaries and interest on capital? No. So, what is the divisible profit? Credit side total. Are you getting the credit side total as 75,500 minus salaries of BNC and interest on capital? Remove this amounts here. What is the difference that you're getting? 20,000. And on that 20,000, we are creating a general reserve. We are setting aside an amount of 2,000 rupees. Okay, to general reserve, 75,500 minus 55,500, 20,000. 2,000 rupees is the general reserve. The balance 18,000 is your divisible profit on which we apply the profit sharing ratio, which is 5:3:2. Done. Are we getting 9,000, 5,400 and 3,600? Right. So this is your appropriation account. Let's see the capital accounts now. Fluctuating capital method. So how many accounts do we prepare? Only one account. All the appropriations, additional capitals and withdrawal of capitals will be routed through only one account. So we are preparing this capital accounts in a tabular form. If the problem says that prepare that in tabular form, you prepare that. If the problem is silent, prepare the accounts individually. Don't prepare that in tabular form. Okay. Now look at the first one. They brought in how much of capital? 2,50,000, 1,30,000 and 1,20,000. Let's complete the appropriations. The amounts to be paid by firm or amounts to be given by firm to the partners. First thing from P&L appropriation account, interest part, salaries part, and the profit that we have calculated on 18,000. We distributed that in 5:3:2. Done. Debit side, what is the thing? Drawings account. How much drawings are made? I think drawings are clear. Yeah, 40,000, 25,000 and 15,000. Drawings. And P&L appropriation account. This is interest on drawings, which is given in the problem. Okay. So interest on drawings is 2,250, 1,125 and 725. Done. Now we will arrive at what are we called as balance of capital of the partners. To balance carried down 2,29,250. This is the balance of A, and this balance will go into your balance sheet. In balance sheet on the liability side, I will write as capital accounts or partners capital. A will have 2,29,250, B 131,775, and C is 1,28,375. This is capital accounts of the partners under fluctuating capital method, because the capital was 2,50,000, 130 and 120, and they have what we call this decrease. Some of them are having decrease because there are too much of drawings here. A has decreased, B, I think only 1,175 excess is there, and C has got excess of 8,375. And these amounts, whatever excess and deficits are there, they will be appearing in your current accounts. Let's see the alternatively. Okay, what is this alternatively is, if the problem is silent, this is how we are supposed to do. Don't prepare it like in a Tableau form. Okay, make sure that you are preparing it individually. Whatever adjustments we have done in the Tableau form here, ABC account, alternative is given, the same problem. Now look at the next thing, fixed capital methods. What are these fixed capital methods? Just now we have discussed. Capital amount is kept in a separate account, and this account will not change until unless there is additional capital brought in by the partner or the capital is withdrawn by the partner. Okay, we don't see any. Do you see any withdrawal of capital? No. Do we have any additional capital brought in by the partners? No. So capital account, look at the credit side. By bank, this is the initial amount that is brought in, and carry down balance is the same. So by balance brought down, capitals will remain same. So all the appropriations, whatever we have done in the, yes, will be brought to current account now. Look at the thing. Only thing is we are separating that 2,50,000 capital, rest of the thing remains the same. By P&L appropriation, what did you bring from P&L appropriation? Interest on capital was given to them. Interest on capital was provided. Salaries were given, only B and C. A is not active partner. We have P&L appropriation, profit distributed. Then we have drawings here and interest on drawings. Now when you total up, A has got excess amount on the debit side. What is the amount? 42,250 minus credit side. Are you getting a debit balance of 20,750, right? Next, B, I think he has got a credit balance of 1,175. I told you 1,175 will be the excess in credit thing, I mean current account, and 8,375. We can make out how much balances will come from the account here. See the thing, when you compare 2,50,000, it has reduced. So this guy will have a debit balance in current account. This guy has invested 130, but he has got 131,177. So 1,775 rupees will be the credit balance. This guy invested 120, he has got 8,375 extra. Okay, I'm just dividing it. So this is your capital accounts concept under fixed capital and fluctuating capital. Alternatively, here you will get how many accounts? 6 accounts, separately 6 T forms. A's capital account, B's capital account, C's capital account, A's current account, B's current account, and C's current account. Only thing is we are dividing the capital amount and drawing all the other appropriations will remain the same. Okay. Now let's see another problem here. Interest on capital. Okay, but this will be calculated on what? Opening balance. And if there is any sort of addition made by the partner, we'll be calculating on that. And current account credit balances are not eligible for interest. Accounting treatment. Okay, already we have done this. And look at this. Provisions are given as per section 13C, the legal aspect of it. Interest on drawings, this will be charged. And there is one more thing, different cases of interest on drawings. What is this thing? If agreement is silent as to interest on drawings, what is that we'll do? No interest on drawings will be charged on the drawings. The same logic applies good even to interest on capital as well. If the agreement is silent, nothing will be paid to them. Let's see the next one. When the date of drawings made during the period of 12 months are not given, dates are not clear. They have not given you the dates. Okay. Total drawings, they gave you a lump sum amount. 40,000 was drawn by A during the year, or 36,000 was drawn. Just now we have seen the case, right? Now, how do we calculate the interest? If the question prompts that interest rate is given with a suffix of per annum, then we'll be taking it as only 6 by 12, half of the year. And if the problem is prompting that, the problem says that it is only what do we call as interest 5%, we'll calculate it flat. Next, when different amounts are withdrawn or different dates, amounts and dates are given separately, we will calculate respective what we call as amounts into percentage of interest on drawings into duration for which these amounts are used by the partners. Now, we will go with what we call as average period, when starting from option number 4 to option number 5, we have to use this only when two conditions are affirmative. Partners are drawing the amounts equally, that is, same amount of money is being taken by the partners at a regular interval. A is drawing 5,000 every month, so 5,000 for 12 months, 60,000. And second condition is the amount should be taken by the partners on the same day every month. First of every month, 15th of every month, last day of every month. Then you can use this things here. Okay. So when a fixed amount is withdrawn on the first day of every month during the period of 12 months, what is it I'm doing? Total drawings. Let us take an example, standard example. A is taking 5,000 rupees every month on the first day of the month. That is April 1st, May 1st, June 1st, henceforth. Last one is March 1st. Then I will take a total drawings of 60,000 and rate by 100 into 6.5 months. Okay. And how did he get this 6.5? What is the calculation that is involved in this? If the amount is taken on April 1st, 5,000, whatever is taken on April 1st, it is used by A for a span of 12 months. The first drawn amount is used for 12 months, and the last drawing of 5,000 made on March 1st is used for 1 month, divided by 2. You're getting how much? 13 by 2, which is 6.5. So amount is fixed. Always check what is the maximum time for which the amount is used plus minimum time for which the amount is used. Same amount, 5,000, 5,000 divided by 2. On the contrary, we can do this mathematically also by using a formula, n into n plus 1 by 2 whole divided by n as well. You'll get the same thing. N is 12 here. Usually it will be 12. It depends. If it is here 12, we'll be taking it as 12, and accordingly you'll get the thing. Okay. Sum of series of numbers divided by n. You'll be getting the same thing. So let's not go with a mathematical approach here. Let's go with something like simple. Maximum time plus minimum time divided by 2. Okay. So this thing. And again, quarters, the same thing. First, option 4, option 5, and option 6 are talking about what? We're talking about months. If the amounts are drawn by the partners at the beginning of the quarter, middle of the quarter, end of the quarter, then I'll be using the same thing. If the amount is drawn at the beginning of the quarter, that is on April 1st, how many months is it used? It is used for 12 months. What is the last quarter of the financial year? January 1st to March 31st. The amount is taken on January. Yes. The last amount is used for 3 months. Total comes to how much? 15 months divided by 2. 15 divided by 2, 7.5 months. You can apply the same n into n plus 1 by 2 whole divided by n also for this as well. Clear? So this is the thing. They gave you an illustration here. Let's see the next problem. Okay, but this is more like a case-based study, wherein in the absence of agreement between the partners, what is the status quo? Ram, Rahim and Karim are partners in a firm. They have no agreement in respect of profit sharing ratio, interest on capital, interest on loan advanced by the partner, and remuneration payable to the partner. In the matters of distribution of profit, they have put forward the following claims. So they are saying something. Let's see their versions. Ram, who contributed the maximum capital, demands interest on capital at 10% per annum. First and foremost thing, when the partners don't have an agreement regarding interest on capital, law says what? Don't talk about interest on capital. No interest on capital will be given to anyone. And share of profit in capital ratio. What is the PSR if there is no agreement? Profit sharing ratio equal. So forget about capital ratio. So both versions, both the demands of Ram are not eligible. Next one, let's see the version of Rahim. Rahim has devoted full time for running the business and demands salary at the rate of 500 per month. But Ram and Rahim are not agreeing for it. Obviously, partners, they are not eligible for any remuneration because there is no agreement between them. There is no written deed between them. Let us see the Karim's thing. Karim demands interest on loan at 2,000. Karim has given a demands interest of rupees 2,000 advanced by him at a market rate of 12%. What is allowed as per law is only 6%. Right. So what is that we are doing? How shall you settle the dispute and prepare a profit and loss appropriation account? So based on all this contention, Nothing will be there in appropriation account. What is the profit that they have got? They have got a profit of 45,000. What will be paid? Only Kareem's loan of 2,000 will be served at 6%. That comes to 120. The balance 4,488 rupees will be, oh, they are creating a reserve as well. 10% transfer to reserve. Reserve, after taking out this 120 on the balance, we create a reserve which comes to 4,448, and the balance 40,392 shall be distributed to the partners in the equal ratio. In the absence of a deed, the partners are supposed to take the profits in their equally, not in their capital ratios and all. Let's see the next one here. Illustration is given here. Look at the thing. Weak, able, and lazy were in partnership, sharing profits and losses in the ratio of 2:1:1. It was agreed that interest on capital would be allowed at 10% per annum, and interest on drawing should be charged at 8% per annum. No interest will be charged or allowed on current account balances. Right? What is a hint? They are maintaining books of accounts under fixed capital method. The following were the particulars of capital and drawing accounts of partners. Capital as on 1st January 2019, weak was 75,000, able 40, and lazy was 30. Current account balances 10,000 credit, nothing is mentioned, credit balance by default. 5,000 able credit balance. Lazy has got a debit balance which will be specified either before or after. Prefix or suffix will be there as we are. Drawings done. Drawings are 15,000, 10,000, and 10,000. Now, the draft accounts for 2018 showed a net profit of 60,000 before taking into account interest on capital and drawings, and subject to following rectifications. They have got some errors in their books of accounts which are to be reconciled and rectified, and subsequently we have to draft the appropriation account. Life insurance premium of week amounting to 750 paid by the firm on 30th June 2019 was charged to miscellaneous expenses. The life insurance premium of week should be technically taken as drawings. It should be added to his drawings, but what is the mistake that they have done? They have taken it as miscellaneous expenses. So week drawings or drawings account of week to miscellaneous expenses. What will happen because of this? Week drawings will increase. What are the drawings of week? This will be increasing by 750, correct? And there will be a increase in profit. When we rectify, the profit increases by 750. Okay, because it is charged to miscellaneous expenses, now it is reverted back. Now we'll see that in a solution. Repairs of machinery amounted 10,000 was debited to plant account, and depreciation thereon charged at 20%. So repairs and maintenance are regular revenue expense, has been treated as capital expenditure and debited to plant account, correct? So depreciation thereof charged at 2%. So out of this 10,000, though they wrote it, actually we were supposed to write entire 10,000 in the profit and loss account, but you have written 2,000 in the form of depreciation, because 10,000 charged at 20%. Obviously they must have charged the depreciation on this 10,000 also. So the balance 8,000 has to be charged now. The profit decreases by 8,000 now. Next, traveling expenses of 3,000 of able for a pleasure trip to UK paid by the firm on 30th June 2019 was debited traveling expenses. It should be added to the drawings of whom? Drawings of able. Oh, this I wrote it in. Was it week? Yes. Right. Next, this thing is. Oh, it be the other way. Correct. Now, let's see the next thing. You are required to prepare profit and loss appropriation account, current accounts of partners, weak, able, and lazy. Okay. What else? That's it, right? Let's see the solution here for CRD problem number 3. P&L appropriation account first. By net profit adjusted 55,750. Given in the problem is 60,000, correct? Before adjusting it was like 60,000. Now after adjustment, what are all the adjustments that is done? We will see that in working note. Working note number 1. Adjusted profit. Net profit as per the problem is 60,000, no doubt. Add back drawings of week, and pleasure trip of Abel. 3,750 is added back. 8,000 is deducted because some machinery repairs were taken as planned. Okay, so we've got 55,750 adjusted profit that is taken to your P&L appropriation account here. Done. Next, interest on drawings. What is the rate at which you are supposed to charge the drawings? What is the percentage that is given? Interest on drawings are to be charged at 8% per annum. Accordingly, they have calculated it. See the calculations. Interest on drawings. Okay. Interest at the rate of 8% per annum. When word per annum is given, it will be calculated only for 6 months. Accordingly, they calculate as 630, 520 and 400. Done. This is charged. P&L appropriation account credit side. Interest on drawings. The only thing that will be credited to P&L appropriation account is over. Let's see the other side. Distribution. Interest on capital to be served at the rate of 10%. Okay. And you're serving it on what amounts? 75,000, 40,000 and 30,000, which comes to 7,500, 4,000 and 3,000, 14,500. Partners capital account, share of profit. That's it. No other appropriation is there. You are getting a difference. Are we getting a difference of 42,800? Check. Distributed in what ratio? They have a ratio. Yes, 2:1:1, which comes to 21,400, 10,700 and 10,700. Right. This was appropriation. Very simple. Only 3 rectifications are carried on. Partners current accounts. Okay. Weak and able are having a credit balance, but lazy is having a debit balance. We have seen this thing. Second one, 10,000 by default credit balance. If it is debit balance, they'll mention it very clearly. So by balance brought down, weak and able a credit balance, and lazy is having this thing. Next, what is the next thing that we are adjusting? Profit and loss appropriation account. Interest on capital, just now we have calculated. This will be added to the partners capital accounts. Profit share, 2:1:1, 21,400, 10,700 and 10,700. And what is it on the other side? Drawings, will remove the drawings amount first. Then life insurance premium. Drawings, again, they have individually given. You can consolidate that and write it as one thing, but they have shown it individually. So P&L appropriation account, interest on drawings, and carried down balances. 22,520, 6,180, 1,700. So this guy, lazy, is still having a debit balance of 1,700 in his current account. This is your CRD problem number 3. Now, guarantee of minimum profit. So what is this guarantee of minimum profit is? Some partner has joined, some new partner has joined the firm, and the old partners of the firm are giving him a guarantee that we will give you a minimum amount as profit. Your share will be given to you irrespective of the fact whether we have profits or losses. Profits are there. If the amount is not sufficient as per the profit sharing ratio, we will contribute. Okay, we'll give it to you from our capital accounts. Or if it is a loss, we will still put you in the same place, same amount of profit. We will bear all your loss part and whatever profit part that we have given as guarantee. Okay, so this thing is called as, what do we call as, guarantee of when the person's partners giving that and all. And this thing can be a, what do we call as, personal guarantee or a firm guarantee. If the partners, all the partners other than the guaranteed partner, if they are giving the commitment to him that this will be the minimum profit, guaranteed profit that will be given to him in their existing profit sharing ratio, it will be called as firm guarantee. If they are deviating that ratio, then it will be called as personal guarantee. And this can be given by all the partners, or only some of the partners, or only one partner out of old partners, right? So this thing's accounting treatment is given, and let's see that with the help of a problem. Very important. Okay, A and B were partners in a firm sharing profits and loss in the ratio of 3:2. These guys are the old partners. They admitted C for 1/6 share in the profits and guaranteed that his share of profit would not be less than 2.5 crores annually. The total profits of the firm for the year ended 31st March 2020 were 9 crores. Calculate the share of profit of each partner. Now, first thing is, forget that this guy C has been given a guarantee of 2.5 crores. Calculate, divide the thing according to the ratio, the new profit sharing ratio, and then check if there is a deficit. Apply these 3 scenarios. Let's see that in a solution. Okay, the first one. Case 1, when guarantee is given by the firm. What is guarantee given by the firm? A and B are giving a guarantee, and that too in 3:2 ratio. Then we call it as a firm guarantee. Guarantee given by the firm. Existing ratio. If there is a deficit, we'll see whether there is deficit or not. If there is a deficit, it should be fulfilled by A and B in 3:2. Then it is called as firm guarantee. So 9 crores, when you distribute that without, what do we call this, seeing into this 2.5 crores. Okay, what is the amount that you're getting? Calculations are done. Do the calculations. I think working notes is not given here. Put it on calci and see. There is no problem. Check the calculation. So it is coming to how much? 9 crores. When it is divided 1 by 6, let us see this share of C. 1.5 crores. And what is the guarantee that is given by the firm? 2.5 crores. There is a deficit of 1 crore. Now, in case of firm guarantee, what is the ratio? 3:2. A has to bear 3 by 5th. B has to bear 2 by 5th. So how much will it be? 60 lakhs of A. So out of this 9 crores, 3 by 6, isn't it? So whatever amount is there, that 60 lakhs has to be borne by A and 40 lakhs has to be borne by B. Let's see the option 2 there. So what is the option 2 here? Let's go back to question. Guarantee given by A. It's a personal guarantee which is given by only one partner. A says that if there is a deficit, if your profit, share of profit after calculating it, if it is below 2.5 crores, I will give you the amount. Accordingly, the second option, what happened when we distributed, there is a 1 crore deficit which is taken out of A's share. A's share originally happens to be 4.5 crores minus 1 crore, 3.5 crores. Okay. And what is the B? B is not agreeing. This is only a personal guarantee which is given by A. And what is the story? C, 1.5, 1 crore will be added from A, recovered from A, and 2.5. This is the second one, personal guarantee. And what is the next thing? Personal guarantee given by all the partners, but in another ratio. Originally, they are sharing it in 3:2, but here they are taking it in 1:1. Look at the thing, guaranteed. Yes, guarantee given by A and B. All the old partners, A and B are the old partners equally, but their profit sharing ratio is 3:2. Okay, so this 1 crore, whatever deficit is there, obviously it will be shared equally. Look at the thing, 50 lakhs out of A and 50 lakhs out of B, and C gets is 2.5. Now, in the event of loss, let's see that provision also. Now, if there is a loss, what will happen is, okay, first, the entire loss has to be borne by the old partners, the agreed ratio. That will not change. And then they have to give him the original part of what we call as profit. So it will be guaranteed amount plus loss amount, both. Even if there is a loss, the partners, guaranteed partner should be credited with the agreed amount. Am I being clear? So we're done with unit number 1. Okay, unit number 1 of partnership is over. We'll continue with unit number 2, that is valuation of goodwill. Okay, let's continue with unit 2, treatment of goodwill in partnership. So what exactly is this goodwill? It is the reputation of this partnership firm, and when we calculate that in terms of money, we call it as goodwill. Goodwill is the value of reputation of a firm in respect of profits earned in future over and above the normal rate of profit. That is, this particular partnership firm, they have a reputation in the market, and when we do the valuation for that, it will be termed as goodwill. And goodwill is an intangible asset. It cannot be seen, it cannot be felt. Okay, and there are, what do we call this, various situations when goodwill is valued. That is, whenever a partnership firm undergoes a reconstituted, we do the valuation of goodwill. That is, whenever there is a change in profit sharing ratio between the existing partners, goodwill is valuated. Whenever a new partner is admitted, when a partner retires or dies, when the firm is dissolved, and when the firm is getting amalgamated with another business. These are the 5 scenarios under which we calculate the goodwill of the firm. Classification of goodwill, purchased goodwill and self-generated goodwill. And purchased goodwill is like, business has paid something. Okay, this partnership firm has acquired another business, and for acquiring that business they have also paid some money towards goodwill, that is purchase goodwill. Self-generated is something which is developed over a period of time. The reputation, the kind of work that they did, they got that particular kind of reputation in the market. Methods of valuation of goodwill. There are three methods which are used in calculating the goodwill of a partnership firm. Average profits basis, that is again simple average and weighted average. And when do we use simple average and when do we use weighted average? We'll see now. Super profits, okay, that is number of years of purchase or annuity basis or capitalization of profits, and capitalization basis average profits. So average profits basis will be taking a particular number of years of profits, like previous year profits or past 3 years or 5 years of profit, and if these profits are in a clear increasing trend or clear decreasing trend, then we use a weighted average. Okay, and simple average will be used, and whenever these profits are not in a clear increasing trend or decreasing trend, there is no trend at all. In 1 year it is less, in 1 year it is more, again it is coming down, it is going up. Profits, we're not talking about losses here. Okay, or even if the losses are there, we have to go for simple average only. So then what is that we will do? Take the total of the number of years of profit divided by number of years, we'll get the average, and number of purchases, years of purchase, that is after calculating the average profit, the firm says that this is the goodwill, this number of years, this particular firm can maintain the same amount of profit for the next 3 years, next 5 years, next 2 years. They'll be multiplying with the number of years there. Weighted average. Now when do we use the weighted average? When there is a clear increasing trend, okay, we'll be assigning weights to them. Yes, ascending and descending order depending upon the thing. And what is the thing? We'll be seeing that in a problem. Super profits basis. What is super profits? What are super profits? Every business has a normal rate of return, normal profit or normal rate of return. But one particular business is earning profit over and above this normal profit, then the business is said to have, what do we call this? Earning super profits. Okay. So super profit is equal to actual profits minus normal profits. So actual profits or average maintainable profits, normal profits, rate of NRR, normal rate of return into capital employed. This is how we get it. And this is how we calculate. We'll be seeing that with a, what do we call as a problem here. Let's see a problem, and we'll see all the, yes, CRD problem number 1. Lee and Lawson were in equal partnership. They agreed to take Hicks as 1/4 partner. For it, it was decided that to find out the goodwill value, Messrs. Lee and Lawson earned a profit of and profits during 2017 to 2020. They gave you profits. 17, 1,20,000, 2018, 1,25,000, 2019, 1,30,000, and 2020, 1,50,000. So 4 years profits are given. They are in a clear increasing trend, though the gap is uneven. We are not talking about equal gap. It need not be equal, but it should be an increasing trend. Okay. And on 31st December 2020, the capital employed by Messrs. Lee and Lawson is 5 lakhs. Rate of normal profit, that is, firms which are operating in the similar kind of business in the same locality, they are making a profit of 20%. Present value of annuity of 1 rupee for 3 years. So they are giving you a hint, not telling you directly, but giving a hint that the profit is purchased for 3 years, whatever profits you are calculating, average or super profits or whatever it is. So find out the value of goodwill under average profit basis, super profit basis, annuity basis, and capitalization basis, right? So all 4 methods are covered in the same problem here. Look at the thing. CRD problem number 1. Calculation of average profits 2017 to 2019 profits, and locate the weights. If it is an increasing trend, we'll be ascending them. If it is decreasing trend, 2017 will have 4, 3, 2, 1. The lowest one will be given to the highest profit, should get the highest weight. Highest profit will get the highest weight. Okay, if it is increasing trend. So accordingly, we'll find out products, multiply them. You should be getting a total product of 13,60,000 divided by total weight, which comes to 10. So what is your average, weighted average profit? 1,36,000. And what is the assumption? They didn't tell us how many years of average profit is purchased or how many years of average profit will be taken for goodwill valuation. So we are taking, based on the question, they have taken the present value annuity at 3 years. So we are going with the assumption that the purchase of goodwill is done for 3 years. So accordingly, under average, yes, we are getting a total of average profit method 4,08,000. Yes, 1,36,000 into 3 years. Next, calculation of goodwill under super profits method. What are super profits? They have earned a profit of 1,36,000. Just now we have calculated in the previous one under average profits method. Now I need to find out a normal profit. How do I arrive at normal profit? What is the capital employed by the firm as 5 lakh rupees? And what is the normal rate of return? 20%. Okay. So what is it I'm doing? Average profit 1,36,000. Normal profit 5 lakhs into 20% comes to 1 lakh. So over and above 1 lakh, whatever is earned by them is to be termed as super profit. Okay. And as per super profits basis, what is the value? The value is 36,000. And how many years of purchase is being made? 3 years purchases, right? So goodwill as per super profits method is how much? 1,08,000. Okay, look at the difference. Under average profit method, 4,08,000. Here it is 1,08,000. Let's calculate it under annuity thing. It's very simple. Goodwill is equal to super profits into annuity factor. All these methods are connected to each other. Okay, already you have seen average method is connected to super profit, and for annuity method we'll be taking super profit value and multiplied with the annuity factor that is provided here. Okay, they'll be giving you the value. You don't have to calculate this value. They'll be providing with this value. Okay, right. So what is the value? 75,834 is the goodwill valuation if you are doing it based on annuity method. And now capitalization method. What is capitalization method? This firm has earned a profit of 1,36,000 by investing 5 lakhs. Okay, but what is the normal rate of return? 20%. Correct. So if the normal rate of return is 20%, they should earn how much profit with the kind of investment that they have done here? That is profit. If you are calculating it the backward way, what should be the capital amount that is required according to normal rate of return based on the profits? Let's see that calculation. 1,36,000 was your average profit. So in order to earn this 1,36,000, and if it is applied at normal rate of return of 20%, this firm should have invested a capital of 6,80,000, but they are getting the profit of 1,36,000 just by investing 5 lakhs. I'll reiterate this. Average profit is 1,36,000. If you take it, if you try to reciprocate the NRR, what will be the capital that will be required to earn this profit at 20% rate of return? 6,80,000. But they have invested only 5 lakhs. The difference is taken as 1,80,000. That will be difference in the capital will be termed as value of goodwill under capitalization. So all 4 methods in one problem. Okay, let's see the next one. CRT problem number 2. The following particulars are available in respect of business carried on by Rathore. Capital invested is 1,50,000. We require this for applying NRR. Profits are given. 2017 profit 40,000, 2018 profit 36,000, 2019 there is a loss of 6,000, 2020 again they got into what we call as profit. There is no clear increasing or decreasing trend, so we don't have a choice but to apply simple average. Now market rate of interest on investment is 10% and risk rate of return on capital invested is 2. So these two put together, market rate of interest on investment plus risk rate of return, together they are called as NRR, normal rate of return. And what is that? Remuneration from alternative employment to the proprietor 6,000 per annum if not engaged in the business. So now he is asking us to adjust the average profit and calculate something called as average future maintainable profits before calculating goodwill. Don't take average profits directly, because this proprietor, this particular person is feeling that, Rathore is feeling that instead of doing this partnership business, if he works somewhere else as an employee, he would have made 6,000 per year as salary. So that we have to remove it from the average profit to arrive at something called as average maintainable profits or average future maintainable profits. That we will see in the solution. You are required to compute the value of the goodwill on the basis of 5 years purchase of super profits of the business calculated on the average profits of the last 4 years. So simple average, very simple problem, small problem. What is that we are doing? CRD problem number 2. Calculation of goodwill under super profits method. They have taken the profits in order 17, 18, 19. Okay. The number got messed up. 19 has got a loss here. Yeah, the numbers have changed here. But whatever, 1,26,000 minus 6,000, we have got 1,20,000 rupees as total. Divided by 4, average profit is 30. But what is that? Remuneration expected by the proprietor, 6,000 will be adjusted out of that. Average maintainable profits, or sometimes they're also termed as average future maintainable profits, are 24. This is your average profit. From that, what is that I have to deduct? I have to deduct the normal rate of return, normal profit. 1,50,000 upon 12% gives us how much? 18,000. 24,000 is the average profits, average future maintainable profits. 18,000, 6,000 is the super profit. And how many years of purchase is it? 5 years of purchase multiplied with 5 in order to get 30,000. The goodwill under super profits method after purchasing the good average profits for 5 years comes to 30,000. Let's see one more problem in this. Okay, so they gave it as what? Vasudevan and Sundar Rajan and Agarwal and partners sharing profits and loss in the ratio of 2:5:3. The balance sheet of the partnership as on 31st December 2020 is given. Okay, capitals are given. Trade payables, sundry fixed assets, inventory, trade receivables, and bank. The partnership firm earned a profit of 2 lakhs in 2020. Okay, and partners withdrew 1,50,000 during the year. Normal rate of return is 30%. You are required to calculate the value of the goodwill on the basis of 5 years purchase of super profits. For this purpose, calculation of super profit using use average capital employed. Okay, what is the average capital employed? The problem here is I know the closing capital. What is the closing capital? Total assets minus outside liabilities. I've got closing capital, that is 6,55,000 minus 30,000. The balance 6,25,000. This is the closing capital. But they are asking us to use what? Average capital. In order to arrive at that, what is it I'll use? Yes, I'll be doing a calculation. Either you reverse the calculation and do it and arrive at the closing capital, or we follow a system. What is that? Look at the thing. Average capital employed 6,25,000. First thing is this is closing capital after deducting total assets 6,55,000 minus trade payable 6,25,000. To that, I'm adding half of the amount withdrawn by the partners. Drawings are added and profit is taken out. 75,000, 1 lakh gives you 6 lakhs. This is your average capital employed. On the contrary, what is that you can do is 6,25,000 plus 1,50,000 minus 2 lakhs, 5,75,000. That is your opening capital. Closing capital is 6,25,000. Add them, 12 lakhs divided by 2 comes to 6 lakhs. So average capital employed is 6 lakhs. What is the next thing? The problem is asking you, what is the normal rate of return? 30% on this average capital employed comes to 1,80,000. 6 lakhs into 30%, 1,80,000. Same calculation is done. So how do we arrive at the profits here? What is the current year profit that you have got? Profits earned during the thing, 2 lakhs. That is what is taken. And less normal, 6 lakhs into 30%, 1,80,000. Super profits are 20. And how many years of purchase? You are purchasing it for 5 years into 20,000. 1 lakh is the goodwill of this particular firm. So we're done with goodwill, valuation of goodwill of a partnership firm. We'll be continuing with admission of a partner. Good morning, class. Today we'll be dealing with chapter number 20, partnership accounts 1, and in that unit number 3, admission of a new partner. Okay, so why a partnership will take a new partner? What are the reasons behind taking a new partner? New partners are admitted for the benefit of partnership. New partner is admitted either for increasing the partnership capital or for strengthening the management of the firm. That is, partnership, they are in need of money. So they want a new person to come in, new partner to come in and contribute to the capital so that the business can run smoothly, or the business is on a expansion now. They want capital now. Or they are having a problem with managing the business. They are unable to control the activity. So they want additional managerial personal. So that's why they are taking a new partner. So these are the obvious reasons for admission of a partner. When a partner joins a firm, it is desirable to bring all the appreciations or reductions in the value of the assets into accounts as on the date of admission. So whenever admission of a partner takes place, all the assets and liabilities are what we call is revalued or reassessed or whatever you call it. Okay. And one more thing that will happen, a new partner acquires two main rights in the firm: right to share the assets of the firm and right to share the future profits of the firm. Okay. And in order to get the first right to share the assets of the firm, a partner has to bring capital. He has to bring amount, and we call it as capital. And if the partner wants share in the future profits, he has to bring something called as goodwill, or it is also called as premium. Okay. So this is the actual purpose of what we call as admission of a partner. Adjustments required. What are the adjustments that are to be done to your books of accounts? The partnership firm will make these adjustments. What is the first one? Adjust in profit sharing ratio. Adjustments in profit sharing ratios. Previously, only two partners were there. Now, third partner is joined. And obviously, there will be a new profit sharing ratio. And there will be a sacrifice ratio or sacrificing ratio between the old partners. Old partners have sacrificed something, and the same sacrifice will go to the new partner. Adjustments of profit and losses arising from the revaluation of assets and liabilities. Adjustment of goodwill. Okay, we have already done goodwill in the previous chapter. Adjustment of reserves, accumulated profits and losses, and adjustment of capital if agreed. This, if capital adjustment has to be done as per their agreement, they will do it. This adjustment, fifth one, is a optional adjustment. It is not mandatory as such. But first four adjustments are common in all the admission of a partner. Okay. So let's see the next one here. Right. So partners will prepare something called as a revaluation account. Okay. Format of revaluation account. What exactly is this revaluation of assets and liabilities is? Okay. Whatever assets are there in the balance sheet before the admission of a new partner, all those assets are reassessed, liabilities are reassessed, and they will arrive at a new value. Some assets they may increase, some assets they may decrease, some liabilities may increase, some liabilities may decrease. And this is routed through an account called as revaluation account, which happens to be a nominal account. And the resultant thing, revaluation profit or revaluation loss, will be accordingly credited or debited to partners' capital accounts. Okay. Now we'll try to see that with the what we call as problem. CRD problem number 1. Basic problem. We'll take care of basic problem first, and then we will get into some advanced problems. Look at this. CRT problem number 1. The following is the balance sheet of Ram and Mohan, who share profits in the ratio of 3:2 as on 1st January 2020. Old partners are Ram and Mohan. Look at their balance sheet. Liabilities, trade payables are given as 15,000. Ram's capital is 20 and Mohan's capital is 25. Buildings are given as 18,000. Plant and machinery 15,000. Inventory is 12,000. Trade receivables 10,000. And a bank balance of 5,000. Now, who is coming in? On this date, Sham is admitted on the following terms. What is that? He is to pay 25,000 as his capital and 10,000 as his share of goodwill for 1/5 share in future profits. Okay. Next, the new profit sharing ratio will be 5:3:2. The problem itself is giving you the new profit sharing ratio. We don't have to calculate anything, called as new profit sharing ratio. The assets are to be revalued. Okay. Well, look at the revaluations done. Building, existing value of the building is given as 18,000, but they are asking the building to be increased to 25. So there is an increase by 7,000 rupees in the value of the building. Next thing is plant and machinery is valued as 12,000. Existing value is 15. There is a decrease in the value, okay, by 3,000 rupees. And we have something like inventories are valued at 12,000. No change in the value of the inventory, but buildings are going up. Next one is trade receivables because of doubtfuls 9,500. What is the existing value of trade receivables is 10,000. They are asking us to reduce an amount of 500 towards provision for doubtful debts. So there is a minus 500 here. Okay. Now that's it. That's all the revaluations are. And it is found that there is a liability for 1,500 for goods receipt but not recorded in the books. You purchased goods, this particular partnership firm, they purchased goods but they didn't record that in the thing. So what will happen? Liability is not recorded. Trade payables will increase with a value for a value of 1500 rupees here. Increase in trade payables to the extent of 1500. The same thing will be recorded in a revaluation. The first thing that we will do on admission of a partner is revaluation. We'll try to see this with the help of a problem here. Look at the solution. Look at the solution, and what is that they are asking us to prepare? They are asking us to prepare journal entries. Give journal entries to record the above and give also the balance sheet of the firm after Sham's admission. First and foremost thing, new partner will bring in capital, and in this problem he is bringing a share of goodwill which is 10,000. Total put together 25 plus 10, 35,000 is coming in. So 2020 January 1st, bank account debit to Sham's capital account 35,000. After that, 10,000 goodwill, whatever is there, will be distributed to the partners in their sacrificing ratio. And what is the sacrifice that they have done? The sacrifice is 1:1, equal. Okay. The sacrifice done by the partners is equal. Look at the calculation here. Ram's old share was 3/5 and Mohan's old share was 2/5. New share is 5/10 and 3/10. When we minus that, we get 1/10 and 1/10. So whatever share of goodwill that is brought in by new partner Sham will be credited to the partners who are sacrificing in their sacrificing ratio, which happens to be 1:1. And what is the amount that Sham is bringing in as goodwill? 10,000. This amount shall be credited. Sham's capital account will be debited and Ram's capital account credited and Mohan's capital account credited. Okay. So the balance in Sham's capital account now comes to 25,000, which is purely towards capital. Next thing, revaluations. Just now we have seen revaluations are done. Plant and machinery has gone down by 3,000. Provision for doubtful is created to the extent of 500 and trade payables is not recorded 1,500. And building got revalued upward 7,000. So net of difference is 5,000 rupees revaluation loss and 7,000 revaluation profit. Net off, when we do, we get a revaluation profit of 2,000, which will be distributed to the old partners in their old profit sharing ratio. That is revaluation account debit to Ram's capital and Mohan's capital, 2,000, 1,200 and 800. Okay. Now, the balance sheet of newly reconstituted firm will look like this. Buildings previous value was 18, added up 7,000 comes to 25,000. Okay. Now, we are writing the revalued figures here. 25,000 is the value. Plant and machinery has gone down by 3,000. The value is 12,000 now. Inventories are 12,000. No change in the inventory value. Trade receivables got decreased. We are anticipating that there will be a bad debt to the extent of 500. Now, trade receivables are standing at 9,500. Bank balance. What is the status quo of bank balance? Original bank balance, if you go back to problem, was 5,000. To this 5,000, Sham has added 35,000. It became 40 now. Now the balance in bank is 40. Trade payables 15,000 existing value, 1,500 unrecorded trade payables amount 1,500 is added, 16,500. And the capital amounts for this we have to prepare what we call as the partners capital accounts. Look at the partners capital accounts are given here. See, opening balance credit side by balance brought down 20,000 and 25,000. Revaluation profit added to the partners capital accounts 1,200 and 800. Cash brought in by Sham 35,000. Out of this 35,000 to Ram's capital account and to Mohan's capital account, the amounts are taken out of Sham's capital account and they are credited here. This is towards goodwill. Credit is given to the sacrificing partners and debit is given to the incoming partner. And when we do the total, that's it. No more appropriations are required. So capital balances are Ram is having 26,200. Mohan is getting 30,800 and Sham obviously only the capital amount is left out because 10,000 whatever is brought in will be given to the partners in their sacrificing ratio. Done. So this is basically a basic level problem with all basic adjustments. So we have passed the journal entries and we have prepared all the required working notes in this particular problem. Now let's do what do we call it as the next problem, CRT problem number 2. Now look at this CRT problem number 2. What is the new thing that is added when compared to the first problem? Observe that the following was the balance sheet of A, B and C who were equal partners on 1st January 2020. Bills payable 3,000, creditors are 6,000, capital accounts are given. A is 20,000, B is 15, C is 10,000, 54,000 total on the liabilities side. Assets are cash is 1,000, debtors 10,000, stock is 12,000, furniture is 5,000, buildings given as 25,000 and bills receivable is 1,000. They agreed to take D into partnership and gave him 1/4 share in the profits on the following terms. That D shall bring in 6,000 for goodwill and 10,000 as capital. This is same, okay, when compared to the previous problem. Now look at this underlying thing. The 1/2 of the goodwill will be withdrawn by the partners. In the previous problem, okay, Ram and Mohan, they never withdrew the goodwill. But in this problem, what is new is the partners are withdrawing half of the goodwill. They are not taking the entire amount of goodwill. How much are they taking? What is their share and all that? We will calculate now. The stock and furniture be depreciated. This is a regular revaluation that has to be done. That a liability of 1,300 be created against bills discounted. They are asking us to create a liability which is a loss, and the buildings are valued at 40,000. That the value of the liabilities and assets other than cash were not to be altered. Very important point. Point number 6 is asking us to conduct the revaluations and find out the profit and immediately reverse all the revaluations whatever are done. So they want only the cash to change, no other assets and liabilities should undergo a change. So all the revaluations, we're talking about revalued assets and liabilities, should be brought back to their original value. So in order to do that, we have to prepare a memorandum revaluation account wherein revaluations are done in the first part, and immediately in the second part we will be reversing all the revaluations. Okay, look at the 6th point, that the values of liabilities and assets other than cash were not to be altered. So how do we do that is, first you do the revaluation, find out the profit or loss, distribute that to the old partners in their old profit sharing ratio, and then reverse all the entries. Whatever previously have got as profit or loss will be the opposite now, and that will be distributed to all the partners including the new partner in their new profit sharing ratio. Okay, we'll see this with a what do we call this solution here. So memorandum revaluation account, and what are the new things that you're learning in this is assets are to be carried at the same value at which they are given here. We're talking about revalued assets which are having a change. Okay, now look at this CRT problem number. Look at the first entry. Obviously, cash account debit to D's capital. What is the amount that D is bringing? D is bringing an amount of 16,000 rupees, 6,000 towards goodwill and 10,000 towards capital. That is going into his account, cash account or bank account, either ways. Cash account debit to D's capital, done. Next one is goodwill. What is their old profit sharing ratio? Old profit sharing ratio of ABC is they are equal partners, 1:1:1. Now they are giving 1/4 share to the new partner D. So obviously the sacrifice will be again in 1:1:1 equal. So this 6,000 rupees whatever is brought in by D towards goodwill will be distributed to the partners equally. So D's capital account, out of the 16,000 whatever is credited to his capital account now, 6,000 is taken out and it is distributed to the old partners in their sacrificing ratio, or you can call it as old profit sharing ratio. Both are one and the same. Now what is the new thing? This entry number 3 is the new one. Out of this 2,000, what is that the partners are doing? Partners are withdrawing only 1/2 of it. Okay, partners can withdraw full amount, but in this problem they said that only half of it is being withdrawn by them. Look at the thing. A's capital account, B's capital account, C's capital account to cash. 3,000 out of 6,000 rupees whatever has been credited to their accounts individually to 2,000 per partner. Out of that they are taking 1,000 each. Look at the next one here. I think we have to carry out the revaluations now. Goodwill part is taken care of. Buildings are increasing. And what is that we are writing? Look at the entry. Buildings account debit to memorandum revaluation account. Okay. We will prepare this memorandum revaluation account whenever the problem is prompting that do not make changes to the revalue assets. The assets are to be revalued, but they should be brought back to their original position. That situation will prepare this memorandum revaluation account, which will comprise of 2 parts. First part is meant for making the finding out revaluation profit or loss, and then immediately the second part continuity will be for reversal of the values there. So building is increasing by 15,000, and memorandum revaluation account debit stock is decreasing by 1,200, furniture is decreasing by 500, and liability for bills is counted as 1,300. Total put together 3,000. There is a revaluation profit of 12,000. Half building value has gone up by 15. Revaluation losses have come to 3. So minus square of that, we have a revaluation profit. So that will be distributed to, this is for the distribution to the partners. Okay, profit. And what is that we are distributing it in? Old profit sharing ratio, which is equal 12,000, 4,000 to A, B and C each. Done. And immediately, since they said that revaluations are not to be shown in the reconstituted balance sheet, we are reversing it. See, previously you wrote the entry writing it as building account debit to memorandum revaluation, and here it will be memorandum revaluation account part 2, the second part, reversal part, to buildings 15,000. All the losses are now debited. Stock will go back to its original position, furniture will go back to its original position, and liability is removed from there. And what is it? Memorandum revaluation account 3,000. Now what is the thing? Previously whatever 12,000 was profit, now it will become loss, and this thing will be distributed to all the partners including the new partner in their new profit sharing ratio. Okay, so A's capital account 12,000, new profit sharing ratio is 1 is to 1 is to 1 is to 1. A's capital 3, all the partners will get 3,000 individually. Okay, so this is how we do. Okay, they have given you the memorandum revaluation list. This is how it looks like. The first part of memorandum, look at the first part of memorandum revaluation account. Losses will go on to the debit side, appraisals in the assets will go on to the credit side. We have got 12,000 which is distributed, and immediately all the things that we have on the debit side as losses will be credited now. See the thing, stock, furniture, liabilities and building will be brought here, and the same 12,000 profit whatever was there in the first part will now become loss and gets distributed to partners in their new profit sharing ratio. Okay, now in this particular problem they have asked you to give the entries, prepare a revaluation account and open up the balance sheet and all that, opening balance sheet and all that. But if you are not asked to prepare revaluation account, then what is that you are supposed to do is find out the sacrificing ratio. Okay, distribute the thing, difference in sacrificing ratio instead of preparing memorandum revaluation account. Okay, what is the difference here? Look at the thing. Previously they had 1 is to 1 is to 1, the same thing, and the sacrifice whatever is on net effect. A is given a credit of 4,000 and he is debited with 3,000 now. So because of that, what will happen? Net effect to his account is 1,000. So you can distribute the, yes, sacrificing ratio, the share of new partner's share in revaluation will be distributed to the partners in their sacrificing ratio. And this is how the balance sheet of newly constituted what we call this partnership firm looks like. Okay, cash has changed. What was the old balance of cash here? Cash balance was 1,000, and now what is the new cash balance here? Cash balance now stands at 14,000. They gave you working note very clearly. Look at the working note here. Cash account opening balance of 1,000. D has brought in 16,000 rupees. Out of that, 1,000 has been taken out. Okay, and the balance is standing at 14,000 now. Okay, now what is the next thing? Balance sheet, partners capital accounts are given here. Balance sheet, will see that. First let us observe partners capital accounts. Opening balances are given here. Then cash brought in by the new partners 16,000 rupees by D's capital. Yes, first distribution of what we call this a goodwill, 6,000 goodwill. This is goodwill part. Memorandum revaluation account part 1, whatever profit 12,000 has come, and immediately that particular memorandum revaluation is reversed on the other side. Okay, and cash account 1,000 is drawn by them. Partners have taken it, and this entire 6,000 taken by the partners goodwill credit part, whatever is this, debited to D's capital account. Next, cash account is over. Let's see the balance sheet. Balance sheet only except for cash. I don't think anything will change here. All the assets will remain at its original value. Okay, except for the capitals will undergo change, and whatever change happens in capital accounts will be there in the cash account. Okay, so this is your CRD problem number 2. Let's see another problem here. So this particular problem, in problem number 2, you have learned something like Partners, when they withdraw the goodwill, what will happen when they withdraw the goodwill? And the concept was memorandum revaluation. When revaluation is done and immediately the revaluation is reversed, how do we show the thing? Let's see the next one, CRT problem number 3. Let's try to find out what is a new point that is added in this particular problem. Dalal, Banerjee and Malik are partners in a firm sharing profits and losses in the ratio of 2:2:1. Their balance sheet as on 31st March 2020 is as below. Sundry trade payables 12,850, outstanding liabilities 1,500, general reserve. This is the first time that you are getting accumulated profits or reserve being created by the partners for unforeseen future contingencies. Okay, so this reserve has to be distributed before giving the effect of admission. Let's see who will join and all that. Capitals are given: Dalal 12,000, Banerjee 12,000, Malik 5,000. Assets are given here, nothing new in the assets here. They agreed to take Mistry as partner with effect from 1st April 2020 on the following terms. Now, Mistry shall bring 5,000 towards his capital and nothing is mentioned regarding goodwill. It means that Mistry is bringing only capital. He is not bringing anything towards goodwill. So what is that we have to do? Whatever sacrifice is done by the partners, it will be taken out of capital amount of the new partner. So Mistry's capital 5,000, it will be adjusted and it will be reduced to the extent of goodwill that the partners are supposed to get. Okay, this is one new point that is added. General reserve is the first thing. The value of the inventory should be increased by 2,500 and furniture should be depreciated by 10%. Revaluations are to be done. Reserve for bad debts to be maintained at 10% of trade receivables. Value of land and building should be enhanced by 20%. The value of goodwill be fixed at 15,000. What is this? This is not the share of Mistry. The full value of goodwill is given as 15,000. Okay. General reserve will be transferred to partners capital account. They told you very specifically here, even if it is not given in the problem specifically, general reserve must be distributed to the old partners in their old profit sharing ratio before reconstituting or before admitting the new partner Mistry. The new profit sharing ratio shall be 5/15, 5/15, 3/15 and 2/15. Outstanding liabilities include 1,000 due to Mr. Sen, which had been paid by Dalal. Necessary entries are to be made in the book. So, there is a liability in your balance sheet. Yeah, this particular liability, outstanding liabilities are standing in the balance sheet at 1,500. Out of this 1,500, 1,000 was payable to a person, Mr. Sen. And who should pay this? Firm should have paid it. But who paid it? Dalal, one of the partner, cleared it. So it should be credited to his partner account because yes, firm's liability has been cleared by one of the partner. This thing will lead to an increase in capital. Okay. And what is that they are asking you to prepare? Revaluation account as usual. Capital accounts of the partners, balance sheet of the firm after admission of Mr. Mistry. Okay. Now let's see the solution part here. CRD problem number 3, revaluation account. Let's see the revaluation losses. Furniture and fittings got decreased by 650. Is it? Furniture is decreasing by how much? You depreciated by 10%. Is it 6,500? Yes, 6,500. Revaluations are carried out here. Let's see the thing. Furniture is decreasing and provision for outflows. Only 2 losses are there on revaluation. And by inventories are increasing. Inventories are increasing by 2,500. Land and buildings have gone up by 5,000. Total 7,500 minus 1,200. Okay. So are we getting 6,300? And what is this? Revaluation profit to be distributed to old partners in their old profit sharing ratio. Dalal gets 2,520. Banerjee gets 2,520. Malik gets 1,260. Okay. Revaluation is not that complicated here. Look at the partners' capital accounts. Initial capital brought in by them is 12,000, 12,000 and 5,000. General reserve. Immediately after writing the opening capitals, distribute the general reserve. Okay, it is very specifically given in the problem as an adjustment. Even if it is not given in the adjustment, you have to distribute it. Then bank, Mistry has brought in only 5,000 rupees as right. Now, what is the goodwill value given here? 15,000 is the value of the goodwill. And what is the share of Mistry? 2/15. Okay, 2/15 out of this comes to 2,000 rupees. Now, if Mistry is getting 2,000 out of 15,000 entire value, that thing must be sacrificed by either Dalal, Banerjee or Malik, or any two of them or any one of them. Who is sacrificing it? We'll see that in a calculation here. Look at the calculation of sacrificing ratio. Dalal, previously he was getting, old ratio was 2 by 5. Now he is taking 5 by 15. Okay. So technically he is sacrificing 1 by 15. Banerjee was previously getting 2 by 5. Now he's taking 5 by 15. Again, even Banerjee is sacrificing 1 by 15. Malik is not sacrificing anything. So this 2,000 rupees, whatever share of Banerjee is there, Mistry is there, that will be distributed to the partners. Okay. So either you can do it directly, sacrificing ratio, take this ratio as such, 15,000 into 1 by 15, 1,000 to Dalal and 1,000 to Banerjee, or you take only the share of Mistry 2,000 and distribute that in 1:1 ratio. Either ways it can be done. So let's go back to the partners capital accounts. Mistry's capital account, okay, how much is being transferred? Credited to Banerjee and Dalal and Banerjee. Malik is not sacrificing any profit. Whatever he was getting before admission of Mistry, he is getting the same share in the profits. Okay. And the same amount has been debited to Mistry's capital account. And what is the balance in his account? Out of 5,000, if 2,000 goes off, 3,000 is the balance. Let's do the balancing now. And revaluation account, the profit part is created. Outstanding liability. This is something new where we have seen out of outstanding liabilities of 1,500, 1,000 pertaining to Mr. Sen was cleared by Dalal. So it is technically an additional capital brought in by him. It should be increasing his capital. We are writing it here. Okay. So the balance carried down is, put it on a calculation and tell me, 19,120, 18,120, 7,560 and 3,000 rupees. That's it. Now, let's see the balance sheet of the newly constituted firm, including the new partner thing. Land buildings have increased by 5,000, 30,000 is the value. Furniture gone down by 650, 5,850. Inventories, 14,250, they have increased. Trade receivables, we have created a provision at the rate of 10%, 4,950. Cash in hand, 140. Cash at bank increases, yeah, 5,960. Partners are not drawing it. Partners are not taking it. Problem is not prompting that the partners are taking it. Sundry trade payables, no change, but outstanding liabilities, previously it was 1,500, now it is only 1,000 because it is cleared by Dalal. Okay. And the capitals as per our partners' capital accounts are taken here. Okay. This is your CRD problem number 3. So what is the new thing that you have learned in this problem is general reserve, that is previously accumulated reserves are to be distributed. And the new partner is bringing only capital and he is not bringing the premium, that is goodwill. So in that case, whatever sacrifice is done by the sacrificing partners, they should be credited the amount of goodwill from the capital amount brought in by the new partner. That is new in this particular problem. Let's see the next problem. Problem number 4. CRD problem number 4. A and B are partners in a firm sharing profits and losses in the ratio of 3:2. The balance sheet of A and B as on 1st January 2020 is as follows. Trade payables are given 17,000, bank overdraft 9,000, and capital accounts are given as 44,000 and 36,000. 80,000 is the capital and 1,06,000 is the value of liabilities. Asset side, buildings are there, furniture, stock in trade, debtors already there is a provision of 200 anticipated bad debts. Investments are given as 2,500 and cash is 15,500. C is admitted to the firm on the above date on the following terms. First one, he is admitted for 1/6 share in future profits and to contribute a capital of 25,000. The new profit sharing ratio between ABC will be 3:2:1 respectively. C is unable to bring in cash for his goodwill. Same story. Partners therefore decide to raise the goodwill account in the books of the firm. They further decided to calculate the goodwill on the basis of C's share in profits and the capital contribution made by him. Furniture is to be written down by 870, stock to be depreciated by 5%. A provision is required to be debtors at like 5%. Already we have a provision, we'll compare, and excess required will be transferred. A provision would also be made for outstanding wages of 1,560. They forgot to write outstanding wages in balance sheet. The value of the building having appreciated to be brought up to 29,200. the value of investment is increased by 450. It is found that creditors include a sum of 1400 which is not to be paid off. Okay, this is an advantage. Whatever amount is there in the creditors, out of that 1400 need not be paid. The firms, it is a gain to the firm. Okay, the thing is, in this particular problem, they didn't mention anything about goodwill, but they have given you a hint that goodwill shall be taken based on the capital invested by the new partner and the share whatever is offered to him, that will become ground. And this is called as a hidden goodwill problem, where we find out the value of the goodwill based on the capital brought in by the new partner and comparing it to the share of profit that he is taking. When you reciprocate that, it gives you the total amount of capital to be maintained, and when we deduct the existing capital amount, the difference will be goodwill. Look at the thing here. Let's do a calculation here. If 25,000 is brought in by C for 1/6 share, what should be the total capital of the firm? 25,000 into 6 by 1 will give us what? Into 6 by 1, reciprocate that and see, 1,50,000. This should be the capital based on C's amount of capital. Now, what is the existing capital of the firm? That is 80,000. That is, this is A and B. And if we include C, it will become 1,05,000. So, what is the difference between these two? 1,50,000 and 1,05,000. We take the goodwill value as 45,000. Okay, this is what we call it as a hidden goodwill problem, where goodwill calculation or goodwill amount is not given to you, but goodwill will be based on the amount of capital brought in compared to the share of the new partner. 45,000 will be the value of goodwill. Let's see that calculation here. Yes, calculation of goodwill. Look at the thing. C's contribution of 25,000 consists of only 1/6 of the capital. So when I raise it to the full value, therefore the total capital of the firm will be 25,000 into 6. That is reciprocating it, 1,50,000. But combined capital of ABC amounts to 44,000, 36,000, 25,000, 1,05,000. So what is the goodwill? Hidden goodwill value is 45,000, and this will be distributed in the ratio. What is the ratio? Sacrifice. Yeah, when it is given as 1/6, he is taking 1/6. The partner's old ratio, old profit sharing ratio will be the sacrificing ratio. It will be there in the same proportion. We don't have to calculate that. So A is supposed to get how much? 7,500. How did he get this 7,500 here? Out of 45,000 rupees total value of goodwill of the firm, if 1/6 of share is of C, his share will be 7,500, and the 7,500 will be distributed to A and B in their sacrificing ratio, that is 3:2. 4,500 will go to A and 3,000 will go to B. Okay, done. So this is what is given, and let's take care of what we call as the revaluation part. Let's first see the revaluation account here in the books of ABC. Buildings value has gone up by 3,200. Sundry creditors value has gone up by 1,400. Investments have gone up by 450, and furniture value has decreased by 870. Stock value has decreased by 1,070, and provision to be created, right? What is the debtors value that is given? 35,000. Don't take it on this, take on the gross value, this amount. And what is that they are asking you to create? How much provision to be maintained? 5%, which comes to how much? 1,750 minus existing provision. Already we have 200 existing provision, so additional provision to be made is 1,550. That's again a loss to us. So outstanding liabilities part, outstanding wages part, 1,560 given in your problem here. Yes, outstanding wages here, 1,560. Now what is the thing? Your revaluation account is in a, what do we call it? We don't have any profit or loss on revaluation, so nothing from revaluation will be transferred to partners capital accounts. Let's see the partners capital accounts here. Balance brought on 44,000, 36,000 of A and B. This guy is bringing cash of 25,000. Capital accounts are credited with 4,500 and 3,000. And what is this thing? Goodwill. And these two amounts, 7,500 shall be debited to C's account. That's it. What is the balance carried down now? 48,500. Only thing that is getting added to the partners capital accounts, old partners, is only goodwill amount. Nothing is getting added to their accounts. Okay, but 36 has now become 39, and C's capital balance will be 17,500. Let's see the reconsidered firm's balance sheet. Buildings have gone up by 3,200, 29,200. Furniture 5,800 minus 870, 4,930. Stock in trade 21,400 minus 1,070, 20,330. Debtors 35,000 balance was there. Previously 200 was the old provision. Now the provision is raised to 1750, 33,250. Okay. Investments have gone up and cash has gone up by 2,000, 25,000. Now it is 40,500. Capitals, we have seen the amounts here. Bank overdraft remains the same. Creditors will increase. Creditors have decreased. We don't have to pay. Yeah. There is a decrease in the value of the creditors. See the last adjustment. It is found that the creditors include a sum of 1,400 which is not to be paid off. This is an advantage to us. Okay. And outstanding wages are standing to the extent of 1,560. This is the balance sheet of newly reconstituted firm. Okay. Now, what is the next question? Let's see the next question here. Next problem. CRD problem number 5. And let's see what is the new thing that we'll find in this. Lina and Meena were in partnership business, sharing profits and loss in the ratio of 2:3. Their balance sheet as on 31st March 2020, as it is given as follows. What is it? Capital Lina and Meena 60,000, 1,40,000. General reserve. Okay. General reserve. And we have something called as workman compensation or workman accident fund. Just like the way general reserve is created from the divisible profits, these partners, Lina and Meena, they created a workman accident fund just in case maybe the industry in which they operate their business, there will be a chance of what we call as some sort of small injuries being sustained by the employees. So for that purpose, they have created this fund. Okay, this is a yes, just like the way general reserve will be distributed, even this thing shall be distributed to the partners, old partners in their old profit sharing ratio, provided there is no liability pending towards this workman accident fund. Okay, if there is a liability, you're not supposed to distribute it. If there is no liability, then they will distribute it. We'll see that down the line in the problem. So this is something new that you're doing it for the first time. Workman accident fund, creditors, bills payable here, goodwill. This is the first time you're seeing goodwill inside a balance sheet. This is old goodwill which was purchased by the firm. That is, Lina and Meena, they paid and they acquired some business. In a way, they paid 60,000 rupees for acquiring goodwill of that particular business. They must have taken over some business, existing business, and only purchased goodwill appears in the books of accounts. This is something new. What is that we will do with that? We will see that in a moment. Building 60,000, plant 45,000, furniture 23,500, debtors given as 38,400, bills receivable 12,500, stock and bank balance. Okay, now who is joining them? On 1st April 2020, they have decided to admit Nina into partnership, giving her 1/5 share in future profits. She brought in 80,000 as her capital. Partners decided to revalue the assets. Okay, goodwill 1 lakh. The new goodwill for the purpose or before the admission of Nina, when they valued it, the goodwill is 1 lakh. Already you have an old goodwill. This goodwill will be removed, or this goodwill shall be removed from the balance sheet. And how do we do that? I'm removing goodwill which is there on the asset side. Equal amount will be removed from the partners capital accounts, old partners in their profit sharing ratio. The goodwill will be removed. That will be the first entry that we'll be writing. Okay. Then new goodwill is given as 1 lakh. Plant is given as 40,000. Is it decreasing? Yes, there is a decrease in the value of the plant by 5,000. Debtors 38,000. There is a drop by 400. Stock is 42,000. Where is stock? Yes, decreasing by 600. Buildings 90,000. Existing value is 60,000. 30,000 increases there in the value of buildings. Furniture 20. Bills receivable will be preparing a revaluation account anyhow. There is no actual liability towards workmen accident fund. So just now we have discussed what is this? There is a workman accident fund which is created by the partners out of their profits. Okay, and there is no liability pending towards it. Then it becomes a free reserve which can be distributed, yes, to the old partners in their old profit sharing ratio. Okay, next one. Goodwill was appearing in the balance sheet as on 31st March 2020, and it was purchased goodwill. Just now we told you, just now we have discussed that the partners, old partners, they must have taken over an existing business, and while purchasing that business, they have paid 60,000 for the goodwill of that particular business. That is the reason why when goodwill appears in the balance sheet, existing balance sheet, it means that this is a purchased goodwill. They paid 60,000 extra over and above the net worth of that particular business, and we are calling it as goodwill. And what is that we have to do? The partners also decided not to show goodwill in the books of the new firm. So old goodwill will go off and new goodwill will not appear. We'll adjust that in the new partners capital account, and whatever sacrifice is made by the existing partners. You are required to show the following accounts in the books of firm. Profit and loss adjustment account. Usually it will be whatever name of the account is given, use the same name. If they are calling it as revaluation account, write it as revaluation account. If they are calling it as P&L adjustment account, write as P&L adjustment account. Partners capital accounts and the balance sheet. As usual, the regular solution. Okay. Now, what are the new things that we have come across in this is important. CRD problem number 5 in the books of Lena, Meena and Nina. P&L adjustment account, the so-called revaluation account. Building is the only asset which is having an increment of 30,000 rupees, and all the other assets are undergoing a decrease in the value. Plant has gone down by 5,000, debtors have gone down by 400, stock has gone down by 600, furniture goes down by 3,500, bills receivable by 500, and when we square off, we are getting a total of 20,000 revaluation profit. Okay, and 20,000 revaluation profit shall be distributed to the old partners in their old profit sharing ratio, which is 2:3. Is it 2:3? It's 2:3. Done. Then partners capital accounts. Look at the thing here. Balance brought down. Lena and Meena 60,000, 1,40,000. By bank, 80,000 is brought in by Nina. Goodwill adjustment 8,000, 12,000. How is it 8,000 and 12,000? We'll see in the calculation. Which a calculation is not given. Why? Because, yeah. What is the share that is given to her? 1/5. Obviously, what will be the sacrificing ratio? 2:3 is the sacrificing ratio. So out of 1 lakh goodwill value, what is the share of Nina here? 1/5. So out of 1 lakh, 1/5 comes to, out of this 1 lakh, 1/5 comes to 20,000, and this 20,000 rupees shall be divided between old partners in 2:3 ratio. That's what they have done here. Okay, goodwill adjustment is done. Okay. General reserve is distributed. This is a regular one. And look at the next one, by workman accident fund. Since there is no liability towards workman accident fund pending, it is to be counted as a free reserve, and it can be taken over by the old partners in their old profit sharing ratio. Revaluation profit 8,000 and 12,000. Debit side, goodwill balance sheet thing. Okay, this, what is this thing? 24 and 36 is nothing but your old goodwill which is there in the books of accounts already. Balance sheet asset side, we have got goodwill. That goodwill shall be distributed to the old partners and debited to them, not remove it. Okay. And Lena and Mina's capital, 20,000 rupees will be taken out of Nina, the new partner, who is not bringing in any amount towards premium. That is goodwill. Goodwill adjustment is done, 20,000. Do the balancing. You should be getting 68,000 in case of Lena, and 1,52,000 in case of Meena and Nina, 60,000 rupees. Done. Let's see the balance sheet of the newly reconstituted firm. Building increased by 30,000, comes to how much? 90,000. All the other assets, technically they have gone down. Okay. And bank balance, how much increases there in the bank balance? 80,000 rupees increases there in the bank balance, because Nina has brought in how much capital? 80,000 rupees is capital. Okay. Now, liability side, capital, Lena, Meena and Nina, creditors 42,600, bills payable as so. Okay. So this was your admission of a partner. Most of the problems, and yes, every problem. Careful with the goodwill calculation and hidden goodwill problem. Fourth problem, what we have seen. At times they will not be, the problem will not be prompting anything about goodwill. They'll just say that calculate based on the profit given and all that. Usually they will be giving you the. So we are done with the admission of a partnership part 1. Unit 3. We'll continue with retirement of a partner. Chapter number 21, partnership accounts 2. In that, Unit 4, retirement of a partner. So, from an existing partnership firm, when one of the partner retires because of obvious reasons, what will be the accounting treatment and what are all the adjustments that are to be done to the books of accounts of a firm? Okay. So, generally, a partner retires from the business because of age or illness or because of obvious reasons. He is retiring from the firm. So generally, the business of a partnership firm may not come to an end when a partner retires. What will happen is the other partners, the continuing partners will be there. They will continue the business, or some new partners will be taken in the place of old partner or partners. Okay. So just like the way we did, what do we call this? Adjustments in the admission of a partner, we'll be doing adjustments here, but one extra adjustment will come. What is that? Previously, if you remember, we have done 5 adjustments. Okay, first one, what is the first one? Adjustment in profit sharing ratio. Previously, we found out new profit sharing ratio, and there was something called a sacrificing ratio. And here we'll be finding out new profit sharing ratio, but this time we'll have a gaining ratio. Why? Because if the old partner, one of the partners out of 3 partners is retiring, the share of the retiring partner will be taken over by the continuing partners. So they'll be technically gaining in the profit, future profits. So adjustment of goodwill, same old story. Adjustment of profit and losses arising on revaluation. Adjustment of accumulated profits, and what do we call this? Adjustment of capital, if agreed, this again. And the sixth and the new one is adjustment of life insurance policies. That is, 2 different types of policies are taken by the firm. One is a joint life policy, that is one policy taken in the name of all the partners by the firm, or the firm takes individual policies in the name of each partner. And what is the accounting treatment and all that, we'll be seeing down the line with a dedicated problem for JLP and ILPs. So adjustment in profit sharing ratio, the same old adjustment that we have done. Then we'll be doing calculating something called as new profit sharing ratio and a ratio called as gaining ratio. Then we'll be seeing the revaluation, adjustment of goodwill, revaluation of assets and liabilities as such. Now let's see this with the problem here. Now we have categorized the problems into 2 parts, that is problems without JLPs and problem with JLP thing. Okay, so the firm has not taken a JLP and one of the partner retires from the firm. What are the adjustments to be done to the existing books of accounts of a firm? Look at the problem here. CRD problem number 1. FG and K were partners sharing profits and losses in the ratio of 2:2:1. K wanted to retire on 31st December 2020. Given below is the balance sheet of the partner as well as other information. Capital accounts are given. F is 1,20,000, G is 80,000, and K, the retiring partner, who is retiring, K is retiring, that would be 60,000 rupees. So he's a tiny partner, 60,000 rupees are required. And one challenge that you will face while dealing with this retirement problems is we need to find out how much amount is to be paid, and while reading the problem itself, try to conclude or try to arrive at how much money is required to be discharged in order to move the retiring partner out of the business. Okay, so K is to be paid what do we call as 60,000. Second thing that you see in your balance sheet is reserves. Obviously this guy will have a share in this, and what is his share in the profits? His share is 1/5. So can I say that 1/5 of 10,000 belongs to this guy? 2,000 rupees. So technically 60,000 rupees capital, 2,000 rupees reserve, 62 till now. Okay, trade payable, keep it there. We'll continue with that amounts to be given to the retiring partner. Sundry fixed assets, inventories, trade receivables, including bills receivable, 20,000. There is a reason they have split the amount into 2 parts. Maybe they will have a revaluation point there. Bank is 50,000. Now, one more thing to observe. They have a bank balance of only 50,000. And do you think this firm is in a position to, can they discharge the liability of retiring partner K? No. Why? Capital alone is 60,000 and there is an addition towards reserve is 2,000 is added, 62,000, and down the line we'll get what we call as goodwill is pending and revaluation profits if any are pending. So firm, they don't have sufficient cash balances. So either the old partners, they have to bring in additional capital to discharge the liability of the retiring partner, or it has to be transferred to a loan account. They don't have a choice. F and G agreed to share profits and losses in the ratio of 3:2. New profit sharing ratio is given. Value of the goodwill was to be taken as 50,000. No calculations required. Goodwill value is taken as 50,000. Whole value of the goodwill. Sundry fixed assets were revalued upward by 30,000 rupees. So fixed assets are going up by 30,000. Next, inventories by 10,000. We have an increase in inventories value by 10,000. Bills receivable dishonored 5,000 on 31st December 2020, but not recorded in the books. So nothing is recorded here. Dishonor of a bill was due to insolvency of the customer. So technically, there is no way that this money will come back. So what is that we are doing? Out of bills receivable or trade receivables, minus 5,000 rupees. Person is declared as insolvent and it will not be anywhere sooner. You will get a clarity about this. So as of now, we are treating it as a loss. So technically, 5,000 is gone. F&G agreed. That's it. Revaluations are over. F&G agreed to bring sufficient cash to discharge the claim of K. So what is that they are planning? Just now we have discussed. Okay. How much money is required to be paid to the retiring partner? Whatever deficit part is there, that will be brought in by the partners here. Follow this point carefully. This is the element that you have to be very keen while doing this problem. FNG agreed to bring sufficient cash to discharge claim of K and to make their capitals proportionate in proportion of their profit sharing ratio. Also, they wanted to maintain 75,000 balance for working capital. So, three conditions. They should bring the money in such a way that they'll be discharging K's amount, that is due amount, and they are planning to make their capitals proportionate. Okay, and what is the next thing? Also, they wanted to maintain a bank balance. So what is the bank balance as of now? Focus on that. Bank balance as of now is 50,000 only. So, what is a claim of this retiring partner K? 60,000 capital, 2,000 reserve. Okay, we have goodwill. Out of 50,000 goodwill, his share is 1/5. So technically, 10,000 rupees goes to him, 72,000. And what is the revaluation part? Revaluation profit are 40,000 minus 5,000, 35,000. Out of 35,000, this guy's share is 7,000. So it comes to roughly, not roughly, exactly 79,000 rupees are to be paid. So they need 79,000 rupees to discharge the liability towards K, and they are planning to maintain 70,000 balance. Total put together 79 plus 25,000. How much would that make to? 1,04,000. So we know the amount. How much amount should be brought in? We know the total, but who should bring how much? How do we calculate that? Is only by preparing a partners capital accounts, and we have to find out what is the capital that has to be maintained by FNG. Okay, so what is a new point in this is they have given you three different points wherein you have to be adjusting the bank balance in such a way that we should find out how much of capitals are to be maintained by the partners and how much money will be brought in by them accordingly. Let's try to see this in a solution here. CRD problem number 1. Look at the journal. So they're writing journal entries also. Yeah, pass the necessary journal entries, prepare capital accounts of the partners, and draft the balance sheet of Messrs. F&G after case requirement. Right. So journal entries in the books of F&G, the newly reconstituted firm, 2020 December 1st. F's capital account debit to K's capital account. Goodwill. Okay. Who is sacrificing? Just by seeing the ratios, we can say F, G, and K were previously taking the profits in 2:2:1. Now, whatever share of K was there, 1 out of 5, is being absorbed by F. There is no need of calculating a sacrificing ratio at all because K's share is going directly, gaining ratio, not sacrificing ratio, gaining ratio. K's share is directly going into F's account. So, who is gaining? Only F is gaining. G is not gaining anything. That is the reason why F's capital account debited with 10,000, credited with 10,000 to K's capital account. Done. Revaluation. Just now we have discussed revaluations. I think there is a revaluation of 35,000. Let's see the revaluation account here. Yes, revaluation account is not given, but yeah, revaluation account we have already calculated. 35,000 is the value of revaluation, and out of that, no, reserves are being distributed first. Reserve is 10,000. Okay, 10,000 being distributed in 2:1 ratio. Then fixed assets and inventories are increasing, 40,000. P&L adjustment account debit to trade receivables, there is a decrease because there was a bill dishonor, 5,000. 35,000 is the revaluation profit or P&L adjustment account balance, which is distributed to the partners in the old ratio, 2:1. Done. And after that, what is the next thing? 1,04,000. Even we have calculated while doing the problem, 1,04,000 has to be brought in, but F has to bring how much and G has to bring how much? How do we find out? Yes, I'll prepare a statement. Look at this statement. After preparing this statement, calculation of total capital of the firm. Total capital of the firm, I will write the revised figures or revalued figures of all the assets and liabilities. Fixed assets 1,50,000 plus 30,000, 1,80,000. These are the figures that will go into your closing balance sheet. Inventories 60,000. Trade receivables after removing the 5,000 rupees bill, they come to 65,000. Bank balance, they are planning to maintain. This is something that is given in the problem. They are planning to maintain 75,000. The total of the asset side should be 3,80,000. Out of this 3,80,000, when I remove all the liabilities, how many liabilities? Reserves are gone, trade payables, only one liability is there, 50,000 rupees. The balance should be towards the capital of the firm. The capital of F and G should be total to 3,30,000, and this will be distributed in their profit sharing ratio, 3:2 ratio, which comes to 1,98,000 and 1,32,000. Now we'll transfer this value to the partners' capital accounts to find out who is bringing how much. Look at the thing. The answer, whatever we have calculated just now, partners' closing balances already they are calculated here. Okay. The balance will be, what will be the balance carried down here? That will be 1 lakh. This is the thing. 1,98,000 of F. Okay. And 1,32,000 of G. If this is the amount that they have to maintain, how much amount should be brought in by them? Okay. Rest of the adjustments are same. Let's conclude all the adjustments and then we'll come to this. Opening balance 1,20,000, 80,000 and 60,000. F's capital account 10,000 rupees. That is goodwill to be credited to K and it is obviously debited to F. Goodwill is over. P&L adjustment account 14,000, 14,000 and 7,000. Reserves are distributed, 10,000 worth of reserves. Okay, 1,38,000. They made the total here. 1,38,000 is the total. Right? Balance carried down. First, we are dividing the capital accounts in two parts to find out what is the thing. So you can do it directly also without totaling, having two totals. Okay. Now, if the balance brought down is 1,28,000, 98,000 and 79,000 and they have to maintain, F and G have to maintain this 1,98,000 and 1,32,000. How much amount should be brought in? Will be, look at the thing here, 70,000 should be brought in by F. Why? 198 is required to be maintained. He has got only 128. 198 minus 128, 70 is brought in. And G should maintain 132, but he has got only 98, 34,000. Total comes to 1,04,000. Okay. So for this purpose, we have to prepare a what we call a statement, which shows us what should be the total capital and how much should be brought in by which partner. Okay. So this is your CRD problem number 1. What is a new thing? What is unique thing is 79. One more thing. 79,000 is discharged. 79, they were planning for it, right? So having 50,000 balance, what is the existing balance? 50,000 is the existing balance, correct? So having 50,000 balance to 50,000, what is that they are adding? 1 lakh 50,000 rupees plus 1,04,000. 1,54,000 minus 79,000. What is the claim of K? 79,000. Okay. And that amount, when it is paid, the balance in your cash account or bank account will be 75, whatever they are planning to maintain. Okay. So this is your CRD problem number 1. Let's see the next problem. Okay. Messrs X is a partnership firm with the partners ABC sharing profits and losses in the ratio of 3:2:5. The balance sheet of the firm as on 30th of June is as under. Capital balances of ABC are given, long-term loans, bank overdraft and trade payables. Land 1 lakh, buildings 2 lakhs, plant and machinery 3 lakhs 80,000, investments 22. Inventories 1 lakh 16,000 and trade receivables are 1 lakh 39,000. 9 lakhs 57,000 rupees is the total of the balance sheet. It is mutually agreed that B will retire from the partnership and in his place D will be admitted. So this is a combination problem, a hybrid problem where retirement and admission are taken care of in the same problem. As a partner with effect from 1st July 2020, for this purpose the following adjustments are to be made. Goodwill of the firm is to be valued at 2 lakhs due to the firm's location advantage, but the same will not appear as an asset in the books of reconstituted firm. Same old treatment. Buildings, plant and machinery are to be valued at 90%, 85%. So they are decreasing by 10% and 15% respectively. Investments are to be taken over by the retiring partner. This is something new. Investments, whatever are there, what is the value of investments that you have in your question? Investments are standing with a value of 22,000. These investments will be taken over by B, who is retiring. Okay, so firm is making a profit. 22,000 worth of investments are handed over to the retiring partner at 25. There is a profit of 3,000 rupees that will be routed through your P&L adjustment account or so-called revaluation account. Trade receivables are considered good only up to 90%. So balance 10% is considered as bad for the balance sheet figure and the balance to be considered bad. Done. In the reconstituted firm, the total capital will be 3 lakhs, which will be contributed by ACD in the new profit sharing ratio, which is 3:4:3. So they have given you the hint that what will be the balance brought down from the partners' capital accounts to balance sheet. So 3 lakhs, when it is divided between partners in the ratio of 3:4:3, 90,000, 90K, 120K and 90K. Is it? So this should be the closing capitals of the partners. So they have given us the closing capital. Accordingly, if required, they have to fill the amount. If there is a shortfall, they have to. If there is excess, they can withdraw. But I don't think you will have a situation where it is an excess because retiring partner B has to be, yes. Are we discharging is the question. The amount due to the retiring partner shall be transferred to his loan account. We are not paying it. The firm is not in a position. Look at the balance, liquidity. Already they are having liquidity crisis. What is the liquidity crisis? They have a OD of 44,000 and no cash balances are there on the asset side. That is the reason why, in order to, yes, they are not in a position to pay the amount to the thing. And one more thing is, how much amount should be brought in by D is not clarified anywhere. Only thing that we know is 90,000 rupees towards capital is clear. Just now we have calculated 3 lakhs divided in the ratio of 3:4:3. The last 3 belongs to D. He should bring 90,000 towards capital, but how much towards goodwill? Okay, goodwill of the firm is valued as, so how much would that be? 60,000, correct? 2 lakhs, look at the calculation here. If 2 lakhs is the value of the goodwill, obviously what is the share of this guy? New partner D. D's share is 3/10. 3/10 comes to 60,000. The total is 60,000 towards goodwill and 90,000 rupees towards capital. Total amount of 1,50,000 should be brought in by the new partner T. Okay, very important problem because this is a problem which combines the admission of a partner and retirement of a partner together. Let's see the revaluation account of this particular problem. What are the increases? Investments, they made a profit. This is not increasing, but this particular investment is taken over by the retiring partner B and he has agreed to take it at 25,000, leading to a profit of 3,000. Look at the changes. There are all decreases in the value of the assets. Buildings have gone down by 20,000. Plant and machinery has gone down by 57,000. Bad debts only 13,900. I think 1 lakh. What is the debtors value? 1,39,000. Yes, 10% drop is there. 90,900 minus 3,000, 87,900 revaluation loss is there, which has to be borne by the partners in their old profit sharing ratio, which comes to 26,370, 17,580 and 43,950. Let's see the partners' capital accounts now. Partners' capital accounts, we already know the closing balances. Why? The problem is very clearly stating that the new partnership will have a capital of 3 lakhs and which shall be contributed by the partners in their new profit sharing ratio, which comes to 90,000, 1,20,000 and 90,000. We already know the answer. Let's see the other appropriations done to the partners' capital accounts. 1,04,000, 76,000 and 1,40,000 is the opening capital. D shall bring in how much? Okay, D's capital account, this is goodwill part. Okay, look at the thing here, 1,50,000. As of now, focus on amount to be brought in by the new partner, 1,50,000. And what is the breakup? Just now we have seen the breakup of this thing is 90,000 towards capital and the 60,000 part is towards goodwill. Okay, we don't have to do a working notes, you can, but still will show because the evaluator should know. Now, goodwill part, 40,000 is going to B and 20,000 is going to C. How is it possible? Okay, let's see the thing. Adjustment of goodwill. Goodwill of the firm is valued at 2 lakhs. ABC, sacrificing ratio. Okay, A is not sacrificing anything because previously he was having 3/10, even now he is having 3/10. B, obviously retiring partner, he is sacrificing everything because he is going out. C, 5/10 and 4/10. Being an old partner, even C is sacrificing. So B and C are sacrificing. A is neutral. So who should be compensated now? B and C should be compensated. How much amount should be compensated to them? 40,000. What is the share? 60,000 rupees. Like, look at the sacrificing ratios here. 2/10 and 1/10. And 3/10 is going to this guy. B is sacrificing his entire 40,000 share. And C is sacrificing 20,000, 60,000 rupees. That is the amount which is created here by D's capital, 40,000 and 20,000. Done. Revaluation loss. Look at the debit side here. Revaluation loss, just now we have calculated 60,000 rupees is debited to this guy's account, of 1,50,000 is the capital that is brought in by him. Okay, and investments are taken over by B. Now, first let's calculate the amount due to B. Total on the credit side comes to 1,16,000. 116 minus other amounts, 73,420. Are they paying anything? Are they paying any part of it? No, nothing is being paid. The amount due to the retiring partner shall be transferred to loan account. So what is the loan amount? B's loan account is 73,400. Done. Now this amount will appear in the balance sheet on the liability side because it is a loan. Let's see, the balances are already given. Now we have to find out, do the debit side total first. Check which side is more. Debit side is more. Minus credit side, only one amount in A account. So technically this guy has to bring additional capital. How much is he bringing? 12,370 is coming in. And C is bringing how much? 3,950. This will affect your bank OD because these guys are having a bank overdraft, isn't it? Bank OD will be affected. Let's see that in the solution. The partners' capital accounts are over. So what is the next thing that we are preparing here? They didn't ask you for balance sheet. Balance sheet is up here. No, only revaluation account and yeah, they didn't ask us to prepare the balance sheet. Okay, having bank overdraft, this amount will reduce the bank overdraft. They are not asking us to prepare balance sheet. Not required, right? Now, so this was your problem number 2, which is a hybrid problem where admission and retirement are handled simultaneously. Now, let's see the next topic. So, part 2, problems with joint life policy. This is one of the additional adjustment. Okay, this was the new thing. When we compare it with the admission of a partner and to retirement of partner, adjustment of JLPs and ILPs are done. This is one more additional adjustment that we'll be doing when it comes to retirement and death as well. Okay, so problems with the joint life policy. What exactly is this joint life policy? Okay. Joint life policy. One policy is taken by the firm. Okay. Firm is taking the policy and firm is paying the premium. And why this policy is taken? Tomorrow morning in the event of retirement, just now we have seen firms are having a hard time in repaying the money. They are transferring the money to the loan account of the partners and they are paying interest on that. So in order to overcome this kind of situation, firm takes a joint life policy, one policy in the name of all the partners, and this money, okay, they surrender. Imagine like firm has taken a policy and in the event of retirement of a particular partner, the firm will surrender this policy to the insurance company. They will get surrender value from the insurance company and this money can be used for repaying the amount to the retiring partner. Okay. And accounting for this joint life policy can be done in three different ways. One is premium method, the other one is premium method or expense method, ordinary business expense method. Surrender value method, this method is also called as JLP asset method or asset method. Joint life policy reserve method, this method is called as reserve method. So what exactly is the technical difference that we have between three? All of them are accounting for the same JLP, but the accounting treatment differs. The concept of each method is different. When premium is treated as an expense under premium method, okay, it is taken as purely an expense. What are the accounting entries that we write? On payment, I'll be debiting an account, joint life policy insurance premium account debit to bank. Okay, this is for the payment. Every year, whenever firm they make the payment on a particular day, on that day they will write this entry. And at the end of the year, the second entry will be at the end of the year. When they prepare profit and loss account, joint life policy insurance premium is treated as a nominal account and expense and it will be closed in profit and loss account. Profit and loss account debit to JLP, joint life policy premium account. Okay, whatever we debited here is closed. On maturity of the policy, that is on maturity in the sense either the policy is being surrendered on retirement of a partner and the policy matures in the event of death of a partner. We'll see that when we go to the next unit, death of a partner. Okay. On maturity of the policy, if the claim is admitted and it is not received, we will debit insurance company account debit to partner's capital amount. Whatever amount is coming as surrender value. We are talking about retirement now. So in retirement, it will be surrendered to the insurance company, handed over to the insurance company, and the money received will be given to the partner's capital accounts. It will be credited to the partner's capital accounts as such. If the claim is admitted and the amount is received, the amount will be there in the bank and the corresponding credit will be given to partner's capital. This is a very simple method. Okay. Second one, premium is treated as an asset. So what is the idea behind this method is, in the first method, whatever premium is paid, it is treated as an expense and the amount is closed in profit and loss account. But the second method says that whenever you are paying premium, when firm pays premium, okay, insurance companies are giving you something called a surrender value. That is, usually on the payment of first installment, first premium, you may not get any surrender value, but second premium is paid. Starting from second premium or third premium, you will get something called a surrender value. That is, on payment of second premium or third premium, if you want to discontinue the policy and surrender it, you will get some money. And this thing is definite. It is sure that you will get this amount. So when it is certain that we'll get the amount, there is no ambiguity, there is no contingency in that. Why are we closing complete premium amount as expense? So they want to divide this premium amount into loss part and asset part. Whatever, imagine like, we'll be seeing a problem, but for idea purpose, a firm has paid premium for 3 years and third year when they inquired, they said that the insurance company said that, this 30% of premium, whatever you paid, will be given back to your surrender value if you surrender it. So 30% whatever is that will be shown as an asset. The base for this method is premium paid will be divided into loss part and asset part. Asset part is that part which will be given back by the insurance company on surrender of a policy. Okay. Now look at the accounting entries. We'll be seeing a complete dedicated problem on JLP now. The following journal entries were passed when premium is paid. Previously, you treated it as an expense, joint life policy insurance premium account debit. Now we are creating an asset here. Joint life policy account debit. Okay. Fixed amount every year. There will be no change in the premium to bank account. This is at the time of payment, on the date when the payment is made by the firm to the insurance company. Look at the second entry at the end of the year for transfer. Profit and loss account debit to joint life policy account. Why are we reversing it? Just now you said that we created an asset. This is an asset. Okay, whatever loss part is there, that loss part will be reversed and loss part from JLP will be transferred to profit and loss account. Okay, simple logic. Next one, this is only towards the loss part. On retirement or death of a partner, insurance company, if the claim is admitted but not paid to the firm, or bank account, if the claim is admitted and received by the firm, to JLP account, JLP asset is closed, nothing will be distributed to the partners. Okay, under this method, nothing will be distributed to the partners in retirement. Okay, why? Because there is no simple reason. What is the reason that is given in the ICMA list? There is no balance in JLP that can be distributed because the policy is surrendered. What are the value, right? Now let's try to see the next method, and then we will go to what we call as a problem, a dedicated problem which discusses all the three methods. One single problem in which all the three methods are accounted for. Creation of joint life policy reserve. So what exactly is this method? Third method, it says that whatever premium is created and whatever surrender value is coming, surrender value is being developed in the policy, every year payments, it is increasing the surrender value. Maintain a reserve in your balance sheet equivalent to the surrender value that is there on the asset side of the balance sheet. So whatever surrender value appears on the asset side, equal amount of reserve, JLP reserve, joint life policy reserve shall be maintained. This is one more way of accounting for joint life policies. Look at the entries here. Premium entry remains the same. Under second method, that is asset method or surrender value method, joint life policy account debit to bank, no change in the entry of payment. That is, this entry is passed on the date of payment when the payment is made by the firm. Now, immediately, when you're preparing your final accounts, when you're closing your final accounts, the firm's final accounts, at that time, from P&L appropriation account, we will create a reserve, okay, because reserves are to be created only from P&L appropriation account. Profit and loss account debit to joint life policy reserve. We are creating a reserve there. And what is the amount? Whatever surrender value will be there in JLP account, the same amount will be shown in the JLP reserve account. At the end of the year, for transfer of loss on JLP or whatever we call as this joint life policy, that is, every year we have discussed this now, there will be a surrender value which will be informed by you, informed to firm by the insurance company. We will reverse that by passing this entry. JLP reserve will be debited and corresponding credit will be given to JLP account, joint life policy account. We'll get a clarity once we do a problem, start working on a problem. On retirement, what will happen? Insurance company or bank to joint life policy. Okay, no balance will be there in the joint life policy account because the amount that you get on surrender will be equal to the joint life policy account, and joint life policy reserve will be distributed to the partners. Next, on death of a partner, insurance company or bank account debit to joint life policy, and the event of death you will get the policy value, not the surrender value. So it will be definitely more than the surrender value. So joint life policy account debit to all partners, whatever balance is there in the JLP account, and at the same time we'll distribute this reserves because reserves technically belong to partners. Okay, right, let's see that with a problem here. Red, white and black shared profits and losses in the ratio 5:3:2. They took out a joint life policy in 2016 for 50,000. So what is the sum assured of the policy is 50,000. A premium of 3,000 being paid annually on 10th June. Every year on 10th June. This is an annual premium. They are paying on 10th June. The surrender value of the policy on 31st December for various years was as follows. 2016 is nil. They didn't get any surrender value. Second year, after paying this second premium, insurance company said that if you surrender the policy now, you will be getting a value of 900. And this is definite, right? There is no ambiguity or contingency in this. 2018, 2000 and 2019 is 3,600. Mind you, these are cumulative figures. 900 plus 1100 is 2,200. 2,200 plus 1,600 is given you 3,600. These are cumulative figures. Now, prepare ledger accounts assuming no joint life policy account is made. So they are asking you to treat it as an expense. That is premium method. First method is premium method. Second one is Joint life policy account was maintained on surrender value. This is like asset method. And next one is joint life policy account is maintained along with JLP reserve. That is JLP reserve. And two scenarios. That is, if Black retires on 15th April and if Black dies on 15th April. So even death case is handled here only. So this is a cumulative problem which covers the entire JLP topic at one place. Clear? Now, what will happen? Premium. How much of premium is being paid? 3,000 rupees is the premium that is paid every year. First method is very simple. 2016 June 10th you paid first premium, 2017 June 10th, 2018 June 10th, and 2019 June 10th. 4 years you will be writing the payment entry and it will be closed in profit and loss account. Joint life policy insurance premium account debit to bank on 10th June of every year starting from 2016 to 2019, and this will be closed in your profit and loss account. Entire 3,000, complete 3,000 is closed in your profit and loss account. And on 15th April 2020, that is in the 5th year, before making payment of 5th premium, A has retired. So how much amount will come from the insurance company? Obviously, you'll be getting 3,600. Under first method, under premium method or ordinary business expense method, this entire 3,600 shall be distributed to the partners in their profit sharing ratio, which is 5:3:2. That is your first part of the solution. Let's see the CRD problem number 3. When JLP premium treated as an expense, look at the joint life policy premium account. 10th June 2016, you are making the first payment and it is closed in your profit and loss account. The same entry repeats for the next 4 years. No change will be there in this. Okay. Entire premium, mind you, entire premium that is paid will be closed in profit and loss account because this is ordinary business expense method. What will happen on retirement? Look at the thing. Profit and loss account, everywhere we will be debiting it to profit and loss account on 31st December accordingly, or 31st March accordingly. In this problem, 31st December. Now, if Black retires, what will happen? Joint life policy account. Imagine like we are opening a joint life policy account, but usually bank, whatever is there, that will be, yes, bank account debit to partners capital accounts. There is no need of joint life policy account also, but for clarity and understanding purpose, we are doing it. By bank surrender value 3,600 is come. 3,600, and this is distributed to the partners in the ratio of 5:3:2. This is in case of what we call as retirement. You'll be getting what? You'll be getting only the surrender value, whatever is given in the problem, which is 3,600. Now, if it is the death of Black dies, how much money will you get? You will be getting the policy value, which stands at 50,000 rupees. Okay, so 50,000 rupees are received, and entire 50,000 will be distributed to the partners in 5:3:2. Very simple method. Okay, now let's see the second one. What is the second method? Joint life policy account was maintained on surrender value basis. So asset method, joint life policy asset method. Now in this, you should be careful. Like first one, when joint life policy premium treated as asset, surrender value. First entry will be joint life policy account debit to bank. You will be making payment on 10th June every year. First payment is made. Let's see year wise. What is the surrender value that is given by the insurance company in 2016 is nil, which means that entire 3,000 premium, whatever is paid, is a loss to you. That is the reason we will transfer entire 3,000 rupees to profit and loss account. Do you see any balance in JLP account? No, JLP account is not having any balance. 3,000 on both the sides. First year is over. Second year. Second payment of premium was done on 10th June 2017 to bank account 3,000. How much are we transferring? Only 2,100. Because insurance company said in 2017, after payment of second premium, they said that, sir, you will be getting 900 rupees if you surrender the policy after payment of second. So on payment, they inquired, the partners, they made the payment and they inquired, do we have any surrender value? Yes, you have surrender value, which is 900. Okay. So 900, which means that what is the 900 part treated as? 900, which is the confirm amount, will be taken as an asset, and the balance part will be treated as loss. And how much is transferred here? Profit and loss account. Look at the thing. They have transferred only 2,100. Joint life policy account is now standing with a balance of 900, and this will be carried down. This is an asset which will appear in your balance sheet on the asset side. Okay, next. So next year, by balance carried down, it is brought down here 900. Next year, again on 10th June 2018, you made one more payment, and this time they said that what is the surrender value? 2000, which includes 900, which means that what is the synergy or what is the additional 1100? How do you get that 1100? 2000 minus 900. This is the value, increase in the value of the thing. So if 2000 carried down, so what is the loss part? 1900. That will be debited to your profit and loss account. When you total up 3900 minus 3900 minus 1900, we have a 2000 surrender value. Two parts of it, 900 for second year 17, 1100 added now 2000. So as on 1st January 2019, we have a asset standing at 2000. Again on 10th June 2019, the firm paid 3000, and this time what is the surrender value that they have given you? 3600. Is it 3600? Yes. But how much of loss? How much of value addition is there? 1600 is added by the insurance company as surrender value. So the balance 1400 will be treated as loss. That will be transferred to profit and loss account. And now your asset is standing at 3600. Now, in the event of retirement, when the policy is surrendered, how much money will you get from the insurance company? What is the balance here? See, on 1st January 2020, the balance is standing at 3600. 15th April 2020, Black has retired. You will get the amount. Do you see any balance in your JLP account? No. So since there is no balance, nothing can be distributed. But what is the logic behind this thing is, every year this surrender value, whatever surrender value we are talking about, is getting distributed to the partners indirectly in the form of profit. Why? Only payment made is 3000, but how much is charged to the profit and loss account in the year 2017 is 2100. 900 is not charged, correct? So if 2000 paid is 3000, but only 2100 is charged, balance 900 is going in the form of profit, and it is getting distributed to the partners in their profit sharing ratio. Second year 2000 already 900 done, 1100 excess. Okay, you are not charging the full premium, unlike in the previous method. You are charging 2100, 1900 and 1400. Whatever deficits are there here, they are surrender values, they are indirectly transferred to partner capital accounts already. That is the reason why in retirement we will not distribute this 3600 surrender value, because every year in the form of surrender value it is going into the partners capital accounts. Next, profit and loss account. Look at the thing. In the first method, if you observe, every year you were transferring how much? 3000, correct? All the first method, I'm talking about comparison, first method and second method. In all the 4 years we have transferred 3000, but here did you transfer 3000? No, 900 shortfall, which means that the excess part, whatever 900 is, distributed to the partners. Here 1900, how much is distributed? 1100, 1400, 1600 is being distributed. Total counts to 3600. That is the reason why in surrender we don't give any amount to the partners, or to keep it simple, there is no balance in JLP account that can be distributed. That is the reason why we are not distributing anything to the partners. Okay, now look at the second scenario. If Black dies on 15th April 2020, what is the scenario? How much money will you get from the insurance company? You'll be getting the sum assured 50,000. What is the debit balance in your JLP account? Is only 3600, which is already distributed. Now, over and above surrender value, whatever policy value amount is there, that will be distributed to the partners, which comes to 46,400, distributed in the ratio of 5:3:2. 23,200, 13,900 and 9,280. Correct? So look at the note here. In case of death of a partner, the ledger accounts of the first 3 years will be the same as in case of retirement. Okay, the ledger accounts will remain the same. Now let's see the third method. What is this third method? You are creating an asset, JLP account debit to bank, create an asset, create a reserve equal to the equal amount of premium that is paid during the year, writing it as P&L appropriation account debit to JLP reserve. Then whatever surrender value is there, deduct that surrender value by reversing these two accounts, asset account credited and reserve account debited. That is the only difference that we will have. Okay, JLP reserve account, look at the thing here. Joint life policy account, bank account. Okay, previously you were debiting it to profit and loss account. Now you are debiting it to which account? JLP reserve account. Losses in the previous method were debited to P&L. You can compare the accounts here. Okay. Now, what is the idea? In the second method, the surrender value of the policy was going into the partner's capital accounts. And there is no way that you can control it. Why? When you are charging only the loss part, automatically the asset part, whatever is there, it is getting into profit, net profit. And from there, automatically goes into appropriation account and gets distributed. So, in order to control it, not to allow this surrender value to go into the partner's capital account, we are creating a reserve, joint life policy reserve account. Okay, so P&L appropriation account, reserve account is created. Look at the story here, joint life policy account. In the event of death, what will happen? 50,000 rupees in your joint life policy account will come, 3,600 is already there. Okay, minus that 46,400 is distributed, and reserve will also be distributed. Look at the reserve account, because partners, they never got this money. Now 3,600 it was always stopped at reserve. Only after creating reserve, which was not allowing the surrender value to go into the partner's capital account, we will distribute the reserve and will distribute the joint life policy asset account. Total amount that goes in is 50,000 rupees. Okay, so this is all about your joint life policy CRD problem number 3. Okay, now we'll be seeing something called as ILPs, individual life policies. Now here in JLP, only one policy is taken by the firm, and one policy, either it is surrendered or it is, in the event of death of a partner, it is being handed over to the insurance company and the amount is received. Now, what is the other way? One more thing is there, separate life policies. It is not like one policy in the name of all the partners, individual policies in the name of each partner. Okay. Now, in case of retirement, instead of taking a joint life policy, they have taken individual policies. Look at the example here. 3 partners are there. Their PSR is 3:1:1, and policy values are given here, and surrender values as on the date of retirement are given to you. Mr. Amit retires, and Amit gets what do we call this? How is it? Amit, Amit, the last partner is retiring. So, in the event of retirement, how do we calculate the amount that has to be given to the partners or the retiring partner is? We will take up the surrender values. What are the surrender values of all the partners, not the individual partner? All the partners' surrender values are 10,000 plus 20,000 plus 30,000, multiplied by the share of the retiring partner, 12,000. This is the amount that will be given. Now, in case of death, imagine like in this example, Amit is dead. What is that you will get? That individual policy of Amit will be handed over, and you will be getting 3 lakh rupees from the insurance company, isn't it? So 3 lakhs plus the surrender values again. Look at the calculation here, or look at the valuation. See, if Amit dies, what will be the story? You will be getting 3 lakhs from the insurance company. Obviously, in the event of death, you will be getting a policy value 1/5 out of that, and surrender values of the other 2 partners, 10,000 and 20,000 put together. Yes, 60,000 plus 6,000. 66,000 will be transferred to the partner, deceased partner thing. Okay. Now, what are the adjustments? Obviously, the same old regular adjustments will be carried on in the case of death. Let's see another problem. Let's continue with CRT problem number 4. On 31st March 2020, the balance sheet of Messrs. Ram, Rahul and Rohit sharing profits and losses in the proportion of their capital stood as follows. So these guys, they are sharing their profits in the proportion of capital, which are in 3:2:1. Capitals are 3 lakhs, 2 lakhs, and 1 lakh. Sundry creditors, no reserves are there. Land and buildings, machinery, closing stock, debtors, cash and bank balance 1 lakh. So who is retiring? On 31st March 2020, Ram desires to retire from the firm and the remaining partners decide to carry on. It was agreed to revalue the assets and liabilities on that date on the following basis. So Ram is retiring. Ram is the major stakeholder in the business. Okay, 3 lakhs, almost 50% of the capital is contributed by this partner. What are the revaluations that we are doing? Land and buildings be appreciated by 30%. Existing value is 2 lakhs. So there is a plus 60,000 rupees, 30% plus 60,000, right? Machinery be depreciated by 20%. That's minus 40,000 rupees here. And we have closing stock to be valued at 80,000. What is the existing value? 1 lakh minus 20,000. Okay. Next thing. What is the next thing? Provision for bad debts to be made at 5% on returns. 5% comes to 10,000 minus 10,000. Correct. Next. Old creditors balance of sundry, old credit balance of sundry creditors 10,000 to be written off. That is, there is an amount in creditors. How much is it? 2 lakhs. Out of this 2 lakhs, we don't have to pay. The supplier agreed not to pay, or it is some sort of, waiver that is given by the supplier. We don't have to pay that. That is again like minus 10,000. Joint life policy of the partners surrendered and cash obtained 60,000. What is the method that they are following? Do you see any JLP here on the asset side? No, right? So no JLP is there, which means that they are following expense method or premium method. Entire premium, whatever is paid towards joint life policy, was charged to P&L account completely. Okay. So whatever money comes in, how much is coming in from the insurance companies? Joint life policy surrendered, cash obtained 60,000. So there is an increase in the cash and bank balance to the extent of 60,000. Okay. This is also to be routed through what we call this revaluation account only. There is an asset called as cash, which is increasing from 1 lakh to 1 lakh 60,000. Technically, it's bank, cash and bank together. Next, goodwill of the entire firm be valued at 1 lakh 80,000 and Ram's share of goodwill will be adjusted in the accounts of Rahul and Rohit, who share the future profits equally. So, no goodwill account being raised. We'll take care of that calculation now. The total capital of the firm was to be the same as before retirement. What is the existing capital of the firm? Existing capital is 6 lakhs. So even after retirement of Ram, Rahul and Rohit must maintain the capital as 6 lakhs, and that too in profit sharing ratio, which is 1:1. That which means that we know what is the balance carried down and brought down of capital account should be 3 lakhs and 3 lakhs. Done. Next thing is individual capitals being their profit sharing ratio done. Amount due to Ram was to be settled on the basis of 50% on retirement and balance 50% within 1 year. So half is paid to him and half is being transferred to loan account. Okay. So what is the new point that we are seeing in this is JLP. Okay, it is maintained under business expense method and you are receiving 60,000. First, let's see what is that they are asking us to prepare. Prepare revaluation account, capital accounts of Rahul and Rohit. Okay, they are asking you to prepare Rahul and Rohit together. Don't include Ram. Retiring partners capital account, we'll keep that as a separate one. Okay. Loan account of Ram, 50% is paid, balance 50 is loan. Cash account and the balance sheet as on the date. Cash account will be very important because the partners, continuing partners, Rahul and Rohit must bring additional capital. Okay, how is it done? Let's check the solution. First, revaluation account. We have already written the revaluations account. Building is increasing, except for building, all the other things are decreasing here. Is it? Now, creditors are also, there is a decrease. That is a gain again. So, buildings are increasing by 60,000 rupees. Creditors 10,000. Okay. And there is a cash increase by 60,000. What is this? Surrender value of JLP, which has been received by the firm. And what are the losses? Machinery has decreased by 40,000, closing stock 20,000, provision for doubtful debts 10,000. So we have a revaluation profit of 60,000 to be distributed to partners in the ratio of 3:2:1. Done. Okay, let's see the next one. Revaluation account is over. Partners capital accounts, and we are preparing only Rahul and Rohit. Will prepare Ram's capital account as a part of working notes because it is not asked as a part of our solution. What are the capitals? First thing, capital balance of Rahul and Rohit 2020 March 31st, 2 lakhs and 1 lakh. Revaluation profit just now arrived at 20,000 and 10,000. Okay. And what is the thing? Goodwill part. Ram's capital. So we have to see the goodwill. What is the story of goodwill? What is the value of goodwill that has been given to us? Goodwill value is given as 1,80,000 and Ram's share of goodwill out of that is 3 by 6. 90,000 rupees should be paid based on the gaining ratio. So how much did they gain? Let's see the calculation. See the thing. Working notes, calculation of gaining ratio of existing partners or continuing partners. Rahul's old share was 1 by 3. Now he's getting 1 by 2. He's gaining 1 by 6. Rohit is gaining 2 by 6. 1 is to 2 or 1 by 6 and 2 by 6. Therefore, the gaining ratio of Rahul and Rohit will be 1 is to 2. And accordingly, what is the amount of goodwill that they have to pay to Ram is out of 1,80,000, 90,000 belongs to Ram. And this thing shall be paid. Rahul will pay 30 out of his capital and Rohit will pay 60,000 out of his capital. That is why the capital accounts of Rahul and Rohit are debited. This is the goodwill part. Okay. Ram's account has been credited. What is this thing? Goodwill. Next, what is the next thing? After goodwill, balances. That's it. Closing balances. We are already given how much of balance should be maintained. Before retirement of Ram, the total capital of the firm was 6 lakhs and they are supposed to maintain the same thing in their new profit sharing ratio, which comes to 3 lakhs and 3 lakhs. Total up the debit side, 3 lakhs 30,000 in Rahul, debit side minus credit side, we have only 2 lakhs 20,000, which means that Rahul has to bring in a amount of 1 lakh 10,000. Rohit will bring 2 lakhs 50,000 total. 3 lakhs 60,000 rupees is getting added to your cash account here. Okay. Then how much are we paying? We'll be seeing what do we call as Ram's loan account. Before that, let's see Ram's capital account. What all the amounts are to be paid to him? Okay. Ram's capital is how much? Ram's capital is 3 lakhs. Okay. 3 lakhs, the first amount that is credited to him. After that, revaluation account profit 30,000 Ram's share. Goodwill, Rahul is paying 30,000 and Rohit is paying 60,000. A total of 4 lakhs 20,000 is due towards Ram. And out of that, you guys are settling how much? 2 lakhs 10,000. And the balance 10,000 is going into Ram's loan account. Okay. Now, that is the reason why in Ram's loan account, look at then they have prepared a separate loan account here. After capital accounts, Ram's loan account. By Ram's capital, 2 lakhs 10,000. And balanced here, to balance carried down, balance brought down 2 lakhs 10,000. This would go into your balance sheet. Cash and bank account, opening balance of 1 lakh is there. Okay. Then you received 60,000 from the insurance company on surrender of insurance policy, 60,000. And just now we have calculated Rahul is bringing 1 lakh 10,000 and Rohit is bringing 2 lakhs 50,000. Total on the debit side comes to 5 lakhs 20,000 minus 2 lakhs 10,000 payment made to Ram. Balance 3 lakhs 10,000. This is the amount that will go into your balance sheet. Next, the balance sheet. Land and buildings revalued, machinery, closing stock, debtors minus provision, cash and bank balance. We are taking it from cash and bank account. Rahul and Rohit 3 lakhs. Ram's loan account 2 lakhs 10,000. Sundry creditors previously 2 lakhs. Now it is 1 lakh 90,000. Okay. So this is it. Okay, well, let's continue with Unit 5, Death of a Partner. So what is the accounting treatment in the event of death of a partner? Okay. The problem arising on death of a partner are similar to that of retirement. They will be almost the same except for one new adjustment has to be made. That is the deceased partner's executors. Okay. The deceased partner's executors must be given the share in the profit up to the date of death of the partner. Look at the list here. In admission, we have seen 5 things are adjusted. In retirement, you have seen something called as One more new addition was there, sixth one, JLP. In this, we'll have seven amounts which are to be settled. Okay, look at the thing. The amount standing to the credit of capital account, this is the basic thing actually. The capital amount standing to the credit of deceased partner capital account has to be transferred to the executor's account. Interest on capital, if provided in the partnership deed up to date of death, this thing again purely depends upon the fact whether they have a clause. Do they have an understanding that in the event of death of a partner is eligible for interest up to the date of death? Okay, the problem will be telling us very clearly the prompt based on that. Share of goodwill, normal thing. Share of undistributed profits, assets and liabilities, revaluation, profit or loss. And look at the thing, sixth one is the new thing that we are doing here. Now, what is the sixth one? Share of profit up to the date of death of the partner. This is a new thing that has to be calculated and credited to the partner's capital account as such. And share of joint life policy, already we have done a problem in retirement, red, black and blue or something, some problem there. Now, this is the new adjustment, that is share of profit up to the date of death of the partner has to be calculated. And what are these are the amounts which are to be paid by firm to the partners executors, and what are the amounts that are to be paid by the executors to the firm is drawings whatever are made, they will be deducted from the partners capital accounts, interest on drawings accordingly. Share of loss on revaluation of assets and liabilities, that is if it is profit we'll give profit. Okay, if it is loss they have to, it has to be debited to the partners capital accounts. Share of loss that has occurred till the date of, if it is profit, well and good, but if there is a loss we have to debit that loss to the partners capital accounts. Okay, so calculation of profit up to date of death, how do we calculate the, what is this new adjustment that we are talking about? So calculation of profit up to the date of death, such profit is recorded through P&L suspense account. Why? Because if the death of the partner occurs in the middle of the year, we'll be preparing P&L account only once in a year. So till that time, whatever profit is calculated, it will be routed through a temporary account called as P&L suspense account. And at the end of the financial year on 31st March, when we are preparing financials, this P&L suspense will be closed in profit and loss account. So P&L suspense is purely a temporary account which is open when we are calculating profit in the middle of the year. After ascertaining the amount due to the deceased partner, it should be credited to the executor's account. Okay, so we'll be seeing that practically with a problem. And what are the bases? There are two ways in which this profit up to the date of death of the partner is arrived at and his share will be taken. How do we do that? First thing is time basis, based on number of months. And second one is turnover basis, that is nothing but gross profit basis. Look at the thing. Let's see a example here for clarity purpose. Time basis, in this case it is assumed that profit has been earned uniformly throughout the year. What is the underlying assumption there? You are going with an assumption that the profit is earned evenly throughout the year, all throughout the 12 months. For example, the total profit is 1,25,000 here. Okay, this is 1,25,000. Partners, three months, like the total profit of the previous year is 1,25,000, and a partner dies 3 months after closing the previous year. So after 3 months he is dying. So what is the share? 1,25,000 into 3 by 12, which comes to 31,200. And if the deceased partner share is 2 by 10th, we'll be giving him 6,250. This is what the calculation is. So this is purely on time basis, where we are going with an assumption that the profit is earned evenly throughout the 12 months period. Now, what is the second one? Turnover basis. What is turnover is? How much of gross profit is earned by the business during the previous year? Apply the same gross profit rate on the sales of that particular 3 months. Okay, look at the thing. Profit from 1st April to 31st May 2020. So April, May, only 2 months. They gave another example here. So profit was 4 lakhs and sales were 60,000 amount. This thing, sales are 4 lakhs last year and profit is 60,000. Then what is the percentage that is earned by the firm is 15%. I'll apply the same 15% on the sales till the date of death of the partner, which happens to be 1 lakh. So I'll be getting what? 15,000 is the profit for that particular, yes, earned on the sales. And out of that, if the deceased partner share, what is the share of the deceased partner? Accordingly, 1 by 6. Imagine like if it is 1 by 6, they will be paying 2,500 will be taken as the share there. Okay. Now, this is the only new adjustment that we are doing. Except for that, all the adjustments that you have done in the retirement will remain the same. Now let's see this problems without joint life policy. The balance sheet of seed, plant and flower as at 31st December 2020 was as under. Three partners are there. Trade payables 20,000, general reserve to be distributed 5,000 rupees. Capitals are given, seed 25,000, plant 15,000, flower 15,000. Total capital happens to be 55,000 and total on the liability side comes to 80,000. Fixed assets 40,000, debtors 10,000, bills receivable 4,000, inventory 16,000, cash at bank 10,000. Done. The profit sharing ratio, seed 5 by 10, plant 3 by 10 and flower is 2 by 10. 5 is to 3 is to 2. On 1st May 2010, plant dies. Now, when did they close this? 31st December. So, how many months of business is over? 4 months of business is over, starting from January 2021 to 30th April, because plant died on 1st May. So, 4 months. Goodwill. They didn't give us goodwill straight away. We have to calculate the goodwill. Goodwill should be valued at 3 years purchase of average profits for 4 years. For 4 years, the profits were 17, 10,000, 18, 13,000, 19, 12,000 and 20, 15,000. Okay. Do we have a trend? No. So we'll go with a simple average. We'll see the calculations now. The deceased partner to be given a share of profit up to date of death on the basis of previous year profit. So what is the previous year? 2020 is the profit. Based on previous year profit, we'll calculate it on what? Time basis only. Okay. Turnover is not asked. We'll see the calculation. Fixed assets were to be depreciated by 10%. What is the value of fixed assets? 10% out of this comes to minus 4,000. Next, a bill for 1,000 was found to be worthless. There are these are not to affect the goodwill. Okay. Where is bills? Under debtors or bills receivable. This is minus 1,000 here. One bill is of no use. Okay. 1,000 rupees. What is the next adjustment? A sum of 7,750 was to be paid immediately. The balance was to remain as loan with the firm at 9% per annum. That is, the surviving partners are settling only 7,750 out of the total amount due, and the balance amount is transferred to first executor account, and from there it will be transferred to executor's loan account, and it is to be served at 9% per annum. Seed and Flower agreed to share profits and losses in future at 3:2, give necessary journal entries and prepare ledger accounts. First, let's see the journal entries here. So CRD problem number 1, first and foremost thing, general reserve is distributed to the partners. How much of general reserve is there? 5,000 rupees general reserve is there, correct? It's general reserve 5,000 to be distributed. So in the old ratio, 5:3:2. Done. General reserve is distributed to the partners. Next, seed capital account and flower capital account to what do we call this? Plant capital account. Adjustment of goodwill. How did they adjust the goodwill? Let's go to working note number 2. Calculation of goodwill. 4 years profit is given. Average comes to 12,500. Goodwill is to be purchased at how many years? 3 years of purchase, 37,500. Plant share of goodwill is 3 by 10th of this, comes to 11,250. And this thing has to be taken out of these accounts in what ratio? Gaining ratio. What is their gaining ratio? Gaining ratio is given here. Seed is gaining 1 by 10th and flower is gaining 2 by 10th, 1:2. Accordingly, we distribute that, and this is the entry. What is the entry? Second journal entry. See that. Seeds capital account is debited with 3,750, flowers capital account 7,500, and plant 11,250. So the goodwill part is over. Next, revaluation account debit to fixed assets and buildings. There is a loss in the decrease in the value of the fixed asset by 4,000 and bills receivable 1,000. 5,000 rupees is the revaluation loss. We don't have any increment in the as such there. So this entire thing, revaluation loss, has to be debited to partners capital accounts in the next entry. Look at the next journal entry. Seeds capital account, plants capital account, flowers capital account debit to revaluation. So distribution of revaluation losses over. Next, share of partner. What is it given? The deceased partner to be given the share of profit up to date of death on the basis of previous year profit. What is previous year? Immediate previous year is 2020. Okay, how did they calculate that? Look at the calculation here. Is given in working note number 2. Working note number 3. 4 months profit. 15,000 is the profit of previous year, that is 2020 is the previous year. 15,000 has been taken. Okay, and 15,000 into 4 by 12 comes to 5,000. And out of this 5,000, what is the share of plant? The deceased partner is 3 by 10, which comes to 1,500. So what is the entry that we are writing? Profit and loss suspense account debit, and credit shall be given to plant's capital account, that is deceased partner capital account. So this is the entry that we have written again in the regular journal entries here. So 1,500 rupees. This is the only new adjustment that you are doing in case of death of a partner. Rest of the adjustments are similar to what we have done in our retirement case. Now, for finding out, revaluation account is prepared. Partners capital accounts. First, let us focus on the deceased partner's capital account. Okay, deceased partner, plant is a deceased partner. 15,000 is the capital amount. 1,500 is the general reserve appropriated to him. Seed and flowers capital account 11,250 goodwill part, and profit and loss suspense account. Total amount on the credit side comes to 29,250 minus revaluation loss of 1,500. What is the balance? 27,750. And what is that firm is settling? You guys are settling only how much? These guys are settling 7,750. Out of 27,750, if 7,750 is settled, the balance 20,000 is transferred to, yes, plant's executor's loan. First of all, the difference amount from capital account should be transferred to executor's account, and from executor's account we will settle the amount. Where is the executor's account prepared? See the thing. From plant capital account, we have transferred the amount to executor account. 27,750 is payable. Out of that, you are paid only 7,750. The balance will be transferred to plant's executor's loan account, and this 20,000 will be shown in the balance sheet. Okay, that is partners capital accounts. They didn't ask you to prepare balance sheet, did they? Prepare the necessary ledgers. They didn't ask you to prepare the balance sheet. Okay, so this is your problem number 1 in case of death of a partner. Goodwill is calculated based on average profits purchased for 3 years. Okay, then partners share in the profit up to the date of death is calculated on the basis of time. Okay, 2 bases are there. We are using time base here. Okay, let's see the next problem. Problems with the joint life policy. The previous one was without joint life policy. Now this thing is with joint life policy. The partnership agreement of a firm consisting of 3 partners ABC who share profits in proportion of 1 by 2, 1 by 4 and 1 by 4. Okay, and where fixed capitals, they are maintaining the accounts under fixed capital method. Fixed capitals are 10,000, 6,000, 4,000 respectively, provided as follows: that partners be allowed interest at 10% per annum on the fixed capitals, but no interest be allowed on undrawn profits are like reserves created and charged on drawings. Okay, that upon the death of a partner, the goodwill of the firm be valued at 2 years purchase of average net profits after charging interest on capital. Okay, we have to remove the capital, interest on capital, and then calculate the thing. We'll be seeing it for 3 years to 31st December. 3 years to 31st December preceding the death of the thing. So they are asking us to take it for the full year. Okay, not up to the date of death. That an insurance policy of 10,000 each to be taken in the individual names of each partner. So this is what they are taking, individual life policies. Okay, it is not a JLP case, insurance policies, but individual policies. The premium to be charged against profit of the firm. That is, they are following surrender method for individual life policies. The same surrender method, asset method and reserve method can be followed even for individual policies. Upon the date of the death, upon the death of a partner, he is to be credited with the share of profit, interest on capital, etc., calculated up to 31st December 2000 or 31st December of following the death. That the share of partners policy, partnership policy and goodwill be credited to the deceased partner on 31st December following his death. And what else is given? That the partnership books be closed annually on 31st December. Now, let's get into the actual content of the problem. A dies on 30th September 2019. The amount standing to his credit of his current account on 31st December 2018 was 450. And from the date of death, his withdrawals were drawings were 3000. Okay. An unrecorded liability of 2000 was discovered on 30th September 2019. It was decided to record it and immediately paid off. Okay. The trading results of the firm before charging interest, and what is why before charging we have to remove the interest on capital now, had been following, like 2016 profit of 9640, 17 profit 6720, 18 there is a loss of 640, and 2019 we have a profit of 3670. The same thing, same content of the problem, but it is not given in a structured way. Assuming that the surrender value of the policy is be 20% of the sum assured. So whatever surrender values are given to us here, they are 20% of the sum assured. Prepare account showing amount due to A's legal representative. Only one account is asked. This is not a comprehensive problem. They are asking you only for A's legal representative's accounts. Okay. Let's see the solution here. What is the capital balance of A? 10,000 rupees. Correct. A's capital balance is 10,000. Okay. So that is what is taken here. Next, profit and loss account. That is interest on capital, share of profit. Look at the calculations here. First one, valuation of goodwill. 16, 17, 18. Okay. Profit before interest on fixed capitals, 9,640, 6,720, and there is a loss of 640 and 15,720 rupees. Okay. Next, interest 2,000 each year on the capital, 6,000 rupees. Profits after interest are 7,640, 4,720. Loss will increase because already there is a loss, and when you charge back interest, 2,640, 9,720. Average comes to, what is the average? 3,240. Okay. Goodwill purchased at 2 years comes to 6,480. Share of A in the goodwill is 3,240. Again, it is coming back to the average profit. Okay. So profit on separate life policies. How do we distribute this? Look at the thing. When A dies, you will surrender the policy. If 2,000 rupees is the surrender value, what is the policy value? They gave you the adjustment here. The share, the share of partnership, and where is the last thing here? Assume that surrender value of the policy to be 20% of sum assured. Okay. So accordingly, A's policy value is 10,000. B and C's policy values are taken as 4,000 rupees. Total 14,000 rupees. And this, out of this 14,000, 1/2 belongs to A. Okay. And share in profits. Profit for the year 3,670. Which year is it? Last year is taken, is it? 3,670. And out of that, minus 2,000 rupees interest on capital, we remove that and we take the original amount 1,670. Out of that, half of it will go to A. They are not asking you to calculate up to the date of death. They are asking you to take it for the full year as per the agreement. Okay. So 835 rupees happens to be the profit. So these are the amounts that are to be given to the partner. Interest on capital 1,000, 10% is on 10,000. Share of profit 835. Okay. And goodwill part is 3,240. B and C, who are giving? B and C are giving. Okay. Individual shares are not required because we are not preparing the accounts of B and C and all that. Current account. 3000 minus 450. On the contrary, what you can do is here, what is that they have done? To drawings, they should have shown it as 3000 and 450 rupees of current account credit balance was supposed to be credited. But instead of doing it, see, they gave you here. Where is the point here? Yes, 3000 rupees here. A dies on 30th September 2019. The amount standing to the credit of his current account on 31st December 2018 was 450. So there is a credit balance in your current account, A's current account. So A's current account debit to A's capital account. You can do that. But here what they did is, instead of showing two amounts, drawing separately and current account balance separately, they have deducted it. Two drawings 3000 and by A's current account it was supposed to be 450. But they squared it off and wrote it as 2550 here. Okay. And profit and loss unrecorded liability. What is this unrecorded liability? Actually, we have to open a revaluation account. Okay, revaluation account and write as revaluation account debit to unrecorded liability or liability, outstanding liability 2000. Instead of preparing a revaluation account or instead of writing an entry, directly we are giving the proportion. What is this 1000? Out of that 2000 rupees, revaluation loss 1000 belongs to A. Okay, done. So what is the balance now? We are getting a total of, what do we call this? What is the share? Let us understand the share of the partners here. 7000 already calculated, done. 10,000 sum assured. 4,000 is the surrender value of the partners. 7,000 discussed already. 22,075 minus 3,550. Okay, what is the balance that you are getting? 18,000. So transfer, is it coming to 18,575? Done. Come on, look at the notes. They gave you notes. As unrecorded liability of 2000 has been charged to capital account through profit and loss adjustment account, no further adjustment in current account profit is required. Okay. One more treatment is this 1000 can be squared off from the current account balance. Okay. They didn't do it. Better to, what do we call this? Credit the current account balance here, not avoid the confusion. A's current account debit to A's capital account, close it, and show the drawings, two drawings, 3000 separately. That is the thing. But here we are going with ICA treatment. Whatever is given in ICA book, we are going with that. Profit for 2016, 17, 18 have not been adjusted for goodwill valuation. They said that only for calculation of profit, they've asked us to adjust the interest on cap. But when it comes to profit sharing, whatever we call this, till the date of death or up to 31st December, we have taken the original figure. We didn't take that 2000 addition made to it. Okay. The problem is not drafted that way. Right. So let's see one more problem on death of a partner. CRD problem number 3. Dia, Ria and Kia are partners of Messrs. DRK Fabric, sharing profits and losses in the ratio of 2:1:2. On 31st March 2020, their balance sheet stood as follows. Capitals are given 1,50,000, 1,80,000, 70,000. General reserve to be distributed 1,40,000. Trade payables, goodwill. Already there is an existing goodwill in the problem. What is that we have done in the retirement problem? Take it out because we will be calculating a new goodwill now. This is a purchased goodwill which these partners have purchased. Okay. Next, Kia dies on 30th September 2020. So how many months of business is already over? 31st March 2020. So 6 months business starting from 1st April 2020, 30th September 2020. The partnership deed provides as follows: that partners be allowed interest at the rate of 12% per annum on their capitals, but no interest be charged on drawings. Only interest on capital is being given. Goodwill appearing in the balance sheet on 31st March 2020 as it was purchased goodwill. Obviously, if you see goodwill in the balance sheet is purchased goodwill. That upon the death of the partner, the goodwill of the firm be valued at 1 year purchase of the average net profits after charging interest on capital for 4 years to 31st March pending the death of a partner. The profits of the firm before charging interest on capital. So we have to convert this after charging interest on capital. 16, 17, 17, 18, 18, 19 and 19, 20. They are not in a trend. Okay, right. Average capital during the preceding 4 years should be assumed as 3 lakhs. This 3 lakhs average capital should be used only for goodwill. Don't take it for interest on capital and other calculations. This particular sentence is given in the problem only for the purpose of goodwill valuation. Clear? Next, profit till the date of death to be ascertained on the basis of average profits of the previous 4 years. Same story. Upon the death of a partner, she was to be credited with her share of profit, interest on capital, etc. calculated till the date of death, only up to date of death. After the death of Gia, 2 lakhs were received from the insurance company against the joint life policy. What is the method? Do you see a joint life? Yes, there is a joint life policy. And what is the method that they have followed? Surrender value method or JLP asset method. Okay. So 60,000 is already distributed. Already we have discussed it. Whatever appears in the balance sheet under surrender value method is already distributed to the partners indirectly every year in the form of profit. Okay. The balance over and above this shall be distributed now. How much did they realize? 1 lakh 40,000. 60 is already given to the partners. Land and buildings were appreciated by 20%. Furniture be depreciated by 10%. Inventory be revalued at 80,000. What is the existing value of the inventory that is given? Inventory stands at 88,740. Okay. And bad debts amounted to 1,000. Amount payable to Kia was paid in cash. So entire amount has been settled to the executors of the deceased partner. What is that you are supposed to prepare? Revaluation account, partners capital account, balance sheet as on 30th September 2020, assuming that other asset liabilities remain the same. Okay. So let's go and see the solution. So what is the unique point in this particular problem? They have given you JLP, surrender value method. JLP appears as an asset. Revaluations, only land and buildings have got appraisal 33,000. Furniture decreased by 7,500, inventory by 8,740, bad debts accounted for 1,760. Profit on revaluation comes to 15,000, distributed to the partners in 2:1:2, their old profit sharing ratio. A simple revaluation account. Partners capital accounts, but before that, let's see the what do we call as goodwill valuation. Calculation of Kia's share of goodwill. 4 years profits are given. Total comes to 7,44,000. Average profit comes to 1,86,000 divided by 4, 1,86,000. Now, interest on capital only for goodwill purpose, they have asked us to assume it as 3 lakhs, not for any other purpose, only for goodwill valuation. That's why we are taking. What is the actual capital? If you observe the problem, the actual capital, I think it's 4 lakh rupees. Is it? Yes, 4 lakhs. So except for goodwill calculation, don't use this 3 lakhs figure anywhere else. Interest on capital, 3 lakhs into 12% comes to 36,000. Minus that, adjusted profits, adjusted average profits are 1,50,000. Goodwill is valued at 1 year's purchase. Okay, same average profits and goodwill value is one and the same, adjusted average profits. And what is Kia's share? 2 by 5. This lady is taking 2 by 5. It's 2 by 5. 60,000 rupees worth of goodwill has to be given to her. And how is that it is paid by Dia and Kia? Look at the thing. Adjusted in what? 2:1 ratio. Because Dia is gaining 2 and Kia is gaining 1. Right? So that is what is shown in the partners capital accounts. Opening balance as per balance sheet. General reserve is there, distributed. Joint life policy proceeds over and above 60,000. 1,40,000 have been distributed in the ratio of 2:1:2. Done. Interest on capital. How did they calculate interest on capital? What is the capital? Kia's capital is how much? Kia's capital is 70,000. Right? On 70,000, they calculate it as what? Into 12 by 100 into 6 by 12. Because she was there in the business only for 6 months. She was alive till 6 months. Okay. Revaluation profit. Just now we have calculated revaluation profit comes to 6,000, 3,000, 6,000. And what is the last thing? Goodwill part. Goodwill is 60,000 shared by Dia and Kia in the ratio of 2:1. That is obviously debited to their capital accounts here. Look at the thing. And what is this goodwill on the debit side? The purchased goodwill which is there in our question. Done. Next thing, what is the next thing that they are doing? P&L suspense account, that is Kia's share of profit up to date of death. Look at the calculation. Calculation of Kia's share of profit till the date of death. Average profits for the full year before interest on thing is 1,86,000. Is it 1,86,000? Check that. Average profit for full year before interest on capital. Okay, did they ask you to take a full year average profits? Profit till the date of death to be ascertained on the basis of average profit. Average profits of the 4 years, already we have calculated average for the purpose of what? For the purpose of goodwill valuation. The same figure has been taken there, 1,86,000. If it is for what do we call as 1 year, complete 1 year, this is for 12 months, but we have to take it only for 6 months, which comes to 93,000. Out of that, less interest on capital. Okay, interest on capital has to be deducted. And what is the original capital? 4 lakhs into 12 by 100 into 6 by 12. 24,000. Careful with this adjustment. The balance part, whatever is there, that will be 69,000 to be distributed as profit. And what is our share? 2 by 5 comes to 27,600. Okay. We are taking, what is the uniqueness in this particular problem is, first and foremost thing, they have asked us to take average profits for calculation of profit of the deceased partner's share. 1,86,000 is the average we have calculated for goodwill purpose. 6 months, it is taken for 6 months. But we are adjusting the profits after interest. Okay, my appropriation is done for 6 months. 4 lakhs is taken, don't take 3 lakhs. Most of you will make a mistake of taking the 3 lakhs. That 3 lakhs is meant only for goodwill valuation only. Okay, original capital that is invested by them as per the question in the balance sheet is 424. Balance profit is divisible profit 69,000, and in that we will take what we call as 27,600 as share of here. 27,600, that is the calculation of 27,600. Now let's settle the deceased partner's account first. What is the total on the credit side? Are you getting 2,79,800? Only one debit is there, that is for purchase goodwill share of Kia is 32,000. Amount settled, how much amount is settled? 22,47,800. This is the amount that is paid. Everything is settled. They are saying that amount payable to Kia was paid in cash. Everything is settled, and the rest of the part is balance the accounts of the surviving partners. Balance, is it coming to 1,96,000? Are they bringing any additional cash? No, nothing is given. Right. So these are the capitals. Look at the bank account here. Opening balance, was it 34,510? Yes, opening balance is 34,510. JLP, you received 2 lakhs from the insurance company. This money came in handy for the other partners, Dia and Ria, for making payment to. Yes, that is the reason why JLP is taken. And Kia's capital account, after settling the amount, what is the balance? 13,290. Favorable or OD? Overdraft balance. You're turning into, your account is turning into overdraft now. Where is your balance sheet? Look at the balance sheet here. Bank overdraft to the extent of, since they have a OD understanding with the bank, they have drawn 13,219 excess and they settled the account of executors of Kia. Okay, so this is the bank account thing, and accordingly we'll prepare the balance sheet. Land and buildings revised values, furniture revised value, inventory, trade receivables, profit and loss suspense account, 31,800. What is the breakup of this 31,800? What is the profit? 27,600. And what is the interest? How much interest was calculated here? Interest for 6 months on our capital, 70,000 comes to how much? Yes, total put together, is it coming to 31,800? 27,600 is the profit part, correct? 27,600. Let me write it here. Okay. And the balance part is 4,100. 300, 100, right? So totals up to what do we call this? 31,800. This is the amount that will be, yes, profit and loss account. Right? That's it. We are 4,200. Yeah, already we have calculated here, right? This amount, round it off. This amount plus this amount. Both the amounts will go into your 4,200. So this is it. A problem, very important problem from examination point of view. We can expect this model of problem in the exam. So we are done with what we call as partnership accounts, death of a partner.